Oh, yes, I can hear you. Okay. Stabilize it. Yeah. Stabilize it. Okay. 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 The same time I would do as forward. Okay. Yeah. Will do.
Traditional property investing can be a complicated, difficult process, often requiring the involvement of various professionals. Here at Easy Properties, we will put you on a path to property investing without the complexities of traditional property ownership. We've changed things so that you can own a share in bricks and mortar through fractional property investing without making a huge commitment of time and money. Here's how. We've made property investing simpler, smarter, and stress-free. Our team of seasoned property experts chooses the best properties to buy and negotiate discounts on your behalf. We buy real properties and then split its value across a number of shares for you to own. Our quick, easy-to-use online platform makes it simple for you to start or expand on your investment portfolio with just a few clicks, offering investors the chance to start small while thinking big. Whether you're new to property investing or a seasoned pro, our goal is to simplify your investment process through fractional property investments. You'll see investment cases for each available property, as well as valuations and historical returns. There's no pain with bonds, lawyers, or boring paperwork, and the costs associated with investing are much lower than traditional property investing. We'll take care of tenants, insurance, maintenance, and all the hassle. All you have to do is sit back and earn your share of rental income after expenses from creditworthy tenants, paid in cash from us to you. If property prices rise, you can watch your investment grow, and when the time comes, you can sell your share to another investor at the new market price through the auction capability within the platform. You can easily access and monitor all your investments online 24 hours a day. Our mission is to help you to enter the property market. Start with one share, keep building, and soon you could own a property empire. It couldn't be easier. Revolutionize your portfolio to the power of property. Sign up on Easy Properties today.
Good morning and welcome to day 2 of the Be a Better Investor conference. And I think yesterday was an absolutely fantastic day. All the videos are available on the Moneyweb website. So if you missed one of those sessions, please tune in. But last night was the longest night in the year in South Africa. And from today, all the days will get longer, the nights will get shorter. And I think it's really symbolic of what happened yesterday, because there were 2 massive events that I think will make the future of South Africa better. The first one, probably everyone can guess, it's the release of the Zondo Commission report. And that contains a lot of bad news, but the fact that it is in the public domain, I think, is fantastic. And hopefully there will be concrete changes that will change the political situation in the country. And the second one is no more masks, no more COVID-19 restrictions, and I think we can officially call today the first day of the post-COVID chaos we had in South Africa and in the rest of the world. So 2 really good news stories there, and hopefully the longer days will symbolize a new dawn for South Africa. But we are here today to talk about investments. We're talking about giving people tools about how to be better investors. So we will hear from absolute experts in the field about their views on investments, where to invest, how to evaluate investments. And I'm really looking forward to day 2. And we've got diverse topics. We're going to look at foreign investments, not only where to invest, but also how to view the South African market. How should the local market fit into a truly diversified portfolio? We'll look at investments versus trading. That is an interesting topic. We'll look at tax implications for investments, investments in property, investments in fixed income. And I really believe that the overview and the diversification of the diverse topics will offer some really, really good insights. We'll have 2 keynote addresses. Adrian Saville of Canero will speak to us. He's really, really popular, and I think his insights, especially the combination of being an economics professor as well as an investment professional will give us some really, really good insights. And Busi Gia from ASISA, of course ASISA is playing a really, really critical role in the investment industry, and I'm sure there will be really, really good insight. So stay tuned for this edition of the Better Investor Conference, day 2, and I believe it will add a lot of value to the insights and the tools in the toolkit of investors and young investors specifically, and hopefully that will make them better. The first session today will look at foreign investments versus the local market. Of course, it's a big debate for South Africans. Do I take my money offshore? And I think most people will say, yes, I need some exposure offshore. The question is just how much, where do I invest, and what do I invest in? And how does that fit into a diversified portfolio? And hopefully we can ventilate the key issues of this debate today. I don't think it's an either-or debate. And we have Shelo Giose. He's from the First Avenue Investments, a truly professional, has been in the business since 1993. And joining us, I believe, from Turkey, and I believe on a boat, but Magda Vizitska from Signia. I don't think you are on a boat this morning. Just tell us where you are and where you are.
Well, actually, now it's not quite about in Turkey. It's Lake Como in Italy. My husband's 60th birthday.
Well, thank you so much for making time for us today. And I think I'm looking forward to this fascinating discussion. But Magda, let's kick off with you. What is your, if you're a South African, let's take myself as an example. I'm in my 40s, I am not thinking about retirement at all, but I'm worried that one day I need to have sufficient money and capital to allow me to, enjoy maybe also going to Italy once in a while. How should I especially consider the construction of my portfolio? How much should be offshore? How much should be in South Africa? Because of course I want to end or have my last days in South Africa. I've got no plans to go anywhere else.
Right. Well, thank you for inviting me, and welcome to everyone listening. Look, in terms of an investment perspective, I always like to take a macro view. I don't analyze individual stocks. As you know, Signia is a passive manager. So basically what we do is we analyze macro. And if one looks over the longer term, because that is really what you are looking at, the short-term noises of a war in Ukraine, of pandemics of this world are short-term noises. But, from my perspective, a long-term investment looks as follows, and again, depending on which age bracket you are in, and that might very well dictate how much equity exposure you want to have. But I would maximize my offshore exposure at all times. And I will take, I would take that 45% that we have been allowed. If it's pre-retirement savings, I would always have it offshore. I would always have it in equities. I would always have it in a very well diversified portfolio of offshore equities. And by that, I mean broad sector allocation, broad geographical allocation, simply because you don't want to, for instance, invest all your money in S&P 500, which is made up of tech stocks. 25% of S&P 500 is tech stock, US tech stocks. So well-diversified offshore equity portfolio to the maximum that you possibly can. I'll explain that in a second. And then in South Africa, I would invest in, given how high our bond yields are and how high they are likely to remain given the fiscal and economic position of South Africa, I would split my money between bonds and some South African equities. Now, What I'm talking about is not being excited about South African equity investments as a long-term investment option. And you only have to look at, and again going down to basics, the economy of South Africa, the lack of growth, increasing unemployment, high inflation. We are looking at infrastructure problems, increasing infrastructure problems, not only electricity but transport, which means that our resource companies are under pressure in terms of exports. And to be perfectly honest, I don't see how South African equities represent great long-term value for investors as it stands at the moment, unless something miraculous happens. ANC waves a magic wand, which they don't have, and fix all the problems in the country which they want. And then the only additional investment I actually hold in my portfolio, because that is how I manage my money. I never talk about things I don't do. I also have exposure to unlisted alternative investments offshore, not in South Africa. It's not a huge percentage of my portfolio, it's around 10%. But what it does give me is exposure to the private markets. And if you actually look at the types of returns that private markets can generate, so here we are talking about private equity funds and venture capital funds. And yes, I'm biased. I started a venture capital fund in London, but I start products which I don't think have merit. I would have some exposure to the private investments simply because they do offer a completely diversified market, uncorrelated exposure in a portfolio.
I want to invite viewers to send questions to events@moneyweb.co.za, or if you watch on YouTube, use that chat function and ask questions, and I will put it to the panel. Shallow, Magda's not very positive about South African equities, especially. She believes an international equity exposure would suit most investors better. What are your views?
Yeah, it's hard to be positive about South Africa, but it's never been easy to be positive about South Africa. Since 1900, it hasn't been positive about. It's been difficult to be positive about South Africa. If you look at that time frame, though, since 1900 till say 2010 and 2011, South Africa has been the second best performing stock market in the whole world in dollar terms, in real terms. So adjusted for all the things that Magda is talking about, inflation, adjusted for currency movement in real terms, in dollar terms, South Africa has been the second best performing stock market compared to 19 developed stock markets. So you take the United States, Switzerland, Australia's in there, Germany, Italy, France, United Kingdom, and so on and so forth, right? So these are liquid, diversified, and investable stock markets that have driven the MSCI world. South Africa has been the second best performing stock market. What have we had since 1900? We've had all sorts of things in South Africa. I don't need to tell you, we've had a Tory history, we've had civil unrest, we've had a revolution, we've had very strange financial architecture, the financial rand, the commercial rand. We've had independence since then. We've had all sorts of global ruptions. We've had the 1998 emerging market crisis. We've had the 2001 tech bubble. We've had the 2008 bubble. In all of that, the South African stock market has done phenomenally well. So South Africa does have a role to play, South African equities that is, do have a role to play in the construct of one's portfolio for wealth generation. In no small part, this has happened because South Africa has commodities that participate in global growth. But in no small part, South Africa has phenomenal management companies that are really focused on capital allocation, not building overcapacity, unlike Chinese management companies who build capacity, like Japanese, they build capacity. They oversupply the economy with capital, with manufacturing capacity, with industrial capacity. We are deindustrializing because we're so focused on getting returns per dollar, per rand invested. So we look at companies like First National Bank. It is a truly world-class bank. When I compare First National Bank for instance, to some of the best banks in the world, M&T Bank, Wells Fargo, Goldman Sachs, State Street. First National Bank is, bar none, the better in that cohort. So I'm not comparing it to emerging market banks, not by any chance. When I compare, for instance, clicks to its cohorts around the world in health and beauty, clicks, bar none, better than Scripps, better than CVS, better than Walgreens. So you can do this in South Africa, right, and participate in some great capital allocation that takes place. Now, you always have to look at valuation, right, and say, at what point is the United States more expensive? At what point is South Africa less expensive, right? And the United States is obviously always more, not always, but structurally more expensive, perennially more expensive than South Africa. But that's also because the United States generates better returns on capital than South Africa. The United States is a more dynamic economy than South Africa, highly competitive. But the United States also does something that South African companies don't do. The amount of share buybacks, so reducing the capital outstanding. So you raise capital for investors, but then you buy some of their shares back. And this is what Warren Buffett does. He stays with companies that over time have a shrinking share base. So he becomes a bigger and bigger, larger shareholder in those companies. So South Africa has a role to play. Now, let's not forget one thing. South Africa is only about 0.8%, maybe less, of global GDP, and that's shrinking. South Africa assets, financial assets, are about 2% or less of global financial assets, and that's shrinking. Other countries are getting bigger and bigger, right? When I say other countries, certainly the United States, certainly Europe is getting bigger. So when you're a South African investor and you're looking to parlay your investments or your capital or your savings globally, be very mindful of the fact that there's greater opportunity in the world. When you're 2% of the world from a financial asset standpoint, and you're 1% of the world or less, or 0.3% of the world actually in GDP, obviously there's great opportunity. The world is far more diversified in terms of the industry you can pursue. So when Magda talks about venture capital, she's probably talking about things like biotech, which we don't have. We don't have even something as simple as an arms industry, which is controversial, but is a phenomenal place to be in. We don't have many industries in South Africa, so you shouldn't be beholden to just investing in what you know. You can have a home buyers investing in what you know, but don't be beholden by that. What it does, right, is that it makes investing difficult, because how do you invest in sectors you don't know? How do you invest in companies you don't know? The tech industry, for instance, we don't have any here. We have Naspers that has Tencent, but that's not South African, right? We're just a holding company that babysits those shares, if I can put it honestly. So there are opportunities that are global, that are diversified, that are wealth creating in the context of valuation. So what would I do from a proportion standpoint? I would certainly put a majority of my capital offshore. I would certainly put, I would say about 70% of my capital in global markets, and I would certainly put 10% of my capital in South Africa, in equity markets in South Africa. But South Africa does have high yields. And no matter how bad the ANC is, no matter how bad the government is, I mean, they are determined not to go bankrupt. It's the last thing we have, actually. It's the last thing we have. We are at the last end of whatever grace the capital markets can provide us. The government is determined not to go bankrupt. So high yields in South Africa are really worth it. So South African bonds do have a role to play.
Is the biggest risk for investments a political risk in South Africa, especially for the local market?
Political risk, but I would have to say also, the lack of dynamism. I think maybe legislative creativity. We just don't know how to grow the economy. I think, in essence, we're state-driven. So
it's a political risk.
It's a political risk if you look at it that way in general terms. Not political in the sense of that we're about to kill people. That's not the kind of political risk I'm talking about. I'm talking about just inadequate legislative creativity to drive the economy and lower risk.
Magda, I want to come back to what you said earlier. You need to have your maximum allocation in your portfolio offshore, which is 45%, but that is within the retirement industry, the so-called Regulation 28 limitation of foreign investments. If you have a discretionary portfolio in South Africa, in addition to a pension fund or an RA, how much of that would you invest offshore?
So I would agree that that percentage is somewhere between 60 to 70%. And, the main reason for that is that, yes, there is the past and what JSC might or might not have done in the past. But you can't discount two factors. One is that JSC is artificially propped up by Regulation 28. So, given that the vast percentage of South African savings is actually trapped either in institutional retirement funds or retirement annuities, you can't discount the fact that they are only permitted to take 45% of money offshore, which means that most domestic asset managers still focus on South African equity markets by definition. Then the other aspect of it, and they almost three kind of things which are, which talk to the JSE. The second one is that the number of listings on the JSE and hence investable opportunities are shrinking. So there are a lot more delistings that we have seen happen than we have seen listings, and that trend is not stopping. And the next one is the dominance of effectively NASPERS and now process on the returns of the JSC over the last decade or so. So if you strip all of those effects out, I don't think, the JSC really does represent such a great opportunity. Now, in terms of commodities and being a commodity market, I think you have just as an attractive commodities market in Australia as you have in South Africa without having to take on all the political risk, or the political incompetence, really, and the economic risks associated with the fact that, for instance, you cannot transport and export steel at the moment because our port infrastructure has been destroyed by, KwaZulu-Natal storms, and little has been done to maintain that infrastructure. So, irrespective of the fact that, JSC is a little bit of a hotbed of trapped money and domestic asset managers keep the money in South Africa, if I'm a rational investor, I do want access to as broad a portfolio of opportunities as I can have. And again, it is the biotechs, it is tech, pure tech that we don't have in South Africa. There are armaments and there are other sectors that we truly do not have represented on the JSE. And if I am structuring a portfolio, I want exposure to all of those sectors to the very maximum. So I would not keep more, irrespective of the higher inflation potentially in South Africa than in other countries. Although over the short term that obviously has switched. Irrespective, I would want to have anywhere between 60 and probably again closer to 70% of my money offshore.
Do you regard companies like Naspers, Process, AB InBev, even maybe Sasol, Richmond, which also dominate the local market, do you regard them as offshore companies? Because they earn the bulk of their income offshore?
100% I do. That was one of my arguments for, a pro-lifting of foreign exchange limits within Regulation 28. And the argument was that, although there are many companies listed on the JSE, they create no jobs in South Africa or very limited jobs in South Africa. They have very limited operations, if any, in South Africa. So what you are then saying is, if you look at a company like Naspers, is what you are saying is that by investing in JSE, if you want tech exposure, your sole exposure, tech exposure that you can get via the JSE is investment in Tencent, not in Alibaba, not in Microsoft, not in Amazon. It's Tencent alone. Richmond, again, luxury goods, very limited range of brands that Richmond owns. So if you said to me, would you like exposure to multiple luxury retail companies, or would you like exposure to just a few that Richmond owns? The answer is obvious. If you ask me if you want exposure to broad tech market and all the tech companies available worldwide, Or do you just want to concentrate your exposure on Tencent? Again, the answer is obvious. I don't want Tencent. In fact, I want a merry split between Chinese tech and US tech exposure in my portfolio. And that is basically equivalent to saying I want to take my money offshore.
Shlomo, interesting perspective.
Sure. I would say, it's actually a little bit of a complex subject, this, because every country to a certain extent has the same weaknesses that Magda is talking about. If you look at the Spanish stock market, I can ask you, what does the Spanish stock market have to offer from a diversity standpoint or diversification standpoint compared to the South African stock market, right? If you're sitting in Spain, do you look at the whole Spanish stock market and say, there's really nothing here that's special. I can get the best companies in the United States. I can get the best companies, somewhere in the Euro 60 or Euro 600 or Euro 60, but not in Spain. You can do that with the United Kingdom. I can ask you, what really does the United Kingdom have? What particular stock that's special does the United Kingdom have, right? If I look at Switzerland, I say, okay, maybe there are 3 or 4 companies in Switzerland that are outstanding. So, there's something called comparative advantage. You're not going to have everything in every country, but you can't junk a whole country. You have to pick the best of what each country has to offer. And it's true that South Africa doesn't have all of it. The stock market in South Africa does not compete at a high level compared to the rest of the world. I would have to say that the United States is really extremely broad and extremely diverse. It gives you a wide variety of sectors that you can pick. And the United States presents that opportunity to not just South African investors, but to European investors, Spanish, Turkish, Portuguese, and so on. Because what does a Portuguese stock market have? If I ask you, tell me one good stock in the Portuguese stock market. Tell me one good stock in the Italian stock market. Maybe Essilor, like Luxottica, right? So this is the point that you're trying to make here is that each country has its own sorts of ills, but you can't junk each country because of those ills. Each country has a not even plethora, a sprinkling of opportunities. And it's true what Magda's saying is that why buy Richemont here? You can buy it in Switzerland. Why buy Naspers here? You can buy Tencent, right? But I just mentioned earlier that when you look at the world, you might say, well, I'm going to buy Clicks in South Africa. I'm going to buy Discam in South Africa. I'm going to buy Freshwan in South Africa, right? There are some opportunities which you can find in South Africa. Now, that doesn't mean that you make up a whole portfolio with South Africa. It means that South Africa becomes part of your construct, albeit a smaller part of your construct. I do agree that I would have to say 70 and 80% is what you take offshore. It just makes it far more complex to do that, to analyze those opportunities, because once you go offshore, you're on the hands of the wolves. I ask you a question. Choose out of about 1,000 fund managers, which one is better for you? Okay, that makes it far more complex, right? And fund managers like us are vying for that opportunity. So there's a home bias in terms of looking for opportunities. There's a home bias in terms of looking for managers. But I also make one more point that I think Magda is getting at here, is that South Africa has an existential problem that it has to figure out. And the way I look at it is that the government really isn't interested in looking at this problem, right? But the problem is we have about 980 state-owned enterprises. We have about 230 listed companies. 230 listed companies drive more value, GDP, than 980. We have a whole bunch of tax money that's being shoveled at a voracious rate towards the 980. We have companies that are on the stock market that don't benefit 1 penny from the taxpayer. When I say 1 penny, they're not funded by the taxpayer, right? They obviously drive on roads built by the government and so on. So the government builds an infrastructure, but that infrastructure is being built at a reducing rate. So these companies are looking after themselves, creating jobs, creating income, growing wages, growing GDP at a much faster clip than SOEs. That is the existential problem. If you could take even half of those SOEs, if you take Transnet, put it on the stock market, if you're taking SAA, put on the stock market, if you're done, you get better capital allocation, those companies would be contributing towards job creation, contributing towards wage growth,
like
and so
Telkom
on.
did.
Like Telkom did. So this is a lack of legislative creativity. This is a lack of adherence to what's actually working. 980 versus 230, right? And the 230 is shrinking. Yet we're sitting with a bench of 980 that is not coming on to the field, right? This is the existential problem that Mark is talking about. Because if that were the case, we might have better companies, not even better, we might have a greater diversity of companies on the stock market. Like if Denel had been on the stock market, Denel would have competed with Lockheed Martin, in the States, with Northrop Grumman, right, in the States. It would have competed with, it would have contributed some diversity.
Yeah, and I think they would have been managed slightly better within the, higher auditing requirements and JSE listing requirements, which offers a lot more transparency. But I see some signs, the SAA, although there is maybe a lot of concern that it should have gone bust, but it's in private sector control at the moment. We see with Transnet, private operators will be allowed on railways. So maybe there's movement. I think the development state model, which the ANC and government has implemented not successfully, if that changes, we could see some of these structural problems being addressed.
Well, I mean, here's a bigger opportunity, right? You need to have an equity culture in a country, okay? I think at this point in South Africa, there's a small percentage of the population that actually takes its own discretionary money. I'm not talking about pension funds. Takes its own discretionary money, which I think a lot of your listeners too are stewards of discretionary money, to put onto the stock market as a first step. Okay, it's a lower step than to put onto the global stock market. That's a higher step, right? Now you think about it, if you were to get more and more people from the rural areas, from the townships, okay, people in remedial areas of residence, to put them onto the stock market, develop an equity culture by extending or by introducing SOEs onto the stock market. And I don't care how you do it. The government owns 5-10% at some point, but you put it on the stock market. You'd get a government that is interested in developing the stock market, interested in telling people to develop an equity culture so they can look after themselves more than the government wants to look after them through grants. That really would liberate the economy, grow it such that this would be a wonderful economy, let alone a stock market.
Magda, let's talk about the exchange rate. I think many people only want to invest offshore to hedge themselves against a weakening rand. So what are your views on the exchange rate and how big a decision or role does it play in the decision to invest offshore or not?
I think it plays a significant role without being the dominant factor. So, just a couple of things I wanted to touch on in terms of, discretionary savings and individual savings, and even, financial advisor to advising individuals to save. I think too much focus, as we're debating this, has been placed on individual stocks. Now, 99% of the population is in no position to stock pick and select the companies they want to invest in. And even if they feel they are, they shouldn't feel that. Most people are ill-equipped to select companies, and the best advice that you can give to investors, domestically or internationally, incidentally, is to actually invest in broad-based index tracking funds at low cost, broad exposure, without having to select any stocks, which frankly, if you are holding a day job, which doesn't involve stock analysis, then frankly, you have no space selecting stocks. So it's very foolish to think that you've got some extraordinary powers to select the stocks that will outperform. So that is my one point. Now, the second point is currency. And obviously the currency is a function of flows of money in and out of the country. And, the rand suffers from two issues. One is, and it's a big one, is that we have one of the most liquid emerging markets currencies in the world, which basically means that foreign investors, when they invest, on basis of sentiment, like South Africa, because they can buy and sell There are no restrictions and no liquidity constraints on how quickly they can exit the market, which is why you see quite a lot of volatility in our currency. Now, what has propped up the rand to date is a high yield. So foreign investors, in a world of almost zero, if not negative interest rates offshore, are attracted to South Africa simply because we pay such high interest rates on our debt. Now, that is a double-edged sword. Why are we paying such high interest rates on our debt? Well, it's because we have failing infrastructure, a government which doesn't have credible economic policies on the table. Even if we had these policies, we have absolutely no implementation capabilities, as we have seen. And, I am still to see a reverse of that. So, you don't have to be a genius to open a newspaper every single day to see kind of one negative story after another emerging out of the public sector in terms of how the economy, the municipalities are being mismanaged. As a consequence, is there a world where we could see in the short to medium term the rand appreciating and hence domestic investments being more attractive simply because of the currency strength? And frankly, apart from our interest rates edging a little bit higher, not too much because that would signal potential for default, but our interest rates edging a little bit higher, yes, we will attract more investments, and yes, the rand will remain at the level at which it is right now. But make no mistake, the investments we are attracting have nothing to do with long-term infrastructure-based investments or ones that are creating jobs. It's hot money coming in and out of South Africa. So any further reversal in sentiment in terms of any more negative data points emerging out of the country will result in money again flowing out and the currency depreciating, and you are better having your money offshore. And I think when people think about offshore investments, right, you're quite right. The for the foremost thing on their minds is not diversification away from the commodities on the Johannesburg Stock Exchange or exposure to different sectors. It actually is the fear of further currency depreciation. And look, we've been through a lot. If you actually think back 10 years and, the rand being closer to 8 rand to the dollar, we are now looking at 15 to 16 rand to the dollar. One needs to ask oneself a question. What would need to happen in South Africa to ensure that the rand doesn't go to 20 rand to the dollar and in time 25? And obviously, there are theoretical things that could happen. There could be good economic policies on the table. There could be government eventually coming to its senses and rather than protecting trade unions, actually privatizing SOEs, or at least partly privatizing SOEs, and relaxing regulation. You could have people deciding to, because that's also yet another major issue which talks to growth prospects of South Africa. You could implement policies which are tax friendly to foreign investors. So tax-free zones, breaks on
Yeah.
taxation, which would again attract money to South Africa. You could introduce a more vibrant venture capital industry in South Africa, which is non-existent, which would keep our young entrepreneurs in the country, which would translate into job creation. So there is a lot of things that with proper thinking and proper people around the table, you could implement and, reverse this almost inevitability if things continue along the same path as they are on at the moment of the rand continuing to depreciate. But I still
Magda,
have
can
to
I interrupt
see
you there? We've got 14
tangible.
minutes left. I just want to quickly, one of the questions is, the word valuation hasn't been mentioned once today. It seems like the share values have been influenced by political developments and prospects. Do you want to comment on that? What role does valuations play in your investment decision, local versus international?
Sure. I mean, I mentioned valuation at the beginning, that you can look at global versus local all you like, but valuation is extremely critical. So you pick the best breed of companies as you wish, or you pick the best opportunity as you wish. You look at diversification all you wish, but you got to buy valuation. So when you look at the last 5 years, the United States has obviously done, not even 5 years, I would have to say last 12 years, the United States has done phenomenally well relative to the local market, right? So valuations of South Africa today versus the United States, South Africa is more appealing than the United States. Now, will the valuation in the United States ever be cheaper than South Africa? No, but they'll contract, as they have contracted at this moment. At this moment, I think what's the best thing to do? The best thing to do is to allocate more capital offshore, because valuation has become more attractive. But there was a time, certainly, say December 2021, when it would have been more prudent to put money in South Africa because of valuation. You know, that's really how you invest anywhere globally. You pursue valuation opportunities together with the quality of companies that you're pursuing. But I just wanted to mention one thing about currency, right? I mean, I think as South Africans, you know, we're really good about identifying what's negative, right? And we go on about that, but you can't have it both ways. The rand is not where it is by mistake. The one good thing we have in this country, besides the tax man, who's getting better at it, is fantastic monetary policy. Our central bank is right up there behind the Fed and behind the ECB and behind the Swiss National Bank with regard to how it's stewarding this country. If it wasn't for the Reserve Bank, think about how much less confidence international investors would have to even use a rand as a proxy for emerging markets. Our currency is about as good as it gets because we have a central bank that's about as good as it gets, right? So each currency has value, and that value is driven by two things: confidence behind the central bank that's stewarding it, and interest rates. Interest rates are not the only factor, it's confidence behind the central bank. That really, we can't have it both ways. That's really a good thing. Whether you want to take money offshore, and when you do take it offshore, you put it in a passive investment, as Magda says, is up to you. Or you put it in an active investment, it's up to you. But either way, which passive investment are you going to put it in? BlackRock, Signia, or Barclays, whatever. I mean, there's so many of them, right? You are in the hands of wolves, by the way, based on valuation also, by the way.
Now, there are a few questions regarding, you know, in what do you invest? I believe there are about 3,000 funds in South Africa. In the world, there probably could be 3 million funds. So the investment universe is really, really vast. Magna, do you look at actively managed international or foreign funds in South Africa? How good are the local analysts and fund managers in picking offshore stocks? And or do you look at international active managed funds? I know you, Insignia, is really big in exchange traded funds and index trackers. So how would you approach it? Because I don't think there's an either or scenario, but how should we look at it here?
Actually, interestingly, there isn't an either or. So, I'll be controversial by saying that I don't think that South African domestically based asset managers are in any position to choose and pick stocks offshore. And, one of the reasons is very simple. Our local asset managers have small investment teams. Their knowledge, by virtue of Regulation 28, is very localized, so they know the Johannesburg Stock Exchange stocks very well. If you look at the thousands and thousands of stocks that are available for investment offshore, we just don't, as a domestic asset management industry, have the resources to analyze well stocks offshore. So that's the domestic asset managers. Now, internationally, and Signia, you might have, we obviously have a firm belief that passive investing is a very sensible way of investing for a standard average investor, simply because the low cost aspect of it does translate into better returns over time. But we, as Signia, we are also multi-managers, so we also do select active offshore asset managers where we come across those that have done very, very well. And excel in a particular area. So we are not, in my mindset, I'm not an exclusively passive investor. And there are international companies which are, and look, there are thousands of offshore asset managers, and it is absolutely naive to suppose that you will be able to identify out of these thousands, that you'll be able to identify the one or two or three that are the best. There are many very good offshore active asset managers. If you do some research, you will find them. You will find active funds that have done very well. But irrespective of whether you are going active or passive, my advice has always been go broad based in terms of exposure. So the bit where, people sitting in South Africa believe that at any given point in time, they can select whether, and successfully select, whether they invest in technology stocks at a point in time, on in mining, or in value stocks, or in growth stocks. If you invest, is a bit of a misnomer. Again, unless your full-time job is being an asset manager. If you are investing for the long term, the safest way of investing, be it passive or be it active, is to invest in managers or strategies which are diversified, and they diversified across sectors, and they are diversified across geographies. So, for instance, a very simple index tracker, whether it's managed by a Signia of this world or a BlackRock, MSCI World Index gives you a very broad-based exposure to the world.
Okay.
And then
I
you
just wanna
can tilt
say-
it.
I just want to say, Magda, I think it's extremely critical of you because you've gained capability now. You're able to look at global markets and global managers. I think it's extremely critical that Magda, you use your bully pulpit, your platform, to actually develop the local stock market, develop local managers to be able to develop them into managing global equities, global bonds, and global asset classes. I don't think it's healthy to say South African managers can't do it, and therefore I'm going to pick, Aberdeen Asset Management. I think you need to look at South African managers and say, okay, now we're coming out of Reg 28, 45% is going to turn to 50, to 55, to 60. How do we bring along the South African asset management industries that they are capable, or it is capable, to compete with an Aberdeen, with the Shoulders, and so on and so forth? It's not. I don't think it's the right way to say, junk South Africa managers. Let's go to global, because South African assets, like assets around the world, do present systemic risk. But how do you have systemic risk with assets sitting overseas? What if Aberdeen goes under and it's carrying South African money? It's extremely critical that we develop South African capabilities to manage global equities rather than to just leave them behind. The second thing that I want to mention is that I think at this point it's really unsafe for the FSCA to increase Reg 28, or is it the Reserve Bank to increase Reg 28, to increase offshore allowance to 45, without thinking about an architecture like UCITS. South Africa needs to now develop an architecture like UCITS that determines the kind of risk that managers should take, risks that investors should not be exposed to, so that we can invest healthily abroad, no different from how the ECB has done it, no different from how the SEC has done in the United States. We don't have a UCITS infrastructure or architecture in South Africa. We really need that, because if we don't, then we derive false comfort in the fact that UCITS in Europe does it. What about a South African architecture that actually does it? We don't have that. So now you're in the hands of anybody that says, I think I can do it safely overseas. That's not good.
Is there any research on whether local managers underperform international managers? I'm talking about active managers.
Yeah, they underperform, they outperform, they do it just as well as anybody else, actually, I have to say. We run a product that actually does global equity, and it does well at times, it doesn't do well at other times based on style. But I think the greater point is this, that from 1800 to today, the United States has had opportunity to keep money in the United States and develop its capabilities, so has Europe, so why not South Africa?
Magda?
Look, with all due respect, I am not, for want of a better word, dissing South African asset managers. I think they are very good at what they do, which is invest in South African stocks. That is what they've been trained on. That is the portfolios that they manage today. Now, in terms of the international investing and developing the South African asset management industry to invest internationally, I would just like to make one point. It kind of talks to this concept of we should believe in South Africa and we should create jobs in South Africa. Well, South African asset management industry has not been a job creator in South Africa. South African asset managers employ handful of people to manage money. So investing a lot in developing of South African asset management industry in order for them to manage money offshore is kind of neither here nor there in terms of job creation in the country. And then the other thing that you're fighting
It's capability
against,
building,
and that I
not
think is a
separation.
bigger problem,
Capability building.
is a much bigger problem is the skills drain from South Africa. So it's very well to talk about upskilling South African asset managers to manage money offshore and building up those capabilities. But I only have to look at my sons, and I've got 22 and a 24-year-old, to tell you right now they've obviously been educated through best schools in South Africa. They and all their friends of any color, incidentally, not only white, are leaving South Africa in droves because of lack of opportunities. So when you are talking about taking the best and the brightest and turning them into asset managers that can manage money offshore, ideally, yes. Realistically, they are on the next plane out of South Africa. So we've got a bigger problem.
Magda, I'm going to interrupt you there. We've got a few minutes. I just want to ask a last question is, do you invest directly in funds offshore or do you invest via feeder funds in rands in South Africa? I'll come back to Shlelo also with a view on that.
You know what? I invest in ETFs on the Johannesburg Stock Exchange. It's just so much easier. Then I don't invest in feeder funds. Feeder funds, unit trust feeder funds, are typically kind of fees on fees on fees. So there are layers of fees. You can achieve exactly the same by investing in an exchange traded fund through easy equities, for that matter, or any other stockbroker on the Johannesburg Stock Exchange. One layer of fees, the same offshore exposure that I can get. And then when I want to take money offshore, physically take money offshore, I only do so for the purposes of investing in asset classes I can't access in South Africa, like private equity.
Shlelo?
Yeah, I think she's right about feeder funds. You could have high costs to a fund if you do that. I think the responsibility to grow your wealth is an incredible responsibility. It is complex. It's not an easy task. I think it's important that you either invest through an ETF or passive product or active product, whichever way you choose to do it. Rather do it directly than through feeder funds. And I think it's actually also critical that I'm not going to stop mentioning this, that South Africa has to develop its capabilities because it does have something to contribute from a financial asset standpoint, from a systemic risk standpoint. And so there have to be capabilities in South Africa that are built, whether active or passive, to be able to serve serve investor interests, investors' monies.
I think we have a few minutes. The session has been stretched because I think this is a fascinating debate. There are several questions regarding the structure of investments locally versus offshore. We have a special session later today just covering that topic. But let me see here. Questions regarding the US inflation rate. Of course, we saw an inflation rate yesterday in South Africa of 6.5%. Many people thought, wow, that it's a lot higher than what was expected, but we also see inflation problems elsewhere in the world, especially in the US, and that is set to continue. Obviously, that will trigger higher interest rates. Magda, does that concern you?
Look, it is what it is. That inflation that we are seeing globally approaching 8, 9, 10% in projected in the UK, for instance, is a little bit beyond our control. So a big function of it is obviously the war in the Ukraine, the higher oil prices and gas prices, which then translate into almost higher prices of everything, higher prices of transport, higher prices of electricity, and then obviously the food issue and the food supply issue. Who knew that Ukraine was the breadbasket of the world? So you've got a side of this inflation which you can do nothing about for as long as the base effects continue. So as long as a year ago the prices were lower, then the inflation number today with higher prices will be higher. In a year's time, when your base effect is today's prices, and next year's prices are at the same level as today's prices because there is no further increase in prices, then inflation will start trending downwards. The only other aspect of inflation is and that is inflation that cannot be controlled, or it's very difficult to control through interest rates and by central banks, because in order to tame inflation of say 8 or 9%, you have to increase interest rates to above 10%. And I don't think any central bank, not the Fed, not European Central Bank, have any appetite for interest rates at that level. Now, the other side of the inflation that we are seeing, and that's not necessarily South Africa, but certainly US, is consumer-driven inflation. So there is this pent-up demand post-pandemic, people going shopping wildly. But I think that in the face of the high food prices and high electricity prices, that Wentum spending by consumers is very quickly coming to an end. It's still there, but it has already started trending downwards. So the reality of this inflation is that I think it's here to stay for at least the next 12 to 18 months. We just have to live through it. I don't think that interest rates, as much as you will see incremental increases in interest rates to try and be perceived to be doing something, I don't think that those interest rates are really going to have a material impact on inflation until the base effects have kind of worked themselves out of the system. So actually, I think it is what it is. It doesn't worry me terribly, but I do think we are heading for potential recession in the US and definitely Europe as a consequence.
Shalo, interesting question. We've spoken a lot about foreign investments. You and Magda have said 70 to 80% of your discretionary investments offshore. What about the 30%? What should you look at in the local market to go and find those stocks, the Clicks, the Dis-Chems, and the likes you've mentioned before?
Well, I think Magda mentioned how good South African managers are with regard to picking domestic stocks as well as picking domestic bonds. I think that's what the 30% goes to. I think it's stocks, bonds, property, and I think do as little as you can in cash. I mean, cash feels safe at this point, but I think when you look 1 year out, you really miss the opportunity to have bought bonds at a high yield and benefit from the bond market when bonds drop or yields drop and bonds go up, right, and bond prices go up. I think you'll regret doing that. I think you'll also regret buying equities at this point, because if you look 5 years out, you'll be in a much different position from a noise and sentiment standpoint. So I think it's really just three asset classes that you worry about. And I know there are things like gold and there are things like Bitcoin. This is a retail investment. I really wouldn't worry about Bitcoin. I really wouldn't worry about, I would even say gold. I have to say just worry about things that are confidence driven and have an interest yield to them.
So don't put it under your mattress or your cash in a couch.
Well, I mean, how much money would you have made had you done that, say, when was Sharpeville, 1967 or something? What would you have done? How much money would you have made in cash had you taken every terrible news point, political point, social disruption, and put it into cash? You'd have lost out on a lot of money. So this conference is about wealth building. Obviously, be safe from a valuation standpoint. And I'm going to say this, it doesn't absolve you of the responsibility of seeking a good steward for your money, whether it's active or passive.
Well, I think we can speak about this topic for many, many hours, but I think this was a fascinating discussion. Magda, thank you so much for talking to us all the way from Italy. It seems like a lovely day there. It's a cold and windy day here in Johannesburg. But thank you so much for your time and participation. And as well as Slelo Giose from First Element. Thank you so much.
First Avenue.
First Avenue. I'm so sorry about that. And thank you for your participation
Thank
today.
you very much for having me.
Yes, and I think it's a great session. I don't think there's a silver bullet on how you decide how to invest offshore. I think the key takeaway is you need to have a significant portion of your portfolio offshore. And once you're offshore, it's not the easiest decision. Maybe a broad ETF or index tracking type of approach could be conservative and the most adequate in these uncertain times. Thank you so much for joining this session.
Thank you, everyone.
I'm Simon Brown. I host the Moneyweb Now podcasts every morning, 6:30 weekdays. Of course, a podcast itself just after 7. And today we're going to be talking around difference between saving, investing, and trading. They kind of fit in the same place. They're money, but they got distinct differences as to exactly where they plug into each other. If you've got questions, you're welcome to send them. events@moneyweb.co.za. And today I'm joined by Neelan Mora. Neelan, appreciate the time today. Vice President Trading at the Purple Group, a CV that runs into half a page. I'm not going to go through all the details, except to say that you've also been in the market a long time. It is a tough market right now. We've seen this before, nothing new. This is what markets do best, truthfully.
Absolutely. And you know, in the volatility and the uncertainty lies opportunity. And, you know, we've got to look through that. So we'll chat a little bit around savings. We'll chat around the relationship between savings and the overlap between savings and investing. And then bring in your favorite topic, trading.
Yeah, it is. And I mentioned in the intro there, which is, you know, they're distinctly different, but there is overlap. They all sit into our money space. And my key thing is always that, you know, I suppose the first question is, you know, saving, investing, trading is a case of, well, what am I trying to achieve? What's my aim with this? Because that helps guide, you know, if I'm buying a house in 3 years and I want to deposit, that's easy. It's saving.
Yes, absolutely right. And so, you know, to extend on that question, what are you trying to achieve? But also, how do you achieve it? Right. So, saving is probably best described as putting away for a rainy day, for a goal, as you mentioned. Typically involves short-term stuff. So the duration is quite short, and typically involves cash. And oftentimes that cash is going to sit in a call or a savings account, so it's easily accessible, specifically for the goal that's required. If you extend that a little bit further, and we look at the current structure of the market, and we say, let's say on a savings account. Ironically, savings accounts at our institutions offer the lowest rates of return, right? But nonetheless, let's say you're earning 5%. And I know in the previous discussion, they introduced the concept of inflation. Let's bring that in a little bit. And let's say inflation is running at 10%. It effectively means that your money is worth 5% less every year, or your buying power. Another way to look at it is that, it would cost you 5% more to buy the same value of goods that you would buy this year. So you've got to introduce the concept of, if that money is just sitting there for short-term use, fine, you can weather that differential for a while. But how do you then keep up with inflation, and how do you preferably beat inflation? Because that's the sole purpose of investing. Firstly, the horizon is much longer than the savings. So you're looking 5, 10, 15, 20 years out, possibly up to retirement. Now, structurally, our market locally, there could be reasons for this, or structural reasons for this. But we must remember that, if we continue referencing those reasons will remain and become an excuse, right? So we have to address them now. Apart from the structural reasons that exist, our country has an extremely low savings rate. Stats SA at the end of last year released a number that was like 1% household savings, which was up from 0.3 the quarter before. Now, the arguments around why that may be the case, perhaps COVID brought on a little bit of fear, and people, for the fear of income generation or job security, people saved more, but nonetheless, 1% is dismal. Another very interesting rate, when you start looking at things, say, in this investment space out to retirement, is something called the replacement rate. And essentially, and this is a scary number, because essentially what this means, and I think this was released by PSG if I'm not mistaken, what this means is that what percentage of your current salary or income pre-retirement is replaced by your retirement funding efforts up to that point. So very simply put, let's use an example. Let's say you're earning 10,000 Rand a month. SA, incidentally, again, is one of the lowest rates in the world. The average replacement rate globally is 70%. SA is at 12%.
Wow. So that means if I'm earning 10, I'm going to get 1,200.
You're going to get access to 1,200 Rand post-retirement. That's the current structure of this. So it's a dire issue that needs to be addressed, and it needs to be addressed now. And unfortunately, it's not a short-term fix.
Sure.
But the efforts now will lead to generational wealth, and behavioral changes down the line. And that's what we've got to address.
And that's what we've got to address. And it comes to your point. We're on saving, and it's weird because the pandemic, if nothing, suddenly all those emergency funds got dusted off in many cases, although a lot of people didn't have them. There's a flip side to it as well. I meet people sometimes, youngsters in their 20s and 30s, and they've got a large amount, and it sits in cash because they're scared of the stock market. The point you referred to there, it's about time. A couple of years you can take that inflation drag, but over decades you're going to get so far behind. And we look at the market, particularly now, things falling, everything looking ugly out there. Truthfully, these sort of things happen, but they pass. Markets are where wealth is created. Savings is not where wealth is created.
Absolutely right. And Simon, if we look back, and we mustn't forget that many new participants to the market, and I'm talking 10 years or younger, and that might show our age. But
I think it does, but yes.
10 years or younger have hardly had the opportunity to understand, experience, invest, trade, save, participate through bear markets.
Yeah.
Right? You and I have seen a couple of them. Incidentally, certainly the last three have produced the best investment opportunities. Can you imagine 2008? We simply bought, closed our eyes, put everything in and left it. Beginning of this year, we would have been smiling.
One of my worst buys in 2008, incidentally, and it was one of the banks, it did incredibly poorly relative. It was up 150% in the couple of years post.
Exactly, that's the point, right? So you've got to look through that. Don't ignore the opportunity that this presents. There are periods in financial markets that need to flush out excess, for example, gearing. And we'll get onto those topics when we bring in the trading aspect of it. But when the market is over-geared, or when the market is overly positioned in one way, and when the market is supported unnaturally, as we've seen since 2008, what we're seeing at the moment is natural. We have to unwind a little bit of that exuberance, if you like. And again, through that provides lots of opportunity.
So let's dig into some of that. So savings is your short-term type of stuff. You're going to get a modest rate. You quite possibly are going to be behind inflation, but it serves a purpose. It's an emergency fund. It's a need, a short-term need, a wedding or a kid's education or something like that. Once we've got that in place, then we start looking to that investing, and that really is the much longer term. Now we're looking out to decades, if you're young enough, many decades, actually looking towards that retirement.
Absolutely. And the first step towards that, I would say, we've got a great initiative going at the moment in the form of tax-free savings accounts and opportunities. One should look to max out that limit every year as your first attempt to start investing. Structurally, the products that are allowed in this tax-free sphere is obviously regulated and decided upon by National Treasury. But the idea behind it is to allow products with limited risk. So you're buying ETFs are allowed, for example. It's not single company exposure and single equity risk that you're taking on. You're buying broad, diversified investments. The lifespan, if you max out every year, 15 years to reach the current cap, which is $500,000 per individual per lifetime, with a 36,000 investment per year. One should look to max that out every year as the first sort of dipping your toe into investing journey, right? Post that, once you've done that, then you can start looking at other products in the investment space, and there are tons of stuff to look at.
I would even step back a moment and say, if folks have got a job, in many cases, they're already going to have something in terms of the pension and retirement.
Possibly, absolutely.
Which, yes. To them, they just see a line item going off their salary slip every month, and they're not quite sure. But that is going to be, it'll be a Regulation 28 product. There are some tax benefits to it. And you're already doing some investing.
100%. You've got that exposure passively happening in the background. And the nice thing about that is perhaps you're not overly sensitive about it because it's done for you. Right, so that's one of the benefits. I mean, some people get a little too carried away and want to watch these things too closely, and the big challenge with that is managing your own emotions, your psychological behavior. And again, this will come up again when we start talking about trading. Your psychological response and behavior to a position that's going against you is very different when you're holding an investment mindset to when you're holding a trading mindset. Right? You've seen it in the past. You've seen people stress out because the market's gone 10% lower. They've geared themselves 10 to 1, and all of a sudden they're in a pickle. From an investment mindset, though, your behavior is very different. Your behavior is, well, if I'm investing regularly, let's assume monthly, via deductions into your salary or towards an RA or whatever the case may be, the 1,500 Rand that went off last month bought X amount of exposure. This month, the number is fixed, but the amount of purchase is greater because it's cheap, right? So I mean, there've been debates that have gone on for decades as well around who is more successful, somebody that tries to time the market, and specifically they're addressing traders, or somebody who periodically and at a regular period invests into the market constantly all the time. And I think the jury is out, but the outcome was that you know better trying to time the market specifically in terms of the outcome and the return that you generate.
It comes to that behavior, and there's two sides from it. The one is setting up those debit orders, as you say, those monthly processes that just fire off, and particularly if you're going into a broad-based, a collective investment, an ETF or something like that, it almost. It just goes, and you don't have to worry about it. You don't have to look at it. If you're doing individual stocks, it then gets a little more challenging. You've got a particular stock. We had the pandemic collapse of just over 2 years ago, and stocks got absolutely beaten down. And then you had to ask yourself some questions. They didn't all survive. I mean, most notably, obviously, Comair, and that comes to your behaviour then. So even within the investing space, there's different types of behavior you're going to have to sort of straddle and manage within your own thinking and your own responses.
Sure, 100% right. And also, what you got to almost try and do is sit and pair your personality with the investments that you choose. Right? So if you're a high risk individual, then you may have an appetite for stuff that is a little more volatile. If you a methodical investor that doesn't have the stomach to absorb a bit of volatility, you might look for the more stable kind of investment. But understand that the risk assumed in that entire investment universe is proportional to the expected return.
Yes.
Right. So that's an interesting concept which we often say, and it's quite cliched, but people don't question the investments when they're making money. Right. The questions only appear when markets move against you. Yes. So we've seen that now, for example, in crypto. There were no questions the last couple of months. Everybody was happy up to December last year when it was up north of $60,000. People were making money. Now we're $20,000, and people are questioning, well, is this the bottom? Is there space on the upside? Do we go to 12,000, which some guests call technical support? What's the future? Is there a future? We're seeing some of the systems fail, people losing money. So all those questions are emerging now purely because there's stress in the system. People are stressed out about returns. So you got to try and match that personality. A nice way to look at it is that there generally should be a blend across asset class, and across saving, investing, and trading, right? And the ratio in which you have those will be determined by your personality.
Your personality, your risk profile, your age. You're fundamentally different at 22 than 72. 100%. I need to take that. I liked your point around expected return. If you come into the market and you say, great, I've got a big weekend planned, I need to double my money. Sure, you can try. It's going to be hard. You're going to have to go and take extreme risk in the process.
That's it.
The other inverse is if you say, well, I just need this money to still be here for a deposit in a year or two, low risk. But even within the equity, if you're saying to yourself, I just need an inflation-beating return. If inflation's going to average, let's pick a number, 6%. If I can do 12% per year over that period, I've created real wealth. It's that expectation so much defines as to how you're going to interact into the market.
Yeah, and at which segment of the market you're going to interact, right? And what that participation level is going to be of your disposable income that's there to participate. Now, we mustn't water down the difference between these three aspects of the market. They're so different that there are different tax laws that govern them.
No.
Right? And,
fair point.
So they're significantly different, and I know there's a tax segment coming up later today. So, we'll listen with that with keen interest, because how you respond and how you are taxed on trading profits is completely different to investment profits over time. So they are significantly different. And to your point, what are you trying to achieve? Let's just roll back right to the first point you made. What are you trying to achieve will also assist in trying to help us decide what avenues we need to use, what products we need to use, what structures we need to use to get to that goal.
And we want to talk a lot around products. I want to move to trading, and we're getting questions coming through it. My last point on the savings and investing and trading is distinct of them. Is it almost to say you need to have your savings in order, and then you step up to some investing and get that in order. And I'm not saying get that in order in the sense that you have enough to retire on, but that you've got those debits going off you.
You've started.
That
you've simply started.
And then we move to the trading. The trading is sort of the third block, and we need to make sure that we've started in those first two before we run to the trading. I
agree with that entirely, yes. The trading side of things, and we'll get into that in detail, I'm sure, just now, and I'm sure there'll be questions about that as well. The trading should be ultimately with money that you can afford to lose, right? I mean, that could be the most lucrative activity of all three in the space defined or the timeline defined, but it will also be the most amount of risk assumed in the timeline defined.
Yeah, and let's move to the trading and a bunch of questions. If you've got questions, events at moneyweb.co.za, you can send them through. They'll pop up on my phone. We can take those questions. Trading is the more rewarding, as you point out, the more risky. It's also, I spent 5 years in the 90s trading like a pro. What I mean by that is just losing money. No one lost money as well as I did. It was I'm going to say surprisingly, it certainly surprised me, although perhaps in hindsight I hadn't thought about it enough. It was a steeper learning curve than I thought.
Absolutely. There are many things to learn. The most important thing that you learn through the journey of trading is your own emotions, your psyche, how you respond 9 times out of 10, your response is going to be wrong.
Oh, yeah. I think I sometimes got 10 out of 10. And that's within the trading. And Nandi's saying, a question from Nandi, I'm 23, how does a beginner investor get started with trading? Now, firstly, Nandi is saying already investing, so that box is ticked, as we said a moment ago. Wanting to get into it, there's different products that we can trade. And I think people think trading, and they straight away think, well, let's go trade 100 geared FX. Well, hang on. You can trade straight equity, or you can trade those derivative products that sit sort of between equity and the 100 times gearing.
Sure, and trading to a large degree is a mindset, right? You could, let's choose a stock, whatever, ABC. You could invest in ABC, but you could also trade in ABC.
Yeah.
So it's a mindset that you approach. If you expect short-term volatility or short-term gains to be made, then you will trade it. If you expect to hold it because fundamentally you believe that this could go 2 or 3 or 10 times the value that it's worth today, then you'll invest in it for a long term. So, to Nandi's point, try and match that with your personality. Try and match the instrument or the platform or the product that you are using with your personality and your risk tolerance. If you're a risk-averse person, there's no point looking for a highly geared instrument to go start trading, right? I mean, you're just going to work yourself into a corner. Rather try and go with a 2-to-1, 3-to-1 type of geared product where you can stomach a little bit of volatility and you have access to trade it frequently and often. Traders have a different mindset. Their activity and participation levels in the market are high. You could have a person trading 20, 30, 40 times a day. And you could still have somebody that trades once a week, still classified as a trader.
That's a great point, because, in my trading, I trade index futures. I don't trade short because I don't like the volatility, because I make the call, market goes down, we get the bounce, I get kicked out, and then it falls. And it's like, I was right and I lost money. Too much volatility. And I've learned this, I've got the scars over the years. I've learned, for me, it's indices, it's long only. So this year, almost halfway through, I think I've put on 4 trades. 2 were NASDAQ, 1 was S&P, and I think 1 was the local market as well. And that's been because that's what, it's still trading. I got a friend who, as you say, he can do 20 trades by lunchtime. We're both traders. We're both in the same sense. I've got another friend who buys equity, and he might buy a stock, he might hold it for a year and a half, 2 years.
Yes.
He's trading it.
Sure.
So it comes to that sense of your space, but also time allowance. Do you have hours in the day? I remember when I started trading, and I was sort of day trading, and I had a daytime job, and they both went poorly because I was trying to do too much.
Yeah.
You mentioned the gearing, and this is an important component. In essence, if I simplified, Nandi comes along, opens an account, GT247 opens the account, funds it with 10,000 ZAR. What they can now do is actually get 40 or 50,000 in terms of ability to trade, and that's that gearing. Yes. It's a loan, so it amplifies your winners, but it amplifies your losers.
Absolutely right. And again, it goes back to the point that nobody really asks questions until they lose money, right? So I agree with you. Trading is the most demanding in terms of your time. You need to actively watch the market, and you need to actively watch the market specifically if you have geared positions on. Lots of platforms like GT247 and others will offer you a demo, access to the platform where you can play around. My advice to Nandi would please, don't get caught up in the hype of these ads that you see on Facebook where
ad.
People have wrapped Lamborghinis in gold wrapping and made that from trading FX. Those stories are far and few between, and you never hear of the guys that get wiped out along the way, and there are lots of them. So just be cautious on that. Choose the company, do your research around the company that you're opening an account with.
Yeah, your platform.
It's a regulated space, understand who you're doing business with, make sure that they're legit, make sure that they've been around long enough. Those types of things,
Yeah, and you can go to the FSCA website and see if people are registered. And I remember, for example, Mirror Trader International, and I kept on saying, why aren't you with the FSCA? And they said, we don't need to be. And I'm like, to me, giant red flag. You mentioned the demo. I like those loads, and I think there's 2 parts to it. The first is just how does the website work? My broker, for example, when I click buy, pops up a button that says, are you sure? Now, let's be clear. For the first couple of years, no, I was not sure. Of course I wasn't sure. Ask me anything, but don't ask me if I'm sure. But the demo got me to how to use the platform, how to execute a trade, how to pull up a chart, how to place the conditional orders, such as stop losses or sell at profit, so that when you put proper money in, you're more au fait with the platform, but you've also had a chance to try out some ideas. You think to yourself, well, I saw this data point, and that should mean X, so let me try X, and it did or didn't work, and you start to learn. You start to learn how markets respond. You start to learn how you respond.
Exactly, very important. And start small.
Yeah.
There's no harm. Start small. Most of these platforms will allow you no minimum. So, start with the smallest amount, understand, teach yourself. It's critically important to get to a place where you're comfortable around what you're doing. There's nothing worse than having a initial bad trading experience. That will put you off for life. And it has a very important part to play along this participation in financial markets. A small part, maybe.
Sure.
Maybe it's only 10% of your overall stuff that gets deployed towards trading. But nonetheless, it can be very rewarding if done properly.
A question came through from Sean, and it's a great one. He says, what about algo trading, rise of index ETFs, hedge funds? Are these influencing markets? Are they changing markets? Are they changing traders? Have you adapted your trading over the years? I mean, certainly mine is adapted, but my big adaptation is that when I started in the late 90s, it was equities. My ability to access an index product as a retail client wasn't available. Now, of course, it absolutely is.
Sure.
So we've seen that change. But otherwise, structurally?
So I think technology has changed the markets,
Sure.
right? I mean, when we started in the mid-90s or whatever, it was difficult to trade.
Yeah,
It was difficult to get access to
I
information.
had to make phone calls.
Exactly. You had to call into your broker, do a trade telephonically, wait 7 days to get a broker's note to know whether or not you're done. This is all instant. You could pick up that device sitting on your lap right there and trade right now.
Yeah.
That's how easy it is. So technology has made the world small. Technology has made access to information incredibly quick and easy. People around the world, it's flattened that curve now. So everybody has access to the same information at the same time. You don't necessarily need a Bloomberg terminal or a Reuters terminal.
To play golf with the right people. And I like that. That is perhaps in my lifetime of markets, which goes back to late 80s. The biggest changes have been cost, has been access, not just to the platform, but to the information. And that is so, stock would move in the 90s, and days later you would read something and discover, or sometimes not even. That has absolutely flattened that playing field, which means that the likes of Nandi, me, you, and others out there really can get involved. And we can do it at a pro level in sense of the tools that we've got.
Absolutely right. And for close to nothing. It's not expensive to get there, right? So to the point about the application of algos and its impact on the market. The upside to the ease and ability to access to the market these days is that we all need liquidity. For us to trade efficiently and effectively and execute effectively, we need deep pockets of liquidity. So when there are algorithms that are in the background churning this market around, well, guess what? It helps with liquidity. The one downside, I mean, you'll remember good few years ago, the flash crash, which was on, if I'm not mistaken, the 6th of May. That was algo-driven. What had happened was there was a fat finger. Somebody sold Dow futures, triggered levels, and algos pretty much were programmed to say, if the market falls by more than 5%, liquidate my positions, and it just carried on going. And eventually we went down, 25% in a day, and then recovered. But exactly. But those are the risks of algos. But that said, in the advent of no fat fingers and errors and mistakes, like algorithms and high frequency traders, all of them contribute towards liquidity in the market, which we all need. There are periods during uncertainty when we find liquidity withdraws from the market, and the effect that has is it gets more expensive to trade, not from the perspective that your broker is necessarily charging you more, but from the perspective that the width of the double, so the difference between the buying and the selling price widens, and the ability to do volume, size that you need sort of lightens. So you've got to move the market a little bit more to get your size done. So, algos have a place in the market. And they do contribute towards liquidity.
Yeah, and it is. I mean, we're all in there. We're all trying to make an honest buck out of the market, and algos are just part of that. You mentioned the point, and I think the flash crash, for example. As an investor, you will probably be unaware of it. As a trader, it might have cost you. It might have been opportunity. Maybe you bought low. Maybe you were short in the position, and that again comes back to that different place where we sort of tend to sit. In terms of timelines, in terms of products, but also I think in terms of how we do it. And if we go all the way back to savings, we're going to go to our bank and open a savings account. It's going to be, as you say, it says savings, it's a misnomer, it's a terrible return. We're going to have our deductions off our salary into a pension. We're not going to have much nuance as to what is there. We'll put money into a tax-free. At that point, we're making some decisions as to which ETFs. Maybe we're buying some individual stocks. Now we're stepping up another level. We're looking at those fundamentals. And we just had Magda and Khelo Gyosi talking around that part of the process. Yes. Trading is often even further different in that we kind of ignore the fundamentals. We look at the technicals, which is looking at price action.
Yeah, well, and I mean, what we're seeing more and more happen at the moment is a blend of that, where guys are looking at the more macro fundamental themes and then using technicals to try and time that and enter and exit.
So you've got your picture. You say it could be a stock, it could be a sector. You say, I like it. I'm going to use the chart, the technicals, to give me that point of entry.
To time it, exactly. So let's use COVID as a bad example because it's a nasty period and was a nasty period. And let's make it more nasty and consider airlines, for example, over that period. So we knew travel was done, right? Hospitality, we knew that they were going to battle. That's the kind of macro theme setting in that you're now thinking about, well, okay, which hotel group, right? Which offers more value? Which do we think is going to return to value quicker than the other, or not? And then you try and decide from there. You kind of narrow down to 1 or 2 or 3 stocks that you want to look at, and then you'll call up a chart and say, okay, let's look at the price action. Let's see where our areas are on the charts, where are areas of support that we think we could like to. If you're investing, and this is where it's going to come to, right? If you're investing, where could you have your first nibble? Because if it goes lower, you're happy to nibble again, and you're not overly stressed about it. If you're trading, that's where the stress is. If you go all in on the first level and it goes 3 or 4 or 5 or 10% lower, you're going to feel a bit stretched out of the position, right? So your behavior again is going to come in there. So
I like that. And also, there's an ETF in the US, and I think it's called Away, which is solely focused on that travel industry. Obviously, took a massive hit 2 years ago, and some stirred people were like, hang on, this will come back, and they timed their entry, and they held it for a year or so, and they've done well. And again, it might have been an ETF, it might not have been geared, it's still technically a trade. So we were hitting the time. So I mean, the distinction between the three, it comes down to timelines, comes down to risk profiles, and ultimately, then again, the products, which is how they're all going to fit together.
100% right. I would start in exactly the same order. What's your horizon? If you're looking 5, 10, 15, 20 years or out to retirement, you need to be an investor. If you have very short-term needs, you're going on holiday, you need to buy a car, you need to pay for university. That money needs to be accessible easily and quickly. Very short-term needs, quick savings product or on call to try and get a better interest rate. And then, if you have time on your hands to dedicate to the market and pay attention and try and etch out cash from the market and, be active in the market, then trading.
And stay away from the Facebook adverts.
Yeah, exactly.
Because to your point, yes, there's a Lamborghini, but there's another 100 that never made it to that particular point. We'll leave that there. Our time has run today. Neil Mora, he is Vice President of Trading at the Purple Group, talking those distinctions between traders, investors, and saving. And they're different, but I think that they all can fit within a sort of well-rounded, holistic, I suppose, in a sense, a sort of money part of your life. As Nolan said, though, it's behavior. That's also an important part of it. We'll leave it there. Nolan, really appreciate the time today.
Thank you, Simon.
Moneyweb Frequently Asked Questions, Part 3, the Moneyweb Insider Gold Premium Subscription.
Welcome to Part 3 of the Moneyweb FAQ series. I'm Ryk van die Kerk. We received the question, what are the benefits of an Insider Gold subscription virtually every day? The short answer is that a premium Insider Gold subscription unlocks a myriad of premium data tools to assist any individual to analyze and research the performance of JSE-listed shares, unit trusts, ETFs, ETNs, commodities, exchange rates, and international indices. The historical performance of these instruments is available for up to 5 years, and the tools allow for the ranking of the indicators according to many predefined metrics. I want to highlight 2 unique and pretty cool tools. The comparison tool allows subscribers to compare the performance of multiple instruments over various periods. For example, a subscriber is able to compare the share price of a company such as Sasol with historic performances of the price of Brent crude oil, the Rand-dollar exchange rate, and the S&P 500 index, all on one graph. We also offer a dedicated page for each listed company and unit trust. They are the Click a Company and Click a Unit Trust pages. Each page contains detailed information on the historical price and financial performance of the instrument. Sign up today for just 630 Rand per year or 63 Rand per month and equip yourself to make better financial decisions. In the following video, I will highlight a few of the many other benefits of the Premium Insider Gold subscription. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels for more information.
Moneyweb, your trusted source for business and investment insights.
Our next guest is our first keynote speaker for the day, an investment specialist with a passion for teaching, and someone I've had the privilege of calling on to be able to educate our investment community at any time. I'd like to introduce to you Dr. Adrian Saville, an investment specialist at Genara Capital and a professor of economics, strategy, and finance at the Gordon Institute of Business Sciences, Gibbs.
Good morning. One of the famous quips or quotes in the world of investing goes that investing is simple but not easy. And what I'd like to explore in this keynote is some of the basic foundations, the key principles that underpin getting investing from not just simple but also to easy. And to kick off the discussion about the headwinds or the challenges that face us as investors, I think it's first worthwhile to square up to public enemy number one. And very often when we think about the things that challenge investment results, ideas, principles, arguments that spring to mind are attributes like volatility, tax, which currency do you achieve your returns in, And all of these matter, make no mistake, all of them are relevant and impactful, oftentimes in negative ways, on investment destinations or investment results. But the single greatest threat to investing is the risk of inflation. If we take the case of South African inflation, just as a talking point, I've got an illustration here of the cost of buying a South African favorite, Kentucky Fried Chicken. And if we rewind to the 1970s and we compare the price of buying a bucket of chicken from the 1970s to buying a bucket of chicken today, the differential is 30 or 40 times. What's happened to the key attribute of the product is essentially very little. In fact, Colonel Saunders assures us that is the exact same secret recipe that's so successful. And so what has happened over the course of these 40 years, it's not that chicken has become more expensive or that making this particular product has become harder or more challenging. It's that our currency buys less. And that is the public enemy number one. The next slide shows you the impact of this, the differential between the impact of tax rates on a terminal return and inflation. And just for the sake of an illustration, what I'm showing here is, imagine that you put 100 into an investment portfolio made up only of cash, and then you let that very stable, smooth asset class compound over 50 years from the late 1960s to now. What would you get? And the differential that you see in this chart is made up of three components. The first is the wonderful compound return that you will get, and then we disrupt that for the two negative impacts of tax and inflation. And overwhelmingly, it is inflation that eats the bulk of the return. And I think this is a fundamental point of departure in thinking about what really is the investment objective. Is it to beat the market? Or should it rather be to beat public enemy number one, this thing called inflation? To be flippant about this, the next slide shows you that there is no such thing as a person who has perfect immunity, and we can go to the dad jokes very quickly. So here you've got the cost of being Superman or Batman, the year of birth, somewhere in the 1930s, and the cost of being them today. And perhaps for Batman, it's much more expensive because there's all types of technological gadgetry that come along with being Batman. But for Superman, it's pretty much the same equipment, just the underwear's gone on the inside. But the cost of living has risen substantially. So it's the same things costing substantially more. And it's not that these things have become scarcer. The point again about inflation, it's that you need more money to buy the same stuff. That is the challenge of investing, the core challenge of investing on the back of these principles. So how then would you square up to this challenge? And there's some data here which suggests that the easy way to square up to inflation is just to worry about asset classes. And this often takes us to being equity-centric in building solutions. The evidence that you see here shows that one of the best ways to beat inflation over long periods of time is just to buy equities and to hold them. And if we then move this to a further illustration, this next illustration shows you that on balance, equities do deliver this very good result. The however, and always in the language of economics, finance, investment strategy, there is always a however. And the however is this wonderful long-run compound return comes at the cost of volatility. And that volatility can then make the appetite, the ability to pallet this long run that much harder. A great example of just how difficult this can be and how we get caught in the headlights of market fascination is shown by the return on the NASDAQ index. If we rewind to the late 1990s, there was a market fascination with NASDAQ, the suggestion being that the simplest way you would become powerfully successful in investing was to buy a single asset class, technology stocks, and own them forever. the most money that ever went into NASDAQ in a single month occurred at the market peak. And it's flagged on this chart. The most money that ever came out of NASDAQ happened almost at exactly the bottom, the market trough. We're told in investing that the key is to buy low and sell high. And you can see here that the behavioral attribute is to do the exact opposite, that what human behavior is doing is it's getting in the way of compounding. It's biasing decisions to do the exact wrong thing, and instead of buying low, sell high, to buy high and sell low. So there's a well-known cartoon from some years back where the proposal is put that we've met the enemy, and the enemy is us. And this then takes us back to that opening quote or quip that investing is simple but not easy. And so what's getting in the way of that ease of investing is our decisions, our behaviors. The point is well made by Morgan Housel, who shows in these two charts the biases or the biases of investors based on their decade of birth. And investors who are born in particular times tend to anchor on asset classes that have then gone on to do well in their early years of getting into the workforce, their first experiences with investing, their first pension fund experience, and so on. And so there's at least two big arguments here to then talk about what gets in the way of making this simple thing called investing difficult as opposed to easy. And the first is that we are hypersensitive to context. And the second is that our decisions and our direction is heavily influenced not only by that context, but by our human wiring. And one way of illustrating how impactful this human wiring can be is it doesn't matter how many times we look at this behavioral exercise. Some people will see the dress as white and gold, and other people will see the dress as blue and black. And we're about 50-50 on this. I'm in the white and gold camp, but there are people who are looking at this behavioral exercise and they are absolutely convinced, as much as I'm convinced that this is white and gold, you're convinced that this is blue and black. And so that's our wiring, and that's the context. So the owner of the famous quote, "Investing is simple but not easy," of course, is Warren Buffett, who needs absolutely no introduction. And if we take the powerful points of Buffett, that what gets in the way of investing is us being confused by context, that it is our behaviors and our decisions that are some of the biggest challenges, and that what we're really squaring up to is not beating the market, but beating public enemy number one, called inflation. How do we set about then laying the foundations for successful investing? And there's 5 principles that I'd like to put on the table in this presentation or in this address. The first is that the single most impactful influence, the single biggest determiner of your terminal investment return is time. There is absolutely nothing that is more powerful, more effective, more important than giving your investment portfolio time. If you had a wand to add one magic ingredient to your investment result, if you had the ability to add a magic ingredient to your investment result, the thing that you should ask for is time. Either to be able to live longer, longevity, or to get the keys to a time machine and go backwards so that you could start earlier. So if you're going to do one thing that's going to make your investment result better, start today. Do it today. That is the fundamental grounding principle. The second point is that fees matter. And it's not to say that what we should be doing is getting fees out of the equation to the fullest possible extent, and that the only thing that we should pursue is the lowest possible fee. But if we take equivalent investments and add fees, fees eat while we sleep. So there's a lovely piece of research here which I can show you from Morningstar. and it shows the success rates of investment portfolios across different mandates, from pure equity mandates, bond mandates, industry-specific mandates, multi-asset mandates. And the Manhattan skyline that you see here shows you the investment portfolios that have the greatest success through to those that have the lowest success. And the distinction as we go through each of these mandates from left to right is that the fees on the mandates is going higher. So the single biggest determinant of success in your investment mandate, based on this Morningstar research, multiple mandates, multiple years, is fees. That's a very powerful due diligence question to ask. The third thing that another piece of Morningstar research shows us is that one of the most effective ways to get investment results is not to try and beat the market, but to match the market. Bernard Baruch, in this lovely quote, tells us that if you want to be an expert in identifying market winners, that it is an incredibly challenging, intricate, complex task, and that we almost set ourselves up for failure given the incredible complexity of context, decision, the multiple moving parts, all of the intricate pieces of the investment machinery and equipment that you need to know. So if that is the case, then the argument can be made that rather than trying to beat the market, you might want to just match the market. And this is what we would call passive investing or index investing. And the next piece of evidence makes exactly this point, that the success rate across mandates is explained then by a combination of getting fees out and matching the market in. So you see here measured over long periods, 5 years, 10 years, 20 years, the number of active managers that beat their market. And I've spent a fair share of my investment career trying to build investment portfolios that beat the market. Make absolutely no mistake, it is an incredibly complex, extraordinarily difficult task. And so beating the market arguably sets us up for disproportionate failure. That doesn't mean we shouldn't try, but we must recognize if we are setting ourselves up in a portfolio that is made up only of things that are supposed to beat the market, we might be setting ourselves up for failure. The fourth critical foundation of successful investing is diversification. And this is the freest lunch. If there is a single free lunch in investing, it's diversity. And that diversification is about owning multiple asset classes, and asset classes don't just have the same thing with different names. So if you own Brazilian equities and Indian equities and South African equities, you actually aren't very diversified. Rather, you have a basket full of emerging market equities. Effective diversification means that you own things that actually look very, very different. They don't just carry different names, but they behave differently. So a diversified portfolio would own things like inflation-linked bonds, physical commodities, precious metals, emerging market equities, some private equity. That would be a fully diversified portfolio. And the next chart shows you some of the results that you can anticipate by way of effective diversification. The last point about ways in which we can lay an effective foundation in investing is to manage ourselves. And that rewinds all the way back to one of the opening arguments that we know who the enemy is, and the enemy is us. And how do we manage ourselves? Robert Shiller, the Yale University professor, says that one of the ways in which he's able to get into the market, hold a effectively diversified portfolio, not try and time the portfolio, is to own things that allow him the ability to exercise discretion, to get engaged with some of his fantastic business ideas, in inverted commas, to have fun in the investment market. And there's no way that I can hide this, shade this, disguise it. I'm absolutely fascinated with investment markets. 35 years of investing hasn't changed that fascination. I'm intrigued with understanding what drives investments, what causes decisions to be right versus those that are wrong, what makes for effective investment results. But how do you marry that with the discipline of getting in the market, getting asset classes right, and just leaving that thing alone to allow it to get on with compounding? So Robert Schiller gives us a clue. And he says, what if you allow yourself a small pocket of distraction, and you can invest all of your distracted time with that fascination? And his rule of thumb is an 80-20 principle. He says 80% of his investment portfolio is in the responsible, sensible things. 20% is given to his fantastic best ideas. Some of these really will be fantastic and brilliant. Some of them won't work out so well. But when you blend that 80-20, it's the 80 that's going to get you effectively to this safe terminal destination based on these 5 founding principles. So a closing set of ideas, what I think might be 2 really interesting investment ideas in this landscape. In a world of 6.5% inflation in South Africa, 7 and 8% inflation if you're in Europe or the US, rising interest rates, falling equity prices, volatile currencies. What about real estate as an asset class? This would seem to be an outrageous proposal because real estate doesn't like rising inflation. Real estate does not like sluggish growth. But here's a portfolio that is made up of thousands of tenants with 85% and more occupancy rates and rental increases with inflation plus uplift. And it's in the property portfolio called storage, which gives you a 7.8% dividend yield with this 85% occupancy rate. Half of the portfolio is now in hard currency, sterling, and the business has steadily grown dividend year after year since listing almost 10 years ago on the Johannesburg Stock Exchange. If we add in not just dividend yield, but also capital appreciation in a fairly choppy and difficult investment environment, storage gives you a 16% return over the past 12 months. And based on valuations plus yield, we suspect that there's a lot more to come from this niche real estate business. A second idea is to diversify away from yourself, to own things that aren't you. And an idea in our global portfolio is in the healthcare industry. So things that aren't investment finance or things that aren't a strategy professor is the healthcare industry. And some elegant attributes of the healthcare industry is you've got quite powerful structural drivers of healthcare in the advanced world, including an aging demographic, younger retirement ages, higher life expectancy, and growing incomes and strong balance sheets, so that people have the capacity to look after themselves in old age and retirement. Governments that are placing increased emphasis on healthcare and recognizing that about 80% of your lifetime healthcare will be spent in the last 3 years of your life. And so here are some ideas about diversification that are not just about owning different asset classes, but about owning things that aren't you, such as healthcare businesses and robotics businesses or equipment businesses in the healthcare arena. If we put all of this together as a closing set of ideas, 3 principal arguments. Public enemy number 1 is inflation. The enemy is us. And investing is simple but not easy. To make investing easy, if we can lay the foundation of these 5 basic principles, get in, stay in, get fees out, all else equal, diversification, own the market rather than trying to beat the market, and then manage ourselves by allowing ourselves the distraction in this simple 80-20 principle. For instance, we might have set the basis for beating that public enemy number 1 and the enemy that is ourselves. Thank you for your time. I hope that those ideas translate into very successful investment results.
Are you an amateur retail investor and want to become a better investor? If so, you should not miss the Moneyweb Be a Better Investor podcast. My name is Ryk van Niekerk, and every week I speak to the best professional investors, research analysts and traders about their personal investment portfolios. We talk about how they make investment decisions and hear what they regard as their best and worst investments ever. The idea is to find some golden nuggets from their perspectives and experiences to assist amateur investors in becoming better investors. Join me and my expert guests weekly on the Moneyweb Be a Better Investor podcast. Listen on moneyweb.co.za or the Moneyweb app.
The Moneyweb Be a Better Investor podcast. Show me the money. Moneyweb, your trusted source for business and investment insights.
Good morning again. It's 11 o'clock and now we will talk about tax and your investments. We have death and taxes. That is a reality for every one of us. And I think many people don't take into account the tax implications on investments. And other people, they just focus on tax. They want to pay the least amount of tax possible. And that also has a massive impact on the investment returns. Of course, many people just look at the gross return they receive and not the net return after they have paid the taxman. And in South Africa, it seems to be one of the most efficient government agencies. But to help me, Piet Nel, he's from SAICA, he's a tax expert, South African Institute for Chartered Accountants, and Louis van Vieren, he's from FISA, the Fiduciary Institute for South Africa, two absolute tax experts. Piet, I'm going to start with you. Let's just frame this discussion. How complex is the tax regime in South Africa, especially related to investments?
Right, I think the answer is it is quite complex. So it is not a simple thing. And maybe I can start by just sort of giving a framework and explain why I believe it is that complex. It is complex because your investment returns are not individually taxed. So in South Africa, we have that this is income, and it's treated together. So you have a pot, everything goes into the pot, and we calculate the tax on that. Other than dividends, where the dividends tax is levied on the dividend itself. So to just conceptually understand how we get to this tax, so we would take all our incomes, and that can be pension, salaries, interest, etc. The gross amount is to be declared to SARS and as a starting point of the calculation. Certain amounts may qualify for an exemption. So as interest, we've got nominal amounts that are exempt from that. So you deduct that from the gross amount. You're entitled to make some deductions. If you have a rental property, you've got rental income, you can take a deduction from that. You get that, and then you get to a net taxable income from this investment, but then collectively they're all added together. Then to that, you add your capital gains. So where you have disposed of assets, you will, on a similar basis, have a gross receipt on the disposal. You'll be entitled to make the cost of acquiring that asset, and the capital gain is the resultant. You add all of that together, you apply an inclusion rate to that, and then this whole pot goes into, and you levy the tax on that, which starts at 18% up to 45%.
Yeah, in a nutshell, that is complex, and I think very few individuals can navigate that.
Yeah.
Louis, in preparation for this session, you sent me a slide which summarizes the tax environment and what you need to take into account. Now, many people will say investments, capital gains tax, dividend tax, tax on your interest you receive. And, you know, if you can take care of those, you're fine, but it's not. The list you sent me, capital gains tax, income tax at the top of the list, then donations tax, the Pension Funds Act as an impact, the Child Care Act, the estate duty you need to pay, the MSS Act. I don't even know what MSS stands for.
Maintenance of Surviving Spouses.
Okay, and the Matrimonial Property Act, the Common Law and other acts, and then VAT at the end. So it is complex, as we've now established. But if you're an investor, when do you need to start worrying about the tax implications, and when do you go and see your tax expert for the first time?
Yeah. Well, Ryk, I'm actually an estate planner, so in my view, all financial planning starts with estate planning, because if you don't structure things correctly from the beginning, you run a serious risk of falling foul of things that you didn't even know of. The reason
How often does that happen? Just to interject.
Often. The reason I sent you that slide is 30 odd years ago, when I started for the first time becoming aware of the process of estate planning, it was very simple. You had a 1 million free from estate duty, plus everything that goes to the surviving spouse on death. So it was quite simple to manage an estate in a way that you pay as little as possible by the way of estate duty, etc. But then came VAT. And if you were a VAT vendor, or if you were supposed to be a VAT vendor but wasn't, and you die, then all of a sudden there were all kinds of complications. Then in 2001 came capital gains tax. And all of a sudden the things that we did to avoid estate duty previously didn't make sense anymore because of these other influences pulling in different directions. And then obviously what you have to remember is all your investments form part of your estate. And if you're a South African resident, it doesn't matter where those investments are, they form part of your estate. And they come into play for estate duty purposes. Then your marital regime, how you are married, may play a role in some of the factors that you have to take into consideration when planning your estate and looking out for ways to pay as little tax as possible. But the most important thing to my mind is you should never allow the tax tail to wag the planning dog. First, get your structures right, get your planning right, and to achieve what you want to do, what you want to achieve, and then start looking at how do you do that in the most tax efficient way. You can tie yourself in knots trying to save tax, and in the end pay a price, a different price in another place.
Opportunity cost.
Opportunity costs, the way that things aren't practically structured. If you just focus on tax. Sometimes tax is the price you pay to get what you want.
Now, in theory at least, the more tax you pay, the more revenue or income you've received.
Yeah.
And that's maybe one way to look at it. Pete, just where do you start? Do you start with your financial advisor, or isn't a financial advisor equipped, or the average financial advisor equipped to also handle the tax side of the investment portfolio and plan?
The financial advisors, to my recollection, is actually equipped. They have part of, when they write that entrance exam of theirs, they actually are examined on the tax matters as well. But I think you would probably start with your financial advisor, but I think this is a team's effort. So clearly, I'm a pure tax specialist, so I will not be able to give you any advice on structuring your, I will just tell you the tax consequences of that. So I would imagine that if the financial advisor, and if you're going into complex structures, then you must have a tax specialist as part of the team. So in all your estate duty plans, you cannot go into that without a tax advisor. Yeah.
Let's talk about a practical example. Let's take a practical example. Say somebody has a pretty significant share portfolio, equity portfolio, diversified, not across geographies, not only in South Africa, but offshore. What are the main elements that individual needs to take into account? My immediate thought is capital gains tax, and make sure you don't trade too often to trigger a trading type of consequence, to let income be taxed at your income tax rate. What do you need to take into account?
Yeah, so do you want me to start? Yeah, okay. So you now have a person that has an existing portfolio, so you're not starting out afresh. So, and it's easy in his or her own personal name. So the things that you will take into account, of course, is the income that flows from this, the dividends income, or whatever income accrues on those shares. It would typically be dividends or foreign dividends, and the tax consequences of that. But then, absolutely right, you have to constantly monitor your portfolio to see that you are in shares that are still growing. And the moment that you change those portfolios, and this is what one must, those shares in your portfolio that you must take into account, it will have a capital gain. It will have a capital gain consequence. There's also transaction taxes. I mean, there's a securities transfer tax on the acquisition and purchase of shares, and most often it's required from the person in whose name it is. But sometimes you'll have to pay that. So there's cost involved in doing that, and so to reposition your investment will have capital gain consequences. And then that question about the regularity of the trading. So the principle in South Africa is the distinction between income and capital, which is taxed differently at lower rates, is that income is something that is derived from business activities. Investment activities per se would not be business activities, because business is you buy and sell things. So a person like, for instance, you wonder, and I'll take that now, but to the people that are doing arbitrage now in the Bitcoin or the cryptocurrency space, they're unlikely to be able to prove that they are an investor there. But a person that has a long-term commitment and immediately, looking at your portfolio and getting rid of shares that you don't want and buying better shares, will generally be able to, and even where they do that before the expiry of the 3-year period, which is an automatic capital intention on that, will normally be able to prove that they didn't have that speculative intent, and that the income is then subject to capital gains.
The rule of thumb is within 3 years.
Within 3 years. On shares, we've got the rule of thumb. It's legislated that SARS will, even if you have acquired a share I have this example of I bought a share and it's never come back to the place I paid for it. So, and I speculatively bought it, and now after 3 years it's capital. So that is the rule of thumb. It's 3 years, so then we don't dispute that it is a capital transaction.
But after 2 years and 364 days, there's not a grey area where you can sell a share and not pay capital gains and it's not being regarded as income.
Yeah. So, but you know that is important. A lot of people are saying, we've got this in the capital gain space. You've got a part of your capital gain that's not taxed. So you have growth in a share, and you've got a 40,000 of your gain. That's nominal, but it may be, but just to make that principle. So they are selling before year end and maybe before their 3-year end to take account of a loss, so that I can set that loss off against my other income and not let it run over to the next period. And then if I want to share, then I buy it back, but I've now get the tax benefit of that. So there is, you can play that game. And there's some anti-avoidance rules there, but it generally is a good, you can do that. Yeah.
Play a game in a long-term investment portfolio. Viewers are welcome to send in questions. The email address events@moneyweb.co.za, or just type into the chat box on the YouTube channel. I see there are several questions that are coming through. So please keep those questions coming.
Can I just add on something on what Piet said is from a structuring point, from a planning point, what you have to be very careful of is if you start investing offshore, is to understand what the legal regime is with regard to succession in that jurisdiction. I'll give you an example. A lot of South Africans moved wealth off to Mauritius over the last number of years. Mauritius has French law, which has forced heirship rules, which means forced heirship rules, which means
not only with respect to the house.
Yeah, which means that you cannot bequeath as you please, as we can do in South Africa in your will. You are forced to leave a certain portion to your spouse and to your children. So it's important to, before you start investing in a jurisdiction, to understand the law of succession rules in that jurisdiction, because it may be appropriate to not then invest in that jurisdiction in your own name, but to set up a structure through which you place your investment.
That's my next question, where, when do you start to structure your portfolio from having investments in your own name to looking at trusts, looking at companies? Is there a rule of thumb?
Any structure costs money. So the rule of thumb would be if your investment is not big enough to justify that cost, then the default would be invest in your own name. Except if you're in a jurisdiction where you don't want to be in your own name because of forced heirship rules, law of succession rules that apply to that specific jurisdiction. Just to come back to those rules, large parts of Europe has the same thing, the same rules. For instance, you shouldn't really, in France, you shouldn't buy fixed property in your own name because it will be subject to the forced heirship rules. There is a way out to an extent in that the Hague Convention on succession in Europe allows you to choose the law that you want to apply to your estate. So again, it's very complex, and you should get advice as soon as possible before you start doing anything in a jurisdiction other than South Africa.
So if you buy a property in Mauritius or in France, do you do it in a South African company or through a South African company, or do you need to register a company in those jurisdictions?
I'm not an expert on French law or Mauritius law, but I would think you should get advice on that before you do anything of that kind. Get an expert in that jurisdiction who can advise you and assist you.
But I think the key point is it's expensive relative to the size of your portfolio. So if you have a massive 100 million plus portfolio, that's the way to go. But if you have 1, 2, 3, 4 million, it's still good to do it in your own name, and the tax implications won't exceed the admin cost of those structures.
I think the other thing with regard to death taxes, to estate duty as we call it in South Africa, or inheritance tax in the UK, is to be aware of the fact that there are double taxation agreements with some countries, and to also understand what that can do for you and how it can work in your favour. But the general rule is, if you're a South African resident, everything you own, doesn't matter where it is, falls into your estate for estate duty, with a couple of exceptions. But we don't need to go into the technicalities of that.
Yeah, and I can appreciate it. To start early with estate planning forms part of your investment plan.
Yes.
For example, if you have fixed property, to transfer a property from your own name into a trust, that is very, very expensive, and there's a lot of taxes to be paid in that process. But let's talk about trusts quickly as a vehicle for to not avoid tax, but to as a tax structuring mechanism. How relevant is it? Has SARS plugged all the holes?
I'll start, and then we'll give the trust specialist an opportunity to do that. Ryk, I think that, and this question was asked to me once when I presented to the Standing Committee on Finance, when Section 7 Cap C was introduced. There definitely still is a need for a trust. I am personally in favour of. I would always use that. It would be part of my plan. My general structure would be have the trust and a company underneath that. The trust, and in fact, we need, and we're lobbying to get some of the law amended there. It is paying tax at 45%, capital gains inclusion at 80%. So it is, from a tax point of view, a really expensive vehicle. But the ability to, on that conduit principle, which is now codified into law, the ability to transfer the income that accrues to the trust to the beneficiaries that may have lower tax rates sort of addresses that problems that we've had in the past. But we've had the discussion before. It still is part of the structure. Any estate plan. In the past, I used to say if you're looking at a person that's got an estate of about 7 million plus, you would start considering the trust because of the cost that Louis had said. But then if I have a client that starts out a business and you've got this phenomenal good idea, I would earlier rather than later then bring it into a trust structure. If I have that existing portfolio, which I have with me, then it's costly to transfer it into the trust and things like that. But when I start out with something that potentially will grow phenomenally, and I mean, I've got an example of a person that sorted out initial capital that funded the company through the trust with some R1,000. It now sits at a billion rand worth. Now that is completely outside of your estate. So there it makes sense, and the cost up front was nominal compared to the benefit we had from that. But Louis, I'd rather hear your voice.
Ryk, I did a bit of modelling recently on Section 7 capital C of the Income Tax Act, which deems interest foregone on a loan to a trust or to a company where a trust holds the shares in that company. That interest foregone on an interest-free loan is deemed a donation every year on the last day of the tax year, and is then subject to donations tax. And as Pete said, if you have a phenomenal business idea and you expect exponential growth in a new business, then it still makes sense to use the old structure of you make a loan to the trust channels that loan into the startup business, but the trust holds all the shares in the company. The modelling I did is on a loan of 50 million. well, I did it from 1 million to 50 million, but it boils down to an estate duty saving over 20 years of in the region of 8 million on the basis of our current official interest rate, and with a growth rate of only 5.5% per annum on the value of that business. Now, the higher that growth rate in the business is, the more it makes sense to use such a structure, to get that huge value out of your estate for estate duty purposes. What one has to be careful of, and what you have to take expert advice on before you start something like this, is because those shares are held in the trust and those shares increase in value, you will have a capital gains tax implication in that trust. But as Piet said, there is the conduit principle available in trusts where you can attribute a capital gain to a beneficiary who then gets taxed in his or her own hands on that capital gain. It's not a panacea for everything, but it is available, and in certain circumstances it may make sense.
Would that be a better option than to say to create a company to hold all the investments? Is that a better option, or how does it compare to a trust?
Yeah, you have to be careful. I think what you have to understand about a company is that you can get money out of a company in two ways. You can either draw a salary from the company if you are employed by that company, or the company has to declare a profit, pay corporate tax,
and dividend tax,
pay dividend withholding tax to get the value or the income out of the company. So that question is a question that can only be answered by looking at the specific circumstances, to my mind, by a tax expert, working with a structuring expert.
Maybe if I can, and that will probably answer, because I don't think everybody would know what Section 7C is. So it's tax related, and that doesn't make it, incomprehensible. But the principle we have here in tax planning, and this is why you've been asking this question and why you want to put it in a trust or a company, and then we can answer which one is the better, is I'm now starting out in this investment scheme. I'm a young person, I'm starting investing, and my portfolio grows. What happens when I die is that you started with death and taxes. There's SARS's last chance to take its taxes. So it's, colloquially speaking, it comes from Benjamin Franklin as well, though he made it in the context of the Constitution then. So we are saying, I've built up this investment over time, and when I die, I have a capital gain and an estate duty. So what we want to do is to address that capital gain, because that has a liability that is brought against the estate at death, and the estate duty. So we transfer this growth asset at its current market value to the trust or the company, but let's just say, so we transfer it, we get it out of our own name. Now, we always say that I say that donations tax and estate duty is, donations tax is just estate duty paid up front. So if you want to get rid of an asset, you donate it. Then you pay your 20%, and then you've got no problem at the end. But we don't want to pay that tax, so we transfer it on loan account, and this is where your 7C comes in. So we transfer the asset, now it grows. So let's say I had an asset that's worth R1 million now. I transfer it on loan account to the trust. 30 years later, when I die, it's worth R20 million. Then the only asset in my estate is this loan account. And I'm taxed at that, so I pay 200,000 tax, whereas I should have paid 20 million rand worth of tax. Now, if I do that same, well, by having done that, the asset and everything happens in the trust. If I transfer it to a company, either in return of shares or by way of a loan account, but I would generally do that and take the shares in the company, because I can do that, it's a tax-free transfer. Then all I've done is replaced my growth asset with shares which essentially have that growth asset. So it remains in my name, that growth is taxed in my name, and ultimately, when I die, that is the value that will be included. So you understand the difference there.
Yeah, that's complicated, and I
Complicated.
think it will differ from individual to individual. Circumstances will also dictate exactly how you approach it. Interesting question here regarding offshore investments. Is the tax payable on investments owned directly offshore? That means you open an account at BlackRock, for example, you have investments there and you get returns. Is that taxed differently to the investments in local feeder funds, which have exposure to the same international assets?
Yeah.
So if you're international, if you put your money in offshore, you take it out of South Africa, is that income taxed differently to while you keep it in South Africa?
So is the feeder fund similar to collective investment schemes?
So collective investment schemes, and you just invest in rands, and then the asset manager invests.
It's rand denominated.
It's rand denominated.
Yeah. Then it's not much different. There's a difference in the tax on a dividend. A dividend is a dividend declared by a South African resident company and paid to the investor, and a foreign dividend. So, but essentially they come down to the same tax percentage. So no, there's no difference in those. It's also, in a collective investment scheme, you are not affected as the participation holder in movements if they buy and sell shares. It's only when you exit that you will then calculate a capital gain on the difference between what you've paid for it and what you've earned. But the income substantially taxed the same as South African funds. Yeah.
If you have your money offshore, would you be say you're invested in the United States, would you be taxed in the United States?
So yes, and this is where Louis had referred to the double taxation treaty. So the moment you've got this, so in tax we talk about you've got a South African resident, or you've got a resident of one country for tax purposes, and then you've got income in another company, so in another country. So you've got this cross-border transaction. Then both countries will generally have a right to tax, but the double taxation treaties will, America, I can't offhand recall that, but I think it's like that. You will often have a sole taxing right, or you will have a limited taxing right. So our dividends tax is at 20%. If I invest in, let's say, the Netherlands, and I have more than 25%, 10% interest in that company there, then the withholding tax in the Netherlands is 10%, and South Africa will tax me on the balance. So there's a dual tax. So it becomes very complex, and it applies to interest and royalties as well. So,
And this following question links to, is also relevant. Does U.S. estate law apply to my New York Stock Exchange stocks and ETFs that I buy on Easy Equities, which is a local investment platform?
I'm not an expert on U.S. law, but the same would apply if you're a South African resident. That would form part of your estate in South Africa for estate duty purposes. But whatever is taxed in the US will then be regarded as a credit in your South African estate duty liability on death. Whatever you have to pay there, and I don't know, I'm not an expert on American inheritance taxes and so on, but whatever is paid there will rank as a credit for your estate duty liability in South Africa.
But there will definitely be a double tax, particularly with the shares. And there's a lot of South Africans that are now structuring exactly for that for the last couple of years. They call it a CITES tax. So it's where it is situated that they have the right to tax that.
How complicated is that administration process? Do you need now to submit the return to the US government as well as the South African?
So yeah, it becomes really complex. The moment... And I think that is why it's one of the benefits of using a trust or a company to make your foreign investments, because of that admin. It's exactly that.
Yeah, that can be
the complexity depends on the jurisdiction. In some jurisdictions, upon death, in some jurisdictions you will find it hard to deal with those assets without an executor in that country or an agent of a South African executor acting in that country. And the paperwork to, for instance, sell fixed property in the UK in a South African deceased estate with only a South African will can be quite cumbersome.
Yeah, I think that's a discussion for a different day. But yes, every jurisdiction you need to ensure that you have a will, because it's not always compatible. I want to talk about cash flow, because many people invest heavily in equities. I see cash as not being one of the optimal asset classes, especially when you include long-term, you have a long-term strategy. But upon death, or maybe some emergency hits, you need to liquidate assets, or for example, when somebody dies, you don't want to sell an asset to pay tax, especially a home and the like. How good are South Africans in planning cash flow for such an unforeseen event?
Terribly poor. Anything between a third and a half of all South African estates of any deceased estates of any value has a liquidity shortage of some magnitude. It's one of those things that it's probably the most important contributor, apart from Master's Office service levels. It's the most important contributor to delaying the administration process of a deceased estate, is if there is insufficient cash. On the other hand, you don't want too much cash in the estate. If things like life insurance and so on can pay outside the estate, because then you save on executors' fees, but don't overdo it, because that saving could very quickly disappear due to the delays if there's insufficient cash in the estate. So it's very important to ensure that there is sufficient cash.
Yeah, there are also other, especially with capital gains tax, you can be liable for a capital gains tax without actually receiving cash proceeds from an investment. And for example, if you have a fixed deposit that only pays out in year 5, you will have a interest liability every year up until year 5, and you will need to finance that with cash from other sources.
Correct, yeah. So I think a lot of people, investors, and we just take when was ABN InDev and your process transaction. So you have this, you're not actually exiting the company, but you're exchanging one share for another share. So we would think as an investor, but I haven't received anything. I didn't actually sell my asset. I just rolled it over into a new investment. But yes, it is a disposal, and your capital gain was realized up until that date, and you've got a capital gain transaction. So there are many instances like that where you have a reinvestment, and that reinvestment, so all your restructuring of the portfolio, as I've said, has a capital gain consequence, and a lot of people miss that. And I've seen that where people are in collective investment schemes, we're just advised to move from the one managed fund to the other, and then at the end of the year, because SARS now receives these reporting from them as third parties, you just get, an uncle of mine, he just got a 400,000 tax bill, and I said, where does this come from? I said, well, you made a capital gain. And he said, but I didn't take money out. So that's exactly that. And we also have this, when you capitalize income, so when you go into your collective investment schemes, your interest and dividends are capitalized into that scheme. You haven't received that, but you're still paying tax on that income. So the same principle.
How lenient is SARS when somebody really has a cash flow problem and it comes from a lack of planning, or is it, listen, pay up all?
And unfortunately, they've got a constitutional court behind them. They have this task to collect money. So in my experience, they're not very lenient. Let's not go into the tax administration side of things, but particularly in the States, you've got, and this is why the planning is so essential there. You've got this capital gains, and as Louis had said, which we didn't have, 20 years. Capital gains is now with us since 1 October 2001. We didn't have that. Now you've got a deemed disposal where there's no actual cash realized from the deceased to his estate. And you must pay that capital gains and then the estate duty. And they have no leniency on that. In fact, you must pay the state duty within 12 months. Otherwise, they start turning interest on that.
The other sneaky thing about capital gains tax at death is that if you're a sole proprietor of a business or a farmer, then your stock in trade is basically deemed income or immediately. And that has a potential.
What do you mean by that?
Your livestock as
your
a farmer?
livestock as a farmer. There's an immediate cash drain on the deceased estate. If you have an investment portfolio that does not go to the surviving spouse, the capital gain between your base cost and the value at date of death will trigger capital gains tax, which will then cause an additional extra drain on the cash resources in the estate. So what you don't want to do is you don't want to be in a position to start selling your investments, or you don't want to put your executor in the position, you won't be there, but you don't want to put your executor in the position where he or she will have to start selling your investments to pay capital gains tax, because selling those investments might trigger a further capital gains tax, because your deceased estate is a separate taxpayer, and any increase in value between date of death and date of sale will cause a further capital gain in the estate.
I'm feeling like I'm going to see my professional shortly after this session. There are a few questions regarding donations and, for example, owning a property with someone else. So you have a property and it's in two names. It happens when you can't afford the bond on your own. What are the implications there? Let's start with property where it's two people joint ownership, and there's a divorce, and the ownership then moves to one party.
I can start with that. So the joint ownership, and it's particularly prevalent in your marriages or in your permanent relationships, which you are treated as spouses. Any transfer of ownership or full ownership between spouses on a divorce is tax neutral from an estate duty point of view, from a normal tax point of view. So there's no capital gain, and also from a transfer duty point of view. But that's only where we have spouses. So when you jointly own, you actually have a partnership with regard to the property. And there are some disputes about, people often say, but I share 60-40 or because I pay the bond and you just pay this. But generally that must be by agreement. So when you jointly own property, you must understand that this is a partnership. The income accrues to the partners jointly. The expenses are incurred by them. They have the tax jointly, and the capital gain. When you exit the partnership, you're disposing of a part of your interest in that asset, and there will be capital gain on that, and then no rollover. So, but between spouses, we have this, so at death or on divorce, that we have a rollover of the capital gains there. But you asked the donations tax. I don't know, was that?
You shouldn't buy a property a couple shouldn't buy property in both their names for romantic reasons. You need to make sure that the tax benefits.
It depends on which spouse you ask that question. But I would tend to agree with you. But this is what it's so complicated with the maintenance of surviving spouse, but also your Section 7. So you're in divorce, there's a maintenance obligation also that passes over that is created on divorce. So and then it helps if the house is then in both spouses. So if you're married in community property, you have this partnership from day one and jointly own the property.
Let's talk about donations tax. How does it work?
Donations tax is basically you pay 20% tax on the donation that exceeds 100,000 Rand per taxpayer per annum. So you can donate up to 100,000 free from donations tax every tax year. after that,
to one individual or to all individuals?
to all individuals. Yeah, it's per taxpayer. There's 100,000.
Yeah, cumulative 100,000.
And after that, you pay 20% on the value of the donation on date of donation. The value on the date of donation.
And the beneficiary, does the beneficiary pay tax on the income? Or no?
Well, SARS can collect it from the beneficiary if the donor does not pay the tax within, the end of the month that follows on the month in which the donation was made.
30 days after the effective date of the donation. But it's not only 20%, Louis. So if you donate more than 30 million rand of cumulatively,
yes, of
then we go into the 25%. So it's similar to a state duty. State duty up to 30 million rand, 20%, and thereafter you've got a 25% rate of tax.
So I saw somebody the other day asking whether it wouldn't be a good idea to donate everything before you die. The problem is you don't know when you're going to die, or most people don't. There
need to ask it back.
There are two ways of actually dealing with something like that, and that is that you can donate where the rights to the donation vest in the beneficiary now, but will only become enforceable at death. But those donations are not subject to donations tax; they're subject to estate duty.
And in loans or donations to spouses, is that treated differently?
You can donate as much as you like to your spouse without any tax implications.
Yeah, so similar to what we said on the property. But if you're married under the accrual system, there's a little bit of thing. But any donations between spouses is not subject to donations tax. But the loan, so what's the context of the loan? So one spouse make a loan. Yeah, you typically you would want the one spouse to purchase property, and the other spouse would then advance a loan, and then you may have interest or may not have interest. There's some tax avoidance there if you move income, but otherwise there's no problem with that.
If you move income to a spouse,
with a lower tax rate, then it effectively will bring that income back to the spouse. That is the higher tax rate job.
A lot of questions on foreign assets and revenue, especially property for interest. Do South Africans understand exactly the tax regime in other countries before they make the decisions? Because you get a lot of the adverts on Moneyweb and on other sites, and where they say, listen, go buy a property, you can get a golden visa, it's only going to cost you 5 million rand, but those type of transactions and decisions also have significant tax implications.
And I think that the quick answer is I don't think many South Africans understand that. And my experiences of South Africa, there's Africans that have now immigrated and live abroad and still retain property in South Africa. This is your one example where if I own property in London or wherever in the world, I will have to submit a tax return. So that's a trade income there. I'll have my rental income. I'll have to declare it. That country has the right to tax that capital gain. South Africa has a capital gain. So there's a dual taxing right in that properties. So that rental income is declared in both countries. And in the resident country, so South African resident will get a foreign tax credit, as Louis alluded to previously, will get a foreign tax credit for the foreign taxes. So yeah.
Interesting question from Andre. If I want to buy a property for my child, is it better to register it in my name or in the child's name?
Well, if you register it in your name, it's not the child's property. We have property in South Africa. We have a very good property registration system in South Africa. So the registered owner on the title deed is the owner of the property, and nobody else has any claim.
But that's the legal perspective. But what about a family? You can't. There's a lifelong bond between you and a child. From a tax perspective, is it better or not?
But so maybe let's start first with the donations tax. And I'm sure Louis is burning to make that same comment. The moment I register that property in my child's name, then I don't own that. So I've now used, let's say I take a 2 million rand and buy a house for 2 million rand. Effectively, my estate is poorer by the 2 million rand. I've donated that. So buying it in his name or her name is a donation.
Yeah.
You achieve that, but that's a cost. Yeah.
Yeah, there is obviously a way to get around that donation, and that is Section 7 capital C that Piet referred to earlier only applies to trusts and companies where a trust holds the shares and the lender is a connected person with regard to that trust or that company. But you can extend a loan, an interest-free loan to your child, and buy the property in the child's name, and then donate 100,000 rand a year away towards that loan and reduce the loan that way, because a loan between individuals where there is no trust involved does not trigger that deemed donation under Section 7 capital C, because in our law interest is not assumed. Interest has to be stipulated in an agreement, otherwise there is no interest.
We've got 5 minutes left. Retirement annuities, you get a big tax benefit if you contribute towards a retirement annuity. Another mechanism in the investment world is tax-free savings accounts, where you also do save on a lot of the taxes that are applicable if you compared to investing it through other means. What are your views on retirement annuities, just from a tax perspective? Is it worth it?
If I may start, I think it definitely is worth it, and there's the two reasons. The first one is, as you've already alluded to, is that we have the ability to deduct against our other income our contributions into the retirement annuity. So effectively, revenue authorities are paying part of your contribution by giving you tax back on that. So if you contribute to the tax-free investment, you don't get a deduction for that. It just have tax-free. But then the additional reason for that is that your retirement annuities, and let's just talk about your retirement funds itself. Any growth, any dividends that accrues to that, any capital gains made in that is not taxed. Whereas if you had directly invested into the similar products for your retirement age, you would have throughout your life paid that. And then there's no capital gains at the end. There's only a gain where you exit from the fund, which you are limited to take 1/3 of that, or on death you can maybe take more of that. But that's the beauty, and that's for me the biggest advantage of a retirement annuity, is that flexibility I have to convert that retirement annuity for the nominees, which will nominees in the context of the retirement funds, your beneficiaries. They can make certain tax-free elections. I can transfer that to the surviving spouse's retirement annuity fund without any tax consequences. So not only during the course of it, this upfront deduction, no tax on the growth, also benefits at the end. So for me, that's the top class investment.
Obviously, where SARS gets its due is when you retire from such a fund, then you have to buy a pension, an annuity with at least 2/3 of that, and that annuity will be fully taxable in your hands. But getting back to the tax-free investment, I think what you also have to be careful of is not to go into a tax-free investment, especially an interest-bearing tax-free investment. Do not go in there until you've used up your interest exemption on ordinary cash investments. So it doesn't make sense, because then you lose that exemption. So first make sure.
What is that exemption? 44,000?
23,800 and 34,500 for people over 65. Yeah. So this is absolutely critical. A very good way to think about this. So when I decide to go into tax-free investment, and I don't have, what are we looking at, 600,000 now, roughly, that will give interest at the rate that we were looking at it now, which will be tax-free. So if I have cash of less than 600,000 Rand, then I will not go into a tax-free investment in a cash one. I will go into a share investment, because the dividends then becomes tax-free. Where if I directly own that dividend, I will pay 20% tax on the dividend. So, and then your accumulative growth is net of the 20% tax, where in my own name it would not be. Yeah. So, yeah.
The only negative, I think, of the tax-free savings account is it's capped, and the annual contributions, I think it's limited at 36,000.
Yeah, so 36,000 with an overall 500,000 limit, so which we're still far away from. But yeah, no, and it should not be capped. I agree.
And it's a once and for all cap that you can't, when you withdraw, then you don't get that back that you've withdrawn. It's that 500,000 is whatever
I think
you've contributed. Once you reach the 500,000, that's it.
Yeah, I think it's a no-brainer to use a tax-free savings account. Obviously, the amounts are capped, but you do get a real benefit, and the long-term benefits can be absolutely fantastic. Just lastly, and we have a minute left, it seems very complicated. And I see you've got a textbook here next to you with notes. It says,
so this is all the tax legislation. So yeah,
it is really complicated. If you are starting to build a wealth portfolio, whether it's within a retirement annuity, whether it's discretionary capital, it is important to take the tax implications into account. Many people phone me and say, listen, I've got a fixed deposit. Should I earn 8% or 7.5%? You need to take into account what the tax impact will be, because in many ways, if you subtract the tax, the real income will be a lot less than inflation, and not a lot of people, or not too many people, actually take that into account.
And you become poor by saving.
Yeah. Anyway, I bring us back to the point at the beginning, the more tax you pay, the more you've earned, and just make sure that you pay what you need to pay and not more. But Louis, Piet, thank you so much for your participation today. I think it was an excellent discussion, and I think many people will think, whoa, I need to go and see a tax professional. Thank you very much. This is the end of this session. Stay tuned, we have got a lot more to come.
Moneyweb Frequently Asked Questions, Part 4, the Moneyweb Insider Gold Premium Subscription.
Welcome to Part 4 of the Moneyweb FAQ series. I'm Ryk van die Kerk, and today I'll highlight a few other valuable tools to answer the question, what are the benefits of an Insider Gold subscription? Whether you are a novice investor or a money-savvy professional, a premium subscription offers several tools to keep subscribers informed of all the daily developments and announcements related to listed entities. One of the most popular tools is our live SENS service. With a few clicks, you can access the latest SENS announcements as and when they are released. As you may know, traditional SENS announcements are notoriously challenging to read. However, you can access PDF versions of all SENS announcements, making them easy to read and to save. Subscribers can also elect to receive notifications when companies they follow release new SENS announcements. And exclusive to Insider Gold users, we offer a portfolio tool where subscribers can create their own share and unit trust portfolios to monitor their performances on one screen. Go to moneyweb.co.za and click on Sign Up and choose the monthly or yearly Insider Gold subscription options available.
Moneyweb, your trusted source for business and investment insights.
Earlier this morning, we had a fascinating discussion about foreign investments, and I think a lot of people would have realized that foreign investments should be a key part of any investment portfolio. But foreign investments, you need to structure those investments properly, because there are different ways to do it, and there are benefits and negativities attached to each of those options. So today we're going to just ventilate and discuss the options you have if you want to invest offshore, and to make sure that the benefits outweigh the negatives. Nadi Token is with me. He's an absolute expert at SEI. Thank you so much for joining me. We just had a tax discussion which I thought was very, very complicated. But how complicated is it for a normal person to say want to build a discretionary portfolio and allocate a significant portion to offshore investments? How difficult is or complex is that environment and those options that you have?
Yeah, so thanks for having me, Rick. So as you mentioned, I mean, I think it's critical that all investors in South Africa have a fair amount of their portfolio invested internationally, and I'm sure you've unpacked this in previous sessions, but the reality is that it has nothing to do with your faith in South Africa. It has nothing to do with where the rand is going. It just has to do with the sheer size of the opportunity set that's available globally relative to locally. So I think it doesn't matter how small your investment is. It doesn't matter how large your investment is. I think it's critical to be able to access offshore investments. And I think what's happened over the last couple of years, as National Treasury and the Reserve Bank has been gradually relaxing, the kind of limitations that there is to investing offshore, I think it has become a lot more accessible even to the smallest of investors. So if you think about, the investment list platforms, and a lot of them are very competitive now on their pricing because they're trying to capture the mass market or the mass retail market, if you will. So now investors can allocate to offshore markets without even using any of their own foreign allowance. They can buy, in essence, a piece of the foreign allowance of a number of service providers, whether that be a stockbroker, whether that be a list platform, and allocate to an offshore fund directly. And then, of course, there are also rand feeder funds, which is essentially giving you exposure to exactly the same offshore investment with you just investing in rands. And I guess the only challenge with a rand feeder fund is that when you disinvest from that portfolio, you're going to be redeemed and paid back in rand. So that money can't be paid into an offshore bank account. But certainly over the last couple of years, through list platforms, through feeder funds, through brokers, allowing, individual investors to use part of their offshore allowance to take cash offshore, it certainly has become a lot more accessible, and there are a lot more options available to retail investors to take money offshore.
Yeah. Just on the feeder funds, yes, you get paid out in rands, but you do get the exchange rate benefit. So if you want to take it out again, it is you won't lose that much.
Sorry, I should have probably been a bit more clear about that. You do absolutely get the exchange rate movement, because essentially what happens is that the management company whose rand feeder fund you invest in, they essentially take the cash offshore for you and then essentially use that cash to go and buy shares internationally. So, you're going and buying Apple and JP Morgan and ExxonMobil and whatever the case might be. And obviously, you invested in rand, so it's fluctuating with both what the rand-dollar exchange rate does as well as what the share price does. So you're fully exposed to the rand hedge, is I guess what you're saying. Yeah.
Viewers are welcome to send questions, events@moneyweb.co.za. Email those questions through, or just type them into the chat box on the YouTube channel. I just want to discuss the need and the how do you evaluate the options and what you need to take into account. Why would you move money offshore into dollars or euros or pounds and invest from an offshore vehicle as opposed to keeping it in South Africa and investing through feeder funds or through ETFs, which are listed on the JSE, which have got a lot of international exposure? What do you need to take into account to make the optimal decision?
Okay, so I think what you need to take into account to make the optimal decisions, also realizing that a lot of the companies that have rand feeder funds are obviously a minute subset of the opportunity set that is available to invest globally. So if you have a substantial amount of capital to invest globally, and you kind of you want to, it depends ultimately what you want to do with that. But so if you are planning on eventually emigrating and having access to that capital outside of South Africa, then I guess a rand feeder becomes a whole lot less attractive as an investment option. If you are planning to just get exposure to some shares internationally, then that's when the rand feeders come into account. However, what you do have to consider is that you are limited to the providers that offer you a rand feeder option available to you. The world of investing globally obviously seems very daunting. There's thousands of asset managers globally. There's thousands of different strategies globally. How do you know that you are ultimately exposed to the correct strategy? And I think, the more complicated your needs become, the more complicated your designing your investment strategy becomes, I think the more kind of bespoke you have to be in the way you go about that. And what I mean by bespoke is saying, okay, well, the ETFs available to me on the JSE are not sophisticated enough. They don't offer the kind of diversification benefits I'm looking for. They don't offer the kind of global investment insights I'm after. And, as a result of that, my pool of capital that I have, being larger than the average retail investor, I potentially can have access to more tailored solutions globally, through the assistance of a wealth manager, through the assistance of a financial advisor. And then it becomes an option of, okay, I've got my money offshore and I've got this universe open to me, but there's so many thousands of funds out there in the universe. How on earth do I go by filtering these funds? And that's when you can go either a multi-manager route or a single manager route. If you do know of good global funds, a multi-manager route can tend to be quite effective, because essentially what you're doing is that you are saying, I am hiring specialists globally whose job day in and day out is to review all of these thousands of global investment strategies and come up with, call it, the best of the best to combine into a portfolio. And I can leverage off of that research with my pool of capital that I have available.
Yeah, that is a very key point. But your wealth manager needs to assist you to take the best possible decision. I think very few individuals can do that. And you sit in front of your wealth manager and you say, listen, what should I do? And then the manager would say, do A, B, and C. Yeah. How well do you think the average wealth manager in South Africa understands this environment and can advise you absolutely optimally?
Sure, Rick, you're really putting me on the spot here. So look, I think it's gotten a hell of a lot better over the last 10 years. And the reason for that is just because there's been this enormous drive to externalize capital out of South Africa, for whatever the reason might be. Lackluster economic growth, increased global opportunity set, better returns available offshore, well, up until the last 12 months, maybe better returns available offshore. So as that demand for global investing has skyrocketed, I think, the level of sophistication that wealth managers and financial advisors have in advising their clients has dramatically improved. I think maybe the one bias to be conscious of is that wealth managers, I think, would stick to brands that they know and brands that they understand. So they're traditionally going to stick to large South African brands with offshore capability. Whether that's the best offering or not, that remains up for debate. But, there are a number of offshore houses that now have a presence in South Africa, and are starting to build a brand for themselves in South Africa, and, they have excellent capability globally. So if I were to answer the question, I'd say better than it was 10 years ago. Although, I think that for the average South African investor, a multi-manager really is a compelling offering, because you are outsourcing that research of global manager selection to specialists.
But how do you, as a normal South African, approach a multi-manager? Is it a direct, or do you need to do it via a wealth manager, or can you actually go and sit in front of a multi-manager and say, listen, okay, I'm an individual, I've got a substantial amount of money, how do I invest it? Yeah. Shouldn't you work through a wealth manager?
Definitely through a wealth manager, right? So, the reality is that these large global multi-managers are probably not accessible to the average retail investor, but their wealth they are accessible to wealth managers, right? So, traditionally, the good financial advisors and wealth managers would know of the good multi-manager offerings that are out there. And a number of these multi-manager offerings do have, boots on the ground in multiple geographies, going and identifying these fund managers all over the world.
Now, just to explain the principle of a multi-manager, they are, call it asset managers, who analyze other unit trusts and collective investment schemes, not underlying companies or securities, and so you invest into the best possible funds as opposed to in the best possible companies. Company is very interesting. What are the typical mistakes investors make when they invest offshore, or they try or intend to invest offshore?
Yeah, I'd say the biggest mistakes there is that they wait for after the fact, because there's panic so there's a cabinet reshuffle. All of a sudden, Nhlanhla Nene is fired, and the rand goes to 18 rand to the dollar overnight, and that's when everybody wants to pile in and get their money out. That's often a mistake, because the currency is very volatile, and it retraces quite quickly off of these large standard deviations we see up or down. And I think traditionally, investors panic and want to take money out at the wrong time. I think that's one of the primary mistakes. I think the second mistake that investors make is that they try and compare global markets to local markets. So they say, well, the overall multiple of the MSCI world is 18 times forward earnings. On average, over the long term, it trades on 14 times earnings, so global markets are expensive. The reality is you're talking about 6,000 shares listed internationally. Yes, there are a handful of shares that are eye-wateringly expensive, but if you dig beneath the surface, there's a number of opportunities that still remain available. So beware of just looking at composite indices and making broad-stroke assumptions about where global markets are going. So I'd say those are
out of it. It's behavioral risks you have. Are there differences in yields from investing in, say, local feeder funds or exchange-traded funds versus moving money into foreign currency and investing from those platforms, probably into similar type of instruments?
Yeah. So I'd say that there wouldn't really be a big difference, but again, you're comparing a like-for-like vehicle, So if you've got a global fund that has a US dollar denominated version and a rand feeder version, typically your returns, your yield are going to be exactly the same in the vehicle over time. There's going to be no difference between them. But obviously, as we mentioned earlier in the discussion, the only limitation you have with the rand feeder funds is you're limited to the providers that have the rand feeder funds, which is obviously a very small subset of the entire global universe that's available.
Okay. Interesting question from Tando. Should I have a foreign will and appoint a foreign executor? That's obviously if you have money offshore invested in assets there, and again, that is a very, very important difference between the two, because if you have money offshore you've actually transferred it out of South Africa, you will need a will. If you keep it in South Africa and you invest in a feeder funds, you don't.
That's 100% right. So you've hit the nail on the head and answered the question.
But not many people take that into account.
That's right. So, and these are the important nuances to understand. And there's also this confusion around, well, if I'm in a rand feeder fund, all of a sudden my money is offshore. Yes, your returns are offshore and your investment opportunities are offshore, but your money in terms of its home is in South Africa still. So, that you don't require a foreign executor or a foreign will for anything that's in a rand-denominated vehicle. But in a dollar-denominated vehicle where you've externalized your money yourself, or you've externalized your money through a list platform or through a broker that offers you a part of their foreign allowance, as we mentioned earlier, again, there your money is externalized, and there you will need a foreign executor and a foreign will.
Do you know where the term feeder fund comes from? Because it's not a very sexy name for a pretty important investment vehicle in South Africa.
I have no idea where it comes from.
Maybe absolutely it feeds through, but maybe the industry can look at that and get a better name. Let's see here. What about risks related to the exchange rate? And I think a lot of people look at foreign investments, and one of the primary reasons they want to invest offshore is they want to hedge themselves against a rand devaluation, which always seems to be imminent. How should people think about the exchange rate when they decide, and not only on whether to invest, but also which vehicle to use?
Yeah, so Rick, this is a question we typically find very difficult to answer. And the reason is that the exchange rate in and of itself is a very emotive thing in South Africa. You know, we're one of the few countries in the world where the average person knows what your exchange rate is versus the US dollar. It's continuously quoted. We are a very liquid emerging market currency. And I think the reality is that it's probably the most emotive part of investing offshore, is that people say, I just want to get my money out of rands. And because it's the most emotive part, I think, traditional or investment professionals are probably try and stay the furthest away from that debate. So the advice we'd give is that, South Africa is less than 0.5% of the global economy. That is your starting point. Forget about the rand, forget about what the politics of our country are. South Africa is 0.5% of the global economy. There must surely be significant investment opportunity, out that doesn't exist in South Africa. It doesn't matter how well run our country is. You cannot get access to the same investment opportunity. And, you just have to look at the tech sector. South Africa, we've got 2 tech shares maybe. Globally we've got 50 tech shares. In South Africa we've got 1 oil and gas play. Globally we've got 20 oil and gas companies. And by the way, oil and gas companies, as you know, have done incredibly well over the recent past. So
as did Sasol.
As did Sasol, yeah. So I think with regards to offshore investing, forget about the currency and say my portfolio needs to be optimally diversified and be exposed to the best possible investment opportunities. Yes, the rand has to be a part of that debate, and when the rand has shot out 15%, it isn't the best time to take money offshore, and when the rand has strengthened 30%, it probably is a good time to take money offshore. But it shouldn't be the primary driver of your decision. You got to park it on the back burner. And, maybe the last 5 years or 6 years are a great example. The rand has gone nowhere. It's been very volatile in that period, but our starting point and our end point are pretty much exactly the same. So any returns you would have gotten would have been from what underlying investments did you have globally, and that was by far the bigger driver of returns over that period.
Yeah, and it seems as if the exchange rate has, the correlation to political instability have reduced. So it's not as correlated anymore. We have a Zonda report which was released yesterday, which contains really airy stuff, and the rand didn't really move.
That's right.
And I think it's because it's so liquid, it's maybe the exchange rate is influenced more by global trade than with local political developments. Interesting question. Can you change the structure of foreign investments at a certain period in time? Is it a complicated process? Are there tax implications? What should you take into account?
Okay, so I'll start off this discussion with a precursor that I am not a tax expert. So you most definitely would need to speak to a tax expert. But in terms of changing the structure of the investment, I know that there are vehicles you can use, which minimize your tax liability and enable you to change the nature of your underlying portfolio, as frequently as you like while you are within the structure, and the tax event is triggered once you leave the structure. So let me maybe put more color to that, right? If you go through a global endowment, a global endowment structure that, it's wrapped in an endowment, and as long as you remain within the endowment structure, there's no tax event that's triggered by switching from an equity fund into a fixed income fund.
Capital gains tax.
So only once you exit the endowment structure. So that's the important. Once you're in the endowment structure, there is no tax. But once you exit the endowment structure, that's when you trigger your tax event.
Yeah, I think get a tax professional. We had a discussion earlier, and it seems as if there are many events that may trigger tax, which people don't really take into account. The geographical destinations of money, obviously foreign investments, it's not a homogeneous thing. There are many companies. There are sectors which you don't have in South Africa. You've alluded to it, defense at the moment, and luxury goods, biotech, and the like. So you need to take that into account. But how do you allocate the not only geographies, currencies, asset classes, and do you think local wealth managers can do that?
Yeah. So I think the asset allocation debate is a complicated one. And obviously, if you're looking at asset allocation in terms of traditional fixed income, equity, property, I think there's some phenomenal opportunities globally in the equity and the property space, and you've got so much diversification by sector there. I mean, if you look at the property, you've got industrial, you've got commercial, you've got you've got warehousing, you've got multiple options in each of those sectors. You have single family, you have multifamily. So, I think that the level of diversification you get in equity and property globally, there are incredible opportunities. I think with regards to fixed income, it's gotten a little bit better over the last 12 months because we've seen those yields back up quite a lot, within developed markets. But, South Africa still obviously has much, much higher yields than are available internationally. So generally, I think the asset allocation debate, local, I think would be better with regards to fixed income. But certainly there's a lot more opportunity in equity and property globally. And from an asset allocation perspective, I think the wealth managers may not be able to do that themselves, or some may not be able to do that themselves, but they certainly do know expert asset managers who have incredible asset allocation products, who have incredible equity products. And I think if you look at this is where the advantage of a multi-manager might come in, because, you can start to blend asset managers of different styles, so value and quality and momentum, and obviously each of these styles go through various cycles where they outperform. And you as an average investor, it becomes very complicated to know which style do I allocate to, which region do I allocate to. And again, that's where a multi-manager can give you the best of all and pick specialists within geographies. They can pick specialists within investment styles, and you can ultimately leverage off all of that research by investing in these vehicles. So ultimately, wealth managers would know who are the optimal offshore, what is the optimal offshore strategy for to meet your individual needs.
Yeah. There are a few questions about local structures. For example, exchange-traded funds. You can go to Signia, for example, and in South Africa buy an MSCI World Fund, American Fund, Developing Market Fund. And that is in rands, and that's a very, very good product. Not only Signia's, but you can get it from many different asset managers. You can also use a platform like Easy Equities and buy stuff in rands, also in rands into foreign stocks and foreign companies, which is also a good product. But one big advantage I see of investing through those structures, you can sign a debit order on your bank account, and every month pay 100 Rand, 1,000 Rand, 2,000 Rand, 10,000 Rand, whatever the amount is. And you can't do that through an international structure.
Absolutely, Rick. And you hit the nail on the head. And that's why I think that this has been the big development in offshore investing over the last 10 years. It's just how much more accessible it has become. So, an investor out there mustn't feel like this is not accessible to me because I can only invest 200 Rand or 500 Rand a month. It most definitely is. And platforms like these ETFs and, trading these ETFs that are listed on the JSE through any broker in South Africa, and the various brokers have various minimum amounts, but they're not big, and there are brokers that have even lower minimum amounts. So you're 100% right that the optionality exists all the way from the most basic 100 Rand a month debit order going and buying an MSCI World ETF to the most complicated tax structuring, correct vehicle for your estate and your will and your taxes, and selecting the right offshore managers and selecting the right asset allocation to meet your specific investment requirements. From this end of the spectrum to that end of the spectrum and everything in between now exists in South Africa, and offshore investing is a lot more accessible.
So if I understand you correctly, is the structure doesn't really matter all that much. You need to have foreign investments in your portfolio, and the choice of investment is a lot more important really than if you to take the money out relative to investing it in rands with access to offshore markets.
That's a fair statement, and I think, and that's how the playing fields have leveled, So I guess the more sophisticated they invest in, the larger the sums they have to invest, the requirement for the tax benefits and the estate benefits comes in, And I guess the one advantage they have over, say, the smaller amount investor is that, they can get access to sophisticated wealth management and financial planning that can tailor an investment strategy specific to them. Whereas, guys on this end of the spectrum are buying an off-the-shelf product, but again, a very good off-the-shelf product. Nothing wrong with it. And it is exposing you to global companies like Apple and Google and ExxonMobil and JP Morgan and all these companies and brands we consume every day in South Africa but can't invest in on the JSE. It still exposes you to those brands and in a very cost-efficient manner.
Yeah, and again, I don't think you're disloyal to South Africa if you go that route. I think it's just a good, solid investment advice. Interesting question regarding inflation in different geographies. Now, inflation currently is a big topic, and it has become a significant element and issue you need to take into account in your investment strategy, because it's, a year ago we didn't have an inflation problem. Now suddenly we have the US close to 9%. South Africa has gone from 4.5% to over 6.5%. And that will trigger interest rates. So there will be a swift change in the dynamics of the world markets. How should you approach that?
Yeah, so it's a scary time, Rick, and a lot of the volatility we've seen in markets over the last 6 months or so. And I'm sure you've had other guests talk about that. The S&P is officially in bear market territory. We more than 20%
is even more.
Even more, exactly. So and the primary driver of that is the fact that inflation is going higher, and central banks have to do something about it, and they have to tighten monetary policy much quicker than they thought they would have had to a year ago. So, in terms of what you do about that, Rake, I think it depends on your time horizon. If you've got a 2 or 3 year time horizon, a 22% crack in the market is disastrous. You wonder whether you can recover from that. But if you've got a 10, 15, 20 year time horizon, these are market events that happen. Markets go in cycles. Currently, we're going through a bear cycle after more than 10 years of going through a phenomenal bull run. So at some point, a drawback is expected. I think the important thing is to be diversified. Don't have all your eggs in one basket. Don't be invested in a manager that only likes technology shares, or don't be invested in a manager that only likes the growth style. Spread it across managers of different investment styles, spread it across managers in different geographies, and ultimately diversification is your friend in this environment.
And keep in mind, a bull market happens over a long period of time, a bear market happens quickly. So the longer you are within a bull market, the better it will be, because it actually takes a lot longer. Then, what are the trends you are seeing regarding the outflow of money from South Africa?
Sure, yeah. So, there's, as we mentioned at the start, there's obviously been significant demand for these offshore products, and that's why we've seen the proliferation of solutions, over the course of the last 10 to 15 years. 15 years ago, someone who had 100 Rand a month to invest had pretty much no options offshore. Today, at the tap of a couple of buttons, they have multiple options at their disposal. They can go buy a tech ETF, they can go buy an S&P ETF, they can go buy a FTSE 100 ETF, and they don't have to take a cent of their money outside the borders of South Africa. And the reason that has happened is because there's been an enormous exodus of capital from South Africa. As we mentioned, that has been the reason, because of, obviously some of it has been emotive investing. You drive over a pothole, all of a sudden you've got to replace your rim, and I want to take all my money out of South Africa. And some of it has been, the world has become smaller, and people have gotten access to more information, and they've realized that there is this broader opportunity set out there, and I want to be able to tap into this.
But do you see more money being converted from rands to dollars than people, for example, investing in feeder funds?
Yeah, that's a good question. So I'd say there is more. There is more converting from rand to dollars, and I think that's the primary driver behind that has been high net worth investors traditionally don't use rand feeder funds. Because they're looking to take their money out of South Africa and have optionality in terms of what they do with their money from that point. And then obviously the big driver of capital flows are retirement funds. And retirement funds have no need to use feeder products. Up until recently, they could take 30% of their assets directly offshore, and now they can take up to 45% of their assets offshore. And that's currently a very hot debate at the moment in terms of what is the optimal offshore allocation. And a lot of investors have already started capitalizing on that and gradually started increasing their direct offshore exposure.
What are the difference in fees from feeder funds as opposed to direct investments offshore?
Yeah, so that's a good question. So feeder funds would traditionally be slightly more expensive, and the reason for that is you've obviously got this added layer of cost of needing to have a South African registered vehicle. So you're ultimately, again, investing in exactly the same end product, but you're accessing it through an additional layer, shall we call it, and that layer needs to incur some fees.
Yeah, but there will be a difference between an actively managed feeder fund as opposed to an exchange-traded fund. So it's not a clear-cut, it's more expensive to invest in feeder funds. There are other options too.
Yeah, sorry, the way I answered the question was really about comparing like for like. So let's take, for example, and I'm not affiliated to any brand, but let's say the Allan Gray Orbis Fund. If you're investing in the Allan Gray Orbis Fund by taking your money into London and investing in pounds, or you're investing in the Allan Gray Orbis Rand Feeder Fund, traditionally the Rand Feeder Fund would be more expensive. That's leaving out the fact that you can get ETFs that are Rand feeders that are obviously going to be much cheaper options than a direct
75 basis points, 100 basis points, what is the ballpark?
Sure. So it obviously depends on the service provider, but I'd say that the Rand feeder funds are typically between 20 and 25 basis points more expensive than the direct offshore option of the exact same fund again. So again, using the example of the Allan Gray Orbis offshore versus the Allan Gray Orbis Rand feeder.
Yeah, I think that's also you need to investigate the fees, because that could also make a difference. I think we had fantastic questions. I think this is a fantastic discussion, and I think the theme of this morning was, listen, diversification is king, do it for the right reasons, go and pick asset classes offshore that are relevant, and base it on valuations. And interesting, I think that word wasn't used too often today. It seems like political risk is one of the things that asset managers actually watch at the moment. And is that short-term noise? Is it the signal? The idea is that fund managers react to signals as opposed to noise, but they can, with inflation and interest rates that may rise soon. Do you regard that as noise or as a signal? Listen, there is a fundamental change in the direction of the investment world.
Yeah, so I think it depends on the signal, right? There are obviously certain variables which are far more relevant than other variables. We'll park aside political risk because that is impossible to predict and impossible to know which way it turns out. But things like inflation, those I think are very relevant. And the reason why inflation is relevant is, remember, what we do in our industry is ultimately try and forecast a set of cash flows for a company and discount those cash flows back to the present value. And that discount rate is a big part of what the present value of that company is worth. And if inflation is overshooting to the extent that it is, that discount rate has to go up because central banks are increasing rates. And all of a sudden, if your cash flows are delivered in 5 years' time or 2 years' time, that's a lot more valuable than your cash flows being delivered in 20 years' time. And you made the point earlier on that the NASDAQ has been much worse than the S&P 500, and that's exactly why, because a number of the companies on the NASDAQ are delivering their profitability 15, 20, 30 years out. And when you're discounting that back at a higher rate, that's worth significantly less. So depends on the macro variable, but things like inflation and how that impacts interest rates, I think that is very relevant to what asset managers should be thinking about at the moment.
Nada, thank you so much for your time today. I think this is a fascinating discussion, and I think people need to make investment decisions for the right reasons and take emotion out of it. Yes, we're seeing a lot of noise in the market at the moment, but it shouldn't affect a long-term decision. Thank you so much for joining us for this session. We'll be back shortly.
I'm Simon Brown, and I host the Moneyweb Now daily podcast. If you're an investor, Moneyweb Now gives you sharp insights into what's happening in local and global markets, with expert market commentary, CEO interviews, economic analysis, and expert opinions on everything market and investing related. As a DIY investor, keeping abreast of important market-moving events, updates and results needn't be time-consuming. Join my guests and I as we navigate the investing world for you every weekday morning in 20 minutes. Live at 6:30 a.m. on moneyweb.co.za or the app, with the podcast available just after 7.
Moneyweb Now. Business, finance, and investment news. Moneyweb, your trusted source for business and investment insights.
Welcome back. I'm Simon Brown, doing this sixth session of day 2 of the Moneyweb Better Investment Conference. Today this session we're looking at investing for fixed income. And I know a whole bunch of you are thinking, fixed income, not interested, you're going to turn off, you're going to go for I was going to say a swim, but not in this way, that depends, I suppose, maybe where you are. But stick around, because I think fixed income is an important part, regardless perhaps where we sit. Yes, we can look at folks in retirement and say it's a high priority for them. I think it's got space across the broader investment age groups. Certainly we're going to dig into that today and get a sense of it. I'm joined by 2 experts on stage with me. Albert Botha, Head of Fixed Income at Ashburton Investments. Appreciate your joining us. I'm not going to read through impressive CVs. Trust me, they're long, they're impressive, and they're real, but time is always tight. Kilibongile Moloko, CEO and founder of Prowess Investment Managers. Appreciate both of your time today. I suppose let's kick off with Andre, to you first. Albert, to you first. It's about wealth creation, it's about capital preservation. Those are the 2 key components. And the distinction there between anything else that we've spoken about today is also that capital preservation.
Well, yes. Firstly, thanks for having us here, Simon. It's probably been repeated at some point during the last 2 days, but the old Buffett rule is that the first rule is never lose money. And one of the advantages of fixed income is that it's a significantly more conservative asset class. It is also part, as you said earlier, of a broader investment portfolio. It's somewhat trite, it's been somewhat mentioned a lot, but the old 60-40 portfolio that has gained a lot of fame in the US and to some extent is the base for our modern balanced fund is 60% equities and 40% fixed income. So it certainly is an important part of the portfolio, and it's certainly an important part of providing the diversification and by being the safe haven, by being the place where you're less likely to lose money. By being that, it allows you to do other things, and in some ways, it allows you to take advantage of opportunities when they present themselves.
You kicked open the 60-40 door, so let's quickly hover there a moment. We'll come to you in a second. It's been a tough year for 60-40, yes. And I suppose the argument is the good old-fashioned cliche. You know what? We're not even 6 months into the year yet, and that is but a blink in an eyelid in an investment time horizon. So
I think what people tend to forget, to some extent, you joked about how fixed income is not interesting at the start, and a lot of attention does get paid to the equity woes, right? But we've seen in the global fixed income markets, one of the largest fixed income indices in the world is called the Barclays Agg, right? Mm-hmm. Barclays Aggregate Index, and that's been functionally in a downwards market from September 2020. Right, it's down 15% up until a couple of days ago. Right, we've seen a massive drawdown, and it's one of the things that has made the last couple of months particularly difficult for investors globally. Has been this movement in almost a highly correlated nature of all asset classes, which has led to the fact that the current drawdown in assets, if you take the drawdown in bonds, drawdown in equities, drawdown in crypto, is the largest drawdown in asset prices and asset value that we have seen in the world in the last 40 years, both in absolute value terms and in relative to GDP terms. It's about 60% of the US GDP has drawn down from the top at the start of the year to now.
I think the only thing's not is gold and oil, and congrats to the gold bugs, and oil, we wish it would draw down a whole lot more. Yeah. Let's bring you into the process. We spoke about it in the intro there. I said, a lot of people think that fixed income is boring and is a retirement strategy. It absolutely is. Don't dispute that. But it's important. We've been talking for the last day and a half at this conference about diversification, and this is an important part of it. And even as a young investor, there's a space perhaps for it.
No, definitely. I think refer to fixed income as a stepchild, right? I think crypto is the popular child at the moment. Everybody understands equities, and I guess fixed income has not really been brought to the limelight, but it's got many benefits, like it has already been alluded to. I think diversification is one of them. Capital preservation is one of them. And it's also very agile compared to other asset classes in terms of meeting your basic needs, right? So if you're investing for education or you want to go on a holiday, you know, it can be tailor-made for a specific need at an individual perspective, where you can, you know, draw down income that you earn from any fixed income investing strategy as well. And also from a balanced fund strategy, I think it gives you that risk diversification strategy, right? Because then you can't put your eggs in one basket. So the 40% rule, you can play around with it from even being as conservative, maybe even as 10% to around 40%. So it really has that dynamic impact in terms of your asset allocation strategy.
Does it almost sit within a portfolio? It's not cash,
yes,
but it's near cash in a sense. So earlier I had a panel, and we were talking around the distinction between saving, investing, and trading. And when we were talking around saving, we were very much talking cash, money in a savings account. But actually, some of that cash, the very, very short term, the stuff you might need in a week, keep that in ZAR. But the longer term, my sister's saving for a car or something like that, this can actually fill as a near cash product.
Yeah, you can, because you can look at cash up to about 13 months, which is more immediate needs, but you also have an opportunity to invest in income funds, which can go up to 2 or 3 years, where you can both get interest accrual or income, but also some capital gain within that investment strategy as well. Or you can even go a little bit longer, where you still get interest income, but a lot more capital preservation, right? So maybe you're looking at 5 years to around 10 years. So your investment horizon is very important to actually take into account. And it actually gives you an opportunity to earn higher returns, obviously lower than the equity strategy or lower than, you know, the property market, but still a very nice to have in your portfolio.
And that's a great point. And there's certainly a segment of the population out there who's retired, who's perhaps living off a fixed amount, and they can't take the risk of an equity market. They would would love the return, but simply can't take that risk. And this is then the perfect space. So I take your point of earlier, you know, maybe for some folks it's only 10%, but there's going to be some people out there who it might even be 100, and then of course there's the span in between.
Yeah, definitely. And I think what's exciting within fixed income is that maybe we think around, you know, just a particular maturity point, either it's 10 years or 20 years or 40 years, but there's so many instruments or companies or even government bonds, corporate bonds, you know, state-owned enterprises, that you can even diversify within your portfolio. So where you're diversifying through the instruments that you're building your portfolio through, but it also means that you're diversifying your risk, but you're also managing your return prospects as well within that context. So I think, you know, just looking at the type of portfolios that you can invest in can also better suit your needs as well, to be able to optimize, you know, growth and also optimize interest income.
What are some of the products that would typically be in fixed income? I mean, there might be some cash in there, but I imagine, I don't know, is there some cash in there? I mean, it's going to be bonds and those sorts.
So fixed income spans, it's somewhat eclectic in some ways. It spans everything from what most people are familiar with, which is a money market fund, right? That's kind of where it starts. It runs through the various things that was just mentioned, various types of income funds. It is generally branches into the area that's broadly called multi-asset income funds, funds that are mostly income, but they're supplemented with things that are near income, for example, a little bit of property, maybe some preference shares, some currency overlays. Currency tends to work relatively well across from bonds because they tend to be uncorrelated with each other. But then also generally part of fixed income, but things that people quite often forget about are your credit, your high yield credit, and then everything down the capital structure through mezz financing. Whenever you hear the president get up on the stage and says we need the private industry and fund managers to get involved in funding the country, what he's talking about is fixed income. He's trying to convince people to go, let's build together, let's build projects. He's specifically thinking, especially more recently, of these kind of power projects that's starting to pop up all over the place, etc. Right? So fixed income spans at a complete gambit. Now, for most investors, their needs will be met by some of the products that I've mentioned first. So your income funds and your multi-asset income funds. Most South African investors find their home somewhere in that kind of space. And it's generally where you should start looking. And only if you can't find what you're looking for there, do you start branching out and start looking for alternatives, add-ons, further ways of diversifying your portfolio. But kind of what's called the short-term interest-bearing category, multi-asset income category is probably the areas where you start looking. And then for those that are slightly more adventurous, South Africa has a pretty decent fixed income hedge fund community as well, both QIFs and RIFs. We're not going to spend a lot of time talking about that today, but it's something else that you can also...
Because you've mentioned everything except equity, crypto and gold so far. Eclectic is the word.
So, I mean, the fixed income, the money market category is larger than the equity general category, right? It is a massive category. Same thing with many of the other categories. They are very, very large. They don't get a lot of attention because, let's be frank, no one goes to Brian and says, you know what, I bought myself a bond, right? They'll go, I bought myself some Naspers, right? Or I sold myself my Apple share, or Tesla's done very well for me the last 5 years. But no one talks about their adventures in money markets. It's not the way of the world. So it doesn't make the front page of newspapers as often.
And I've just realized I've got a lot more fixed income than I thought because, of course, Reg 28, I've got that little bit at the bottom, which, and I remember going through my statement at the end of, I suppose it was the March quarter, and it's not sitting in rands, it's sitting in a fixed income.
Yeah, no, definitely. I think it's quite interesting as well. I was doing some research a couple of years ago that just in terms of global financial markets, that fixed income markets are actually bigger than equity markets because every government actually funds through the bond market, right?
Of course.
And I think in South Africa over the last 15 years, we've also seen an emergence of credit or corporates coming to the bond market to also issue. So I guess maybe the BRI conversation is a lot easier because then you can talk about, you know, maybe I've got exposure to Bidvest bonds or, you know, Mercedes-Benz and so forth. So there's been a lot of growth and there's been a lot of learnings as well. I think it's just more the investors getting closer to the innovation that has actually happened within fixed income. And I think what is topical now, even within fixed income, is actually the ESG investing, environmental, social, and governance aspects, factors that you take into account. Or even investing in green bonds, it's also another factor. Or investing in fixed income, but having an impact in terms of economic or social factors as well, right? So you'd even find that in typical retail bond funds that you can access in the South African context, that some of the managers are actually investing in underlying companies that has got that sustainability theme coming through. So you can get financial returns, but as well, be relevant in terms of most probably changing the landscape of, where you're
returns.
Exactly the point, yeah.
So there is everything except crypto stocks and gold in there and no barrels of oil. Is it, I mean, most of us would think it's going to be predominantly bonds and probably sovereign. Is that even fair or am I still missing it?
I think to some extent it's fair because when you look at how governments actually structure their budgets, right, there's a very large component that the proceeds that go towards infrastructure development or even funding social infrastructure such as education, healthcare, and so forth. But we've seen, if I talk about the South African context, we've had state-owned enterprises that also issue bonds in the local listed bond market. So most of them have got an infrastructure focus, which has got a social aspect as well. I think what we're seeing globally, and we yet to see from a South African context, is that you also have corporates that might be involved in infrastructure or social industries that would have a positive social impact that will also issue not only in the bond market, but also in the equity markets globally. So hopefully over time, once we go through the current economic cycle, there might be that innovation in terms of companies that are able to access both the listed bond market or even equity market where there's an opportunity to actually rebuild the economy through companies that focus on such factors.
A question from Lelo saying, I'm 22, just started in investing, wants to know about what fixed income is. Keep watching, we're all learning here so far today. How do you utilize it? And I want to add to it, how do you access it? This is not something, I mean, I'm thinking there's some ETFs with bonds in them, but they're not fixed income. And I don't want to go too much down that rabbit hole. I'm typically going to approach a financial advisor or financial institution, such as that you work for, and I would then buy the product that way, either on lump sum or monthly.
So I don't want to go into indexation methodologies and replicability today, but you're right, there's not that many, equity ETFs dominate the ETF market, right? And the primary reason for that is it's easier to replicate and it's more liquid. Whereas because the fixed income markets, the indices aren't easy to replicate, and they're not liquid, as all the instruments aren't as liquid, it's not as easy to create ETFs, right? So fixed income, basically, just to simplify it down to its bare essentials, is the capital markets providing debt funding, right? So in other words, we are loaning money to institutions in various ways, right? Either you're doing it via fixed interest rates, that's generally bonds. You're doing it via floating interest rates, that's generally called floating rate notes, and it's mostly used by the corporate credit market. And the third way is kind of what's called inflation-linked bonds, and that's also primarily government, right? Now, for someone that's 22, the way that they generally would access the fixed income market would be via funds, right? One of the advantages in this space is that fixed income tends to be relatively cheap to access via funds. There's for example, money market funds. Our money market fund sits in the 20 to 25 basis point range. Many of the other fixed income funds sit 35, 40 basis points. They're not very expensive portfolios, and they tend not to have, mostly, not completely, they tend not to have performance fees, right? So the easiest and simplest ways to do that is go talk to a financial advisor, make sure that you've got your risk and your cash flows sorted out, and they can either help you to get access via LISP, which is a list-linked investment service provider, or if you feel confident in your own ability to analyze markets and to look at these products, you can go directly to a Manco. A Manco is anyone like ourselves, asset managers. You can go to the website, and there's normally a way that you can access the funds and invest directly, right? So that's kind of what fixed income is, and two ways to get access, right? We can talk broadly about other ways as well, but for 95% of people, they're going to get access to in one of those two ways.
And then maybe if I can add as well, I mean, it's also very easy, affordable, right? So most of these funds, you would find that they've actually lowered the minimum amount that you can actually invest. You would find that some of them is 300 per month, debit order, like we at around 500, or it can be a lump sum of 5,000 rands, and also easy to withdraw. So if you need it to access your money as well, it's also easily accessible within maybe 24 hours or 48 hours. So there's also that flexibility within the retail space in terms of just being able to invest there.
There's a lot better. I remember Eskom bonds a couple of years ago yielding 22%, essentially backed by government. I thought, brilliant, phoned up a bond broker, minimum 5 million. It's like, okay. So that was me. We've been talking bonds, and some folks, I mean, debt, essentially, it's debt. And some folks are going to be like, whoa, hang on, debt, this is risky. This is not lending money to a person you just met in the bar or your brother-in-law or something like that. I mean, this is government, sovereigns, it's large financial institutions. And part of what you folks do as the managers of it, you're assessing that risk.
Yeah, no, definitely. I think it's very important to understand that we have what is called default risk, which we need to measure. And by default risk, we look at what is the probability that the entity that we're lending money to is not going to repay us, right? So that is taken in terms of your portfolio construction. It's taken into account in terms of looking at your portfolio risk. and also how you structure your portfolio. So we have what we call credit ratings. I guess some people might have heard of it. So a credit rating is actually Standard & Poor's and Moody's. So they would actually assign a level of default risk on a particular issuer or on a government, which would be sovereign debt and so forth. So theoretically, a sovereign government like South Africa or the US government is assumed to be default free. So they would actually have a AAA plus credit rating. And the reason for that is it's not like governments don't actually default, because they do. We've seen with Argentina years back, Venezuela and so forth, is that because they've got the ability to print money, right? And that's
and
also...
we all know what that means, but
Exactly.
You're 100% right. I mean, they own the printing press.
Exactly.
But you raised a great point there. And I remember digging into the markets in the 80s as I was sort of learning my way around. And during the 70s, we'd seen a lot of sovereign default coming through. We still have it.
Yeah.
But it's a lot less frequent. You mentioned Argentina, and a decade later, they issued 100-year bonds and they were oversubscribed.
Yeah.
That sort of prevalence of sovereign default is not off the table entirely, but seems to be less prevalent.
It is. I think also you need to look at how monetary policy and fiscal policy has actually evolved through the different cycles. I think 2008 was actually a case in point where there were new instruments that were actually used to be able to support economic growth, or even to minimize the risk of default, or even to support financial markets. That quantitative easing came into place. Governments being able to print money. You also had synchronized actions from your central banks and also from governments globally, and some of the agencies like IMF and so forth, the World Bank also being involved, because then I think managing global risk became a global issue, right? So and also the impact. I think 2008 happened, we realized that when China sniffs or the US sniffs, everybody gets it, right? So I think there's been this overall risk management from a global perspective. And I think that most probably, in my personal opinion, has actually meant that you would have less governments actually defaulting. So
yeah, I hadn't thought of it that way. I like that entirely. But we've just been talking around the process of buying. A question came through from Andre saying, but how do I buy bonds apart from going to the post office? Those are available, yes. But there's also the nuance, and I don't want to get too much into the weeds here, but if I buy a bond in the primary market, in other words, I buy it directly from the corporate or the sovereign, and I hold it to maturity, assuming no default, I'm going to get my interest every payment, and I get my money back at the end. But as soon as I start buying bonds on an ETF on the JSE or something, then I can have that risk of capital. And probably for most people, the easiest way to get that exposure is going to be through one of these funds, because then I let you folks, the experts, manage it all.
So we've seen an uptick in interest of our own clients looking at buying a single bond. Because you can understand, we sit in front of investors and you explain to them their opportunities and what a 5-year bond is yielding and what a 10-year bond is yielding. And then a client hears that there's a 5-year bond that's yielding 8.9%. And they say, well, actually, I want that one. How do I get that one? Now it is possible, right? You need to have a share trading account. And a share trader can generally get you a portion of that bond. They can buy it in the secondary market. And as long as you buy that bond and you hold it all the way to maturity, right, whether that's 2027 or 2032 or 2037 or all the way out, the longest African bond is an inflation-linked bond and matures in 2050, right? You are guaranteed by the South African government precise payments on precise dates, and I can calculate those payments to as many decimals as you require. As long as the African government is there and they're paying out the money, you will get it, right? The value of that bond, in other words, the resale value of that bond in the market, will go up and down. In the same way that your house price goes up and down. But the utility that you get from your bond, right, is fixed and predefined and known in advance. Much like the utility from your house remains exactly the same, regardless of whether someone pays you less now or more tomorrow and then less the day after that again, right? So I think it is something that people could look into, right? but it is slightly more technical. It is a little bit harder to understand. But it does for certain types of investors that want that combination of potentially higher yields, but also along with more certainty.
Comes back to that capital preservation.
Yeah.
And that has a, let's say, a slightly higher tolerance for complexity. If you've got that triad of requirements and traits, it might be something you could look into, and it is something that is available. It's not something that only us highfalutin portfolio managers can buy. You can buy it as well, but it is slightly more technical. And in the same way that, for argument's sake, Bitcoin and those kind of things are more technical to buy. Some people went through the effort of buying those. It did well for some, but did badly for others. I mean, we're not going to discuss crypto in this session. I'd prefer if we don't.
But I like your point around utility. I'd never thought a bond has utility. The utility is steady income stream that I can calculate to fractions of a cent. Viewers out there, remember, if you've got a question, events@moneyweb.co.za. Send your questions through. They will pop up on my phone. We've still got about another 18 minutes, so we've got some time for some questions there. Another key distinction between a money fund, an income fund, and equity is that the distributions are paid as interest, if I'm correct, and that has tax implications. And I don't want to run down that tax hole, but it does mean, know that there potentially is an implication there, and perhaps speak to a tax expert.
Yeah, no, definitely you have to. I think simplistically, obviously, if you're an individual, you have to look at what is your marginal tax rate. So that will apply in terms of your interest income. There will also be capital gains tax that will be taken into account. So you also have to look at what that is. I think your effective capital gains tax might be around 18%. Maxes out at some point. But also, I think another area that's not really given attention is that the government in 2018 introduced tax-free savings, products. And that the reason for that was to encourage the South African citizens to save more because of the low savings rate, right? So you can actually invest or save up to 500,000 in your lifetime without paying interest income, dividend income, capital tax, capital gains tax as well. So that's an advantage. You can save up to 36,000 per annum, up to 500,000. So either you're going into the fixed income market or equity markets or any other market, that's also achievable.
Yeah, and that's actually, because one thing I did notice, since the tax-free came in, we've got the interest exemption, which if memory serves, 24,800 for under 65, 34,500 above. That hasn't changed. And government is now essentially saying, we've given you this new product. And again, as a youngster, I might want to have equity in there. And as I get into my drawdown years, so to speak, I can start shifting that across.
Yeah, and I think that's a very important point, because I think we're focusing purely on fixed income, but also fixed income can be incorporated into a multi-asset class product, or what we call balance funds, right? So where you can have a portion in fixed income and a portion in equities as well. So it really plays a role in terms of your portfolio construction, and you also get the benefits of tax savings within that similar products as well.
Oh, but what is frequency of distribution, or is this going to depend on the fund? I mean, someone out there is saying, you know what, give it to me at Christmas time, or someone else is saying, I need it once a month. I mean, are the funds, would you find a fund, or perhaps you could say, well, a couple of funds that sort of pay at different frequencies?
So money markets tend to distribute monthly. Income funds broadly tend to distribute quarterly, whereas your riskier funds tend to distribute half yearly. Some investors have an interest in getting those types of distributions and living from them, and it's whereas for many others it's a somewhat of a non-issue, right? I think it for many depends on the ease of transaction and on the platform that they use. And if you are looking for portfolios that do distribute monthly, there are a couple, you can look at them. But the higher up the risk spectrum you go, the more likely it is you'll find that portfolios distribute only quarterly or only half yearly. Because outside of the income funds, there's quite often just not enough either dividends or income to distribute over a monthly period if you're investing in things that don't pay high income rates.
Yeah, but I think, sorry, to interject, the beauty of the distribution methodology is that you can also choose not to receive your interest income,
just
right?
Reinvest it
and then you
back
just
in.
reinvest it, so you get compounding interest, and your capital value also goes up. So that's another way to actually enhance your returns as well. So it all depends on what need you have. Yeah.
And it doesn't have certainty. It's what we said right up front. I remember it was April 2020. We'd all gone into lockdown. The retail government bonds were suddenly offering 11.5%, locked in for 5 years. And I thought to myself, you know what? Like maybe markets are going to do better. Maybe they're not. But I kind of like 11.5%.
Yeah, no, that's very good.
And it was an opportune moment and time. And they still have, I think they're at 9.75. It's that fixed nature of it. Yes, maybe markets do 50 and I lost out, but so far they're down 30, so not so much the case. I have been using money market and income fund almost interchangeably. I suspect they're different.
Yes, they are different, but not entirely different. I mean, there's different ways to structure them. So generally, a money market fund will invest in opportunities that are 13 months and lower. You generally target, investing in bank deposits. You'll find that the bulk of the destination will be your banking sector, or there might be some corporates, but the credit quality of the underlying investments is very high, right? So meaning that, and that's why it's actually synonymous with capital preservation as well, because then you're taking lower risk. We know that bank deposits are also guaranteed by the Reserve Bank as well. So the risk of losing capital is very, 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 very low or close to non-existent, but it does exist. But it also means that your returns are also lower. But it's better than putting money under a mattress or even putting it in one bank deposit, right? So because you're getting diversification. The income fund, you're looking at maybe close to 2 or 3 years, depending on what type of income fund you're looking at. So it will be a combination of cash instruments. It will be a combination of bonds that are short-term in nature, mostly government bonds. You can include credit, corporate bonds as well. And some income funds can actually go into other asset classes, like maybe preference shares. You can actually look at a bit of, optimizing your returns through going into equities. Some of them might have a global component where you can take a portion, like our income fund. We can take 25% and invest that in global markets as well, in global fixed income. So it also depends on your risk profile. So if you're more conservative, it's important to look at the underlying structure of the retail product that you're buying within the income fund. But the beauty of having these asset classes, components of them within the income fund, is that you can actually boost your potential returns, but you have to be willing to take a little bit of volatility in the short term, within that 2 to 3 year or 4 year period. Yeah.
I hadn't even thought of the offshore component, and that would give me exposure to. I mean, if you just stay with bonds for a moment, a multiple of sovereign, and then of course the corporates. I was going to say Apple, but they've got more money than most banks, so they probably don't need to borrow. But and of course that again gives me some foreign currency and also some exchange rate risk, I suppose.
Yeah, no, definitely. I think, obviously, if you're investing in global assets, particularly from a fixed income perspective, it has to make sense from a return perspective, but you are taking a currency view. So if you believe that, our currency is going to be weaker, your proceeds are going to be higher than actually investing in the local market, then it actually makes sense to actually go into the global, fixed income markets as well. And with just the growth in emerging markets and access to emerging market assets as well, means that you can diversify. So you're not only restricted to your developed markets like the US or Europe and so forth. There's a whole lot more that you can invest in, because then there's also a play of, is Brazil priced better than South Africa? They're both emerging markets, but if you think you can actually target higher returns from other emerging market, listed bond markets, why not?
Fair point. Nathan asks a question, use fixed income for short-term saving vehicle. I was suggesting up front that this was a possibility. And notwithstanding, I mean, you were suggesting that actually we can liquidate these literally within a day or two. I mean, is that a proper benefit? The problem with money in the bank, as Nathan says, my return is modest. I think my banks, I mean, maybe they're generous and they're giving me 4.5% or something like that.
That's very high.
So banks are restricted from providing high returns on those short-term next day, let's call them, the instruments by a piece of regulation called Basel III. It affects how much of their savings and deposits are allowed to account for various types of ratios. Things called net stable funding ratio and all a range of different things that you would need a different masterclass on from someone in the bank to cover. But so they don't generally offer great kind of on deposit rates in that space. And the moment that you then start putting it away for 1 month, 2 months, 3 months, 6 months, fixed deposits, then it is literally fixed. Then the rates are higher, but then you can't touch it for 5 years, right? So we find that in many of our products that short-term need, in other words, I'm saving for something like a car, right? I don't know what the car's going to look like, but I'll know it when I see it. In the meantime, I'll save. And then suddenly you look scrolling through Auto Trader, you find the car, you go, I'm buying this tomorrow, I need the cash tomorrow. Yeah. That's the perfect type of vehicle. Then an income fund or a money market fund that doesn't have a lot of volatility is the absolute perfect vehicle for that type of need. The other one is rainy day funds, right? It won't rain for 5 years and then suddenly it storms. That's perfect type of instrument again because you can withdraw the money. So regulatory capital, emergency capital, short-term savings for overseas trips, those kind of things, they work very, very well within the fixed income and kind of income fund space.
Yeah. Or even saving for lobola. You want to get married one.
Yeah.
You don't know when you're going to meet the one, right?
Well, you've met her, you now need to raise the money.
You need to raise the money.
Pay for it.
Exactly.
I want to touch on one of the things that we have suddenly seen for the first time in a long time. Locally, yesterday, inflation, 6.5%. UK, 9.1%. America, 8.6%. So we're seeing inflation rising. We are seeing central banks, I think some of them are a little bit behind the curve. Not our own. I think our own governor is great, but I think there's some banks behind the curve, but we'll leave that aside. But does that simple me says, well, that means I should start getting higher returns out of my income funds as we see rates start to pick up? Is it as simple as that?
Yes and no, because remember when you are saving or investing, you want to be able, you're also looking at mitigating inflation risk, that your money loses value in terms of purchasing power, right? And we know that that's inflation risk. So if inflation is at 6.5 from a local perspective, how much are you earning on your money market fund, right? If you're earning below 6.5, it means that you have a negative real returns. Your money is not going to work for you. So generally what the market does is that investors now demand higher rates because of inflation going higher. So you'll see the money market curve adjusting higher, the bond yield curve also adjusting higher. So investors will actually be looking for higher returns. So on that basis, you should be expecting to earn a lot higher, but also you need to look at what is the rate of inflation, because just getting higher nominal rates, which is what we get it, is not enough. It makes sense in the context that you're actually covering the loss of monetary value as a result of inflation.
Yeah. My friend in the UK earning 8% thinks they're winning. Inflation 9.1, sorry for you. It's not quite working. Well, you mentioned ESG earlier in the conversation, and ESG is a weird one. It certainly has been coming to the fore. There's a lot of pushback in terms of greenwashing and concerns and the like. But, environmental, social governance, I don't think anyone can say that those aren't important. I think they're going to become only more important as time moves on. And I imagine that there are components or even, perhaps funds which have higher ESG, higher green credentials for those who are looking for good as well as profit.
Yeah, I think, over the last, I would say, I started Prowess 13 years ago, and back then we were very much involved in, the projects within the industry that we were trying to engage with retirement funds and investors on incorporating ESG factors into your investment strategy, into your investment philosophy, and also into companies that you're investing in, holding them accountable whether they are actually implementing ESG strategies within their corporate strategy or business strategy, right? And I think the philosophy there is that if you do that, you become a sustainable company. You have corporate, citizenship responsibility as well, which is very important. You do well for society. I think that's an overarching thing. But when you think about it, it should already be incorporated, right? So I think there's been a move of rewarding those companies that actually can demonstrate that in their business strategy, they actually incorporate ESG investing. And some investors actually price for it. It's easier in the equity markets. I think when there were oil spills, you've seen that equity prices got knocked because investors were worried about the environmental impact. From a South African government perspective, we saw in 2015 when we started having governance issues from from a government perspective, that our bond market sold off. So there were governance issues that were coming through. The state-owned enterprises, when there were also governance issues, we saw a lot of local institutional investors also selling your Escoms and other state-owned enterprises. So we're seeing decision makers really taking that seriously, and also being able to price for it where possible. Then it does impact your ability in terms of earning higher returns as well. But it's not a direct correlation because not everybody has yet bought into it in terms of how they manage their portfolios. Not every corporate has bought into it in terms of how they manage their business strategy. But it is a very topical theme. Yeah.
We'll get there in time.
Yeah. And it's harder in fixed income than it is in equities, because we don't have the capacity to vote.
Yeah.
Right? Equity holders vote at annual shareholder events, and they can vote directors, and they can. So we can ask the same questions, right? And we can request the same meetings, but we don't have the right to upvote and downvote various things. So your control is more difficult, and it's more via the funding channel. That's the one thing. And the other thing that's an issue within ESG, within countries like South Africa, I think that is not as prevalent if you read the research internationally, is that people tend to forget that, specifically in developing countries, there is an entrenched conflict between the social and environmental quite often, right? I mean, if you think about let's say a massive new coal mine and a massive if we create a new project, right? We build a coal mine, we build a rail track, we build a harbor, right? It's not very pretty, it's not very environmentally friendly, but it will be amazing for the communities and amazing for jobs, right? So it's exceptional from a social, right? And it could be exceptional from a governance perspective, right? But environmental scores, people are going to look from offshore and go, but that's a bit dirty. And the feedback you kind of want to give them is, yes, but that's the same way you developed your countries. Yeah. And to some extent, many countries, and Germany's found themselves in that place. They've just moved their dirt off their balance sheets. It's why Germany's suffering at the moment, because they've moved their oil and gas to Russia, and now all of a sudden that's come back to bite them.
And now they're reopening.
Coal.
Dirty ones. But I particularly like your point. I mean, America basically chopped down their forests, and it's why the phrase is a transition, rather than a complete and absolute. A quick last question, because we've hit time. How do I pick the fund? I mean, is this something, and it's, I think I've got a level of skill in equity, and I'm not so foolish as to think I'm the best, but I got some level of skill. In this space I haven't. Is this something where really I should get an expert to assist me? Because I can look at yield, but I know that there's more to it than just yield. Get an expert.
No, I would say get an expert, but also know what your investment needs are, your investment horizon. Am I investing over a 12-month, 2-year, or do I have time? That will determine which type of product to actually invest in. Do I have immediate needs? Like it was mentioned before, I want to save towards something.
Have I met the lady, or have I still got to meet her?
Exactly the point, right? So I think that's where to start. But I think if this is your first time, rather talk to an advisor, and through that, it'll be an easier journey going forward in terms of how to navigate it.
And Also, we run, I think, 6 different funds that has the term income in it, right? Income doesn't mean income in the same way, right?
Gotcha.
The one income fund I've run for over a decade hasn't seen a negative month in 12 years. The other fund sometimes sees negative 2%, right? Both are funds well suited for their purpose, but just because something has income in the name doesn't mean you can compare it with something else that has income in the name. I would highly recommend, if you ever want to use an income fund, look at a performance chart, not just a performance table, a performance chart of the last 3 years. You can start it in middle 2019 and then just see what it did over the last period. Because a lot of funds did very well over that period, right? Including, but the rides in for certain funds were rougher than others. That doesn't mean that they were poor funds. It's just that they are more or less suited to certain types of environments.
Yeah. No, and we had Craig Grader-John yesterday, and he was saying that's what he does. He starts with the universe of 2,000 and narrows it down to 35. That's his skill set. So I go to him and say, can I have a look at your list type of scenario and get the expert. I like that point. 12 funds with income in the name. That would boggle my brain. We're going to leave that there. We have run out of time. I really appreciate the insights. This was a huge amount of fun. I learned a ton. I hope that you and the audience learned a ton as well. Remember, we're taking a short break now. We'll be back at 1:30. So don't go anywhere just yet. We've still got a number of great shows coming through.
Traditional property investing can be a complicated, difficult process, often requiring the involvement of various professionals. Here at Easy Properties, we will put you on a path to property investing without the complexities of traditional property ownership. We've changed things so that you can own a share in bricks and mortar through fractional property investing without making a huge commitment of time and money. Here's how. We've made property investing simpler, smarter, and stress-free. Our team of seasoned property experts chooses the best properties to buy and negotiate discounts on your behalf. We buy real properties and then split its value across a number of shares for you to own. Our quick, easy-to-use online platform makes it simple for you to start or expand on your investment portfolio with just a few clicks, offering investors the chance to start small while thinking big. Whether you're new to property investing or a seasoned pro, our goal is to simplify your investment process through fractional property investments. You'll see investment cases for each available property, as well as valuations and historical returns. There's no pain with bonds, lawyers, or boring paperwork, and the costs associated with investing are much lower than traditional property investing. We'll take care of tenants, insurance, maintenance, and all the hassle. All you have to do is sit back and earn your share of rental income after expenses from creditworthy tenants, paid in cash from us to you. If property prices rise, you can watch your investment grow, and when the time comes, you can sell your share to another investor at the new market price through the auction capability within the platform. You can easily access and monitor all your investments online 24 hours a day. Our mission is to help you to enter the property market. Start with one share, keep building, and soon you could own a property empire. It couldn't be easier. Revolutionize your portfolio to the power of property. Sign up on Easy Properties today.
Welcome back. I'm Simon Brown, host of Moneyweb Now, every weekday morning, 6:30 a.m. You'll find me on the Moneyweb website and, of course, the Moneyweb app. Now, this session we're going to be talking youth and money. And joining me is Elke Brink, wealth advisor at R21 PSG Wealth, and it's something which is a passion of Elke's and mine as well. And I think it was something that was distilled into me. I remember as a very young kid getting my 1.5 cents of pocket money, and I couldn't get it until I justified what I was going to do with it. I was allowed to say I could spend some on sweets, but I couldn't just say I was going to blow it. There had to be a plan. And I think even from that very young age, it got me a little bit smarter than that. Okay, appreciate your time today, really joining us virtually. It is something which is so important. No one denies the fact that money is a life skill, but it's not been taught at the schools. Parents aren't teaching it, with respect to parents, because they weren't taught. I mean, heck, our governments don't even have particularly good money skills.
Yeah, thank you, Simon. Thank you for the invitation. I think there's definitely a big lack in our educational system when it comes to younger people, and I think that should be a compulsory subject in school to learn about managing your finances and how tax works and really just planning your portfolios, because it's so relevant to every single person out there. And I think the saddest part of everything is that you lose so much time as a young person where you can start optimizing a portfolio from the day you start earning an income or even pocket money, where I think a lot of people lose easily up to 10 years of their lives just for the lack of knowledge.
Yeah, it's a great point. Certainly, my mother would ask me questions around the pocket money time, but make no mistake about it, when I got my first salary, I did all the wrong stuff with it. I mean, I did every one of those mistakes. How early? I mean, when do you start? You talk about a first salary. You need to have that knowledge beforehand. I mean, at what point do you start having conversations and age appropriate?
I think as soon as possible. I think it becomes so relevant in high school already, or even if you, I have quite a few clients who actually start off with their toddlers by giving them a little savings piggy and really instilling those beliefs from day one that you get X amount of pocket money, and if you save for a party you want to attend over the weekend or a gift you need to buy your friend, so really teaching from the moment that a child starts to understand. And I think that's wonderful beliefs that you can really start from a young age. I think as children get a little bit older, and that I would say maybe high school phase, there are so many wonderful apps and platforms in today's time that really make it easy to understand and to learn. I think easy equities are one of them, where you can play around with fake money, if I can call it
demo
that, to
accounts.
just start learning the principles of investing. And there's a fairly relevant new app. It's called Up, which I think is really fantastic also, where they are instilling the principles of really weekly updates about investment markets and starting to learn the principles of how do you invest in the markets, which asset classes do you invest in. So I don't think you can start too early.
I'm taking your point, and you're mentioning things such as easy equity, such as Up, and I think about my niece who would spend, given half the chance, every waking minute on TikTok. Now, let's make no mistake about it. TikTok is also full of crypto and FX scams. But there was a farmer on TikTok who was just doing some sort of basic, and the fact that he was a farmer wasn't the important point, sort of helping people with family budgeting and the like. And I suppose it's going where the kids are. If the kids on TikTok, well, maybe find a financial person on TikTok who can teach them some of those skills.
Definitely. I think even if you look at Instagram, or I think, maybe I'm a bit older for TikTok already, but I think if you just follow the right pages and you follow the right advisors or something, it's such an easy platform to gain access to little chunks of information. And I think that's a wonderful way to learn. If you make it more fun, you make it more approachable for younger people, it should be understandable. And I think same for parents. I think it's a difficult lesson to start teaching your child from school on how to be responsible with money, how to really plan what you're doing with your pocket money. Like you mentioned yourself, you always had to have a plan. And I think that's fantastic. I think teaching those principles from the start to this is the X amount you're getting per month, and how are you going to spread it and plan for it. And if it's finished middle of the month, then it's finished. You don't necessarily get more. And I think teaching those responsibilities earlier on will make a very big change. I think that's the saddest part to me, that there's no education system for it. There's a reason only 6% of South Africans can retire comfortably. A lot of us are obviously doing something wrong. We're starting to save too late. We're starting to plan too late. What we are saving, we're maybe not allocating correctly because maybe we don't understand what asset classes are important and what not. So it's also important to understand how to invest and to have these conversations. If you start saving, if you start investing, how do I do so? And what are the best ways to grow your portfolio?
And I like your point around that. And it occurs to me that, many adults, and I will admit that, my first, X number of paychecks weren't spent responsibly. And it's something I look back and think, I messed that up. But there's an opportunity for me to now speak to my niece and nephew as a parent to say, I didn't do it well, but I know what the problems were. And it almost becomes, and in the blurb I have, it's a life skill. And to use that as a teaching experience with your kids and say, look, this is what I did. And I know that parents are always saying, don't do what I did and that sort of thing. But to engage them and say, I made these mistakes. These are what I did and what I wish I hadn't, and bring that real world experience into it and make it practical and relatable.
Definitely, and I think we need to be prepared. The moment you do start working, I think you can learn all these skills about building a portfolio much younger. And I think kids are so tech savvy and informed these days that you can build a resilient portfolio at the age of 10 probably. But I think once you start working and you have access to the tools of possibly a pension fund or a provident fund and being part of these type of investments as well, understanding it from day one and optimizing it from day one can make a major difference in your portfolio. So firstly, just ensuring your portfolio is tax efficient from day one, and just ensuring you're saving enough and you're understanding the principles once you have the opportunity to be a part of it.
So I want to move to that, which is, we've been talking probably more teens and maybe even pre-teens, but now someone's maybe in their early 20s, qualified, gets their first job. It starts at that point. Now, obviously, if they work for a large corporate, they're probably going to have some sort of pension or provident money going off. Ask questions around that, but also at 21 years old, find a financial advisor. You're not rich yet, but you will be in time, but you can use that advice, an expert who can guide you.
Definitely. I think the most wonderful benefit you have when it comes to starting a portfolio is time. And if you can save yourself from making a few mistakes starting off, it already makes a big difference. I think that's something a lot of investors unfortunately do incorrectly when you start off, is investing in wrong type of products, or maybe products where the fee structures or penalty structures aren't optimal. Perhaps you're investing too conservatively for your age, especially as a young person. So I think sitting with an advisor and having those talks that you can really make the right decisions from day one, and you're going to save yourself a lot of time of trying to fix the portfolio later.
And is it even, I mean, you mentioned, I mean, I always say your biggest asset as a young person is time, because you've got it in spades. You've got literally decades of it, 4 or 5 decades of it. Some of those decisions that you make back there, you mentioned the right products, for example. I mean, those could have real long-term implications. I mean, if you take your entire net wealth in January and put it in crypto, you're in big trouble. It's those lessons, but is it also perhaps just the structures? For example, a Regulation 28 product or a tax-free product, which is really about the long-term, really designed for that long-term process.
Yes, I think the investment vehicle is always important, and I think an ideal portfolio would eventually consist out of a few different vehicles. And then it's very important the fee structures. I think if you can avoid structures that have penalty clauses included, because the longer time you have, then it becomes a downside, because it's very difficult to get out of that product again with time. And yeah, lastly, I think the asset classes are very important. I think as a young person, you can be 100% in equity exposure because your term is maybe 60 years long. So you have a very long investment term. And I think that's something that needs to be advised appropriately for the individual. But that's definitely a benefit a young person will have. You have an extremely long investment term to work with. And that also takes off a lot of pressure of you have to invest or how much you have to save, because you just have the benefit of compound interest over time.
Yeah, you got that time, and also it is, and I know that we often think we know it all, and I've been in this industry for decades and learning stuff this afternoon. And one of them, I mean, you mentioned there as a young person, and I've met people in their 20s, and I mentioned it in one of the panels yesterday, who are totally in cash because they've saved money. But the markets scare them, so they don't want to get involved. And you're saying, hang on a second, you've got that time on your side, and that's where the advisor comes in. And that doesn't mean that they can't have some traditional product, Reg 28 and the like. They can still have themselves an easy equities account. They can still go and buy some crypto. It's just getting that balance.
Yes, I think any portfolio I'll always advise being diversified. It just depends how much. And I think if you have the benefit of being younger, if you really do the homework and understand how markets behave, and I think that's a responsibility every individual has, even if it's not your main interest, perhaps to focus on finances or investments, but it's so relevant to your future and your life. So reading a bit and understanding what market cycles go through, and maybe you'll feel less risk averse if you really understand the benefit of time. So I think that's something quite important, because I think being risk averse and just being in cash, for example, at the moment, you're almost hurting yourself more.
Yeah, it was the comment that's made many. I mean, cash has risk, and that risk is inflation, which we're currently getting absolutely really the pointy of. What about support structures? I mean, we've spoken about a financial advisor, and that obviously is a part of the support structure. But I'm thinking here, sort of maybe siblings, maybe friends, maybe a parent or friends of a parent. I mean, you're talking around, high inflation. In many cases, folks are particularly, I'm thinking of Americans. If you're 25, 30 years old, you've never seen high inflation. Yet there are people there who lived through it and absolutely know it. And finding a community almost, I suppose, who you can engage with, who can say to you, don't worry, we've been here before, it too will pass in time.
Yes, and I think that comes back to maybe speaking to different generations and reading up yourself a bit, but I think that's important. Everything has happened in history, and it always repeats itself, and I think if you understand the essence of different asset classes and what the behavioral effect is of it, you'll be less scared of it. And I think that's something to just understand and to either speak to an advisor or do the reading up yourself, whatever you prefer to do. But I think once you understand it, then you feel comfortable. And I always feel very passionate about that. I always want my clients to understand why we're making changes to portfolios or why are we deciding certain things, because I think it's just easier to absorb should a crisis come, because you're going to understand what's going to happen and what is to expect in the future.
Yeah, I like that point. Sort of keep them involved. Not hands-on necessarily, I suppose informed. Keep them informed so that they understand what the logic is and what the process. A question coming through from Mary, who says, parent of teens, how do I get them started with budgeting? Now, as I said, I don't know, my mother just kind of did it. I don't know where it came from. But I mean, if you've got tips for parents to how to sort of introduce it, I mean, is it a carrot and stick, no budget, no pudding or something like that?
I think it really depends how you want to approach it, but I think the more in detail you can go from the beginning, the better. So perhaps giving your child, depending on what exactly you are paying as once and what you are still paying for. But let's use an example. You rather give a higher allowance, but now your child is responsible for paying their cell phone contract and perhaps paying some of their clothes they buy on a monthly basis. So you can decide how much responsibility you want to give, but I think the more the better to start understanding the cost of living and allocating that on a month-to-month basis. And I think it's a good principle for adults as well. Sometimes we need to go back to the basics and print out 3 bank statements and really see what are you spending and understand where it's going and where it's possible to save a bit more. I would also implement starting to play around with investments or savings from an early age. You can start an investment account and just learn how it's working, start feeling the effects of the market, being invested from the age of 16 or 14. I don't think there should be a minimum added to it. But I think, really becoming responsible and learning how to plan. As I mentioned a bit earlier, I think if you have 4 parties this month that you want to attend and every friend needs a gift and every friend needs a snack or something you take with, you need to plan for it. And if you haven't planned for all the parties, then maybe you should not attend one or plan differently. Again, it sounds a bit harsh, but I think it's important
I take your point.
to also plan socially.
Yeah, I want to come back to the family process, but something which you said there triggered a thought in me, is to a teenager or perhaps even younger, I don't know, is open them an easy equity account, put 100 Rand in and say to them, go buy something. Because nothing teaches you, all the theory in the world is great, but nothing sort of really teaches you if you bought, I don't know, Steinhoff just before the collapse, or maybe you bought Sasol at the lows of 2 years ago. I mean, that really galvanizes the learning, and because it's small enough amounts of money, worst case, you bought a Steinhoff and you lost lots of it, but you get lessons from it, and it's that real world learning.
Yes, definitely. You learn from it and you learn how the system works. I think you also see the upside of it. If you're having a year like we had in 2021 and you're optimizing your 20% returns on the average fund, then that's also nice to feel. So you can also see the benefit of investing and the benefit of compound interest and how it really makes a difference, even if you're just adding 100 or 200 a month. So I would definitely recommend that.
Remember, folks, if you've got questions, you can email them, events@moneyweb.co.za. They'll pop up on my phone and we can ask them. And another great question has just come through. What common mistakes have you observed that young investors make?
I think there are 2 things I would mainly say, and I think it applies a little bit more to working young adults already. But the one thing would be if they change employers, and they have the option to access their retirement fund that they cash out. And they feel I've only saved a year or two's funds, I can just use it for something and then start again. So I think cashing out the retirement fund would be one of the biggest mistakes. And I think being invested too conservatively for a young person. And I know it's a personality thing also, being risk averse, which is fine and it should be accommodated. But once again, understanding how asset classes work and the benefit of time, be careful to not just be in cash starting off.
that cashing out, and again, as I said, I made all the mistakes when I was young. I think 25-year-old me left a job and cashed in a retirement fund. And I remember at the time thinking that it wasn't a lot of money. And I forget, maybe it was 15,000 Rand or something, maybe not even that much. But of course, that was 30 years ago almost, or 28 years ago. And that money compounded over the last almost 3 decades would be a lot more than that 12,000. And it was me just not understanding what I was looking at was the honest point. I didn't understand the implication. I was like, this isn't going to change my retirement. Truthfully, it wouldn't have changed it, but it would have certainly added to it. It would increase the quality of red wine on cold evenings.
Definitely. I think if you really just do the calculation of what a year's saving in a retirement portfolio would have done if you had just left it for another 50 years, it's a very different. So it might not feel like much. And I think that's also the principle of starting to invest is don't feel that if you're only starting to save 100 or 200 a year that it doesn't make sense to do it at all. Every rand makes a very big difference over the long term.
Coming back, and we were answering the question from Mira around parents and helping them. It almost, particularly at that point where they're teens, maybe even a little bit pre-teen, it almost needs to be a family affair, I imagine, in a sense. And there's a budget which the parent will have, but kind of involve the kids. They might not get much executive voting power on the budget because, of course, then it's all going to be pizza and ice cream. But make it that family affair rather than a dictate. And sit around the table once a month and pull apart, as you mentioned, last month's bank statements. Where did the money go? To try and instill them not just the good habits, but I think also that sometimes there's plans and sometimes plans go a little bit wonky.
Yes, I think as with any good relationship in life, I think communication is important. And I think there's a level of respect that comes with it if children understand where money comes from and where it's going to. I have quite a few friends where their toddlers assume that if you have a credit card that it's limitless. So if you say you don't have money with you and they want an ice cream or a coffee, they just use the plastic money. So I think it's important to start teaching a child from early on. We actually worked hard for this, and this is Wayne, and to understand that, like you say, maybe no voting rights from the start, but having the conversation. And like you say, I think also learning how to plan for emergencies from early on, having that few months saving built up. Okay, if you're not working already, it doesn't apply, but having an emergency fund, maybe learning how to save for a holiday or save for something really nice you want to buy. So learning that longer term investing as well. I think that's one of the biggest things younger people deal with, or perhaps all of us deal with, but it's that instant gratification problem. And I think that lesson also needs to be learned from early on, is how to just learn how to save for longer and not touch your funds.
That's a great point, because we've been talking money and budget, we've been talking investing and starting early and using that benefit of time that you have as a younger person. But it's also learning those skills of saving. And again, you might be in your early 20s at your first job and you might think, what am I saving for? But you're going to want a car one day, you're going to want a house one day, you're going to want a wedding one day. And you might not even have met the person or got your driver's license yet, but that doesn't mean that it shouldn't still be a part of your thinking and a part of your personal finance journey, because it's certainly going to hold you in good stead later in life.
Definitely. I think it's important from day one to start learning how to plan for an emergency fund. And emergency shouldn't just always be seen as a negative thing. It can also be used for a holiday or something nice. But learning how to save for that short-term planning and planning for all the correct things from day one. So I think if you can manage to keep your debt as low as possible or as well structured as possible, and starting to plan for retirement and retirement only focused from day one, and having these different vehicles, having your emergency fund or your holiday fund, setting up all the correct vehicles from day one, I think it will just bring a lot of financial peace and also ensure that you don't have to play catch up later in life.
Does it need to get as complex as because I was starting to think about debt. You'd mentioned that there, and there's different types of debt. Of course, there's maybe a student loan to go to varsity. There's a car and a house, and then of course there's the other debt, the credit card, which has in theory no bottom, but of course it has an end point at some point as well. I mean, is it important to to go to bring those in, to bring in things such as a personal balance sheet? Or are we taking that perhaps a little too far, and I'm getting too excited by the numbers and spreadsheets?
I think it's important principles from day one. I think a lot of us land snowball effect where now maybe you have more than one credit card already, and you have a home loan paying off, and you're paying off your car, and it just becomes the snowball effect where I think ideally, if you could have lived a life where there's no debt, which I think is not possible for the average individual out there, that would have been great. But I think at least prioritizing what type of debt you take on. So maybe something that will be an asset in your life at some point, a home loan, or I guess you can see a study loan or something like that as well. Where credit cards, I would be very wary of, and you're really just understanding where you're optimizing it, and then it goes into a next topic is don't just prioritize that, but also prioritize your investment portfolio. I think a lot of younger people also, as they're starting to settle into their portfolios, they just want to pay off their bond, or they just want to focus on this, and then they're not saving in their investment at all. Where now you're again losing time, where I would say at least try to prioritize both.
A last question, and I've saved it for the end because it's my favorite question, because it's Thabo. And it starts off, I have just matriculated, and I'm thinking where this is going, and it goes a complete different way. Thabo is way ahead of both of us. I've just matriculated. How many investments should I take out? Thabo's got the whole thing wrapped down. I mean, I suppose there isn't a perfect number. I mean, it's more than one. But the sense is that just matriculated, a couple of months out of school and already thinking about that, which tells me on track.
Yeah, very much on track. I'm very impressed with that. I think the number of investments happen naturally as your cycle goes on. So for example, if you start working at an employer who offers a pension or a provident, you're going to have that fourth product. And let's say you leave that employer again, automatically my advice would have been to put it into a preservation fund. So with time, your portfolio will expand, but my recommendation would be to at least try to optimize your tax benefits from day one. And that normally would be a combination of a retirement product and a tax-free investment. But also having a short-term and a long-term type of investment. So long-term would be a retirement product, and that you only really benefit from once you're starting to earn an income because it's tax deductible. But also having a liquidity type of investment. So that would be a voluntary investment or something that you can access in the short term. So I think it's more that you don't necessarily need many products, but the role they play and the usage in your portfolio differs. So some investments will have tax benefits, but you can't touch them for a long time, where other investments will be accessible immediately, but you also want to use it then only as an emergency fund. You don't want to use your accessible investment as your retirement planning, for example. So I think just defining the different roles and the different goals, from short-term goals to long-term goals. And you might only need 2 or 3 different vehicles in your portfolio. I also wouldn't recommend having too many investments because it's just not necessary. You can diversify within that vehicle by using different funds and different asset classes and different managers.
We're going to leave it there. We have run out of time, unfortunately. Elke Brink, Director Wealth Advisor at R21 PSG Wealth, talking youth, youngsters, kids, but also people starting out, and how incredibly important it is. And I think there's a responsibility there, and I think a lot of that responsibility sits on us as adults who we made those mistakes. Let's not see them repeated by the next generation. Okay, really appreciate the time today. Small break. We'll be back with the rest of the Moneyweb Better Investor Conference shortly.
Hi, I'm Suren Naidu, Deputy Editor of Moneyweb and host of the Property Pod. My Moneyweb podcast is published every second Tuesday and covers the broader property industry. We get valuable insights from leaders in the property sector, including the CEOs of GSE-listed real estate investment trusts, property entrepreneurs, industry analysts and experts, as well as private developers and estate agencies. If you're interested in the property industry, then tuning into the Property Pod is a must. Listen to the podcast on moneyweb.co.za, the Moneyweb app, Apple Podcasts, or Spotify.
The Property Pod with Suren Naidu. The Property Pod. Moneyweb, your trusted source for business and investment insights.
Welcome to the property session of the Better Investor Conference. My name is Suren Naidu. I'm the Deputy Editor at Moneyweb, and I also host the Property Pod, which is a podcast on the real estate sector, which comes out every alternate week on a Tuesday. I hope you listen out for it. On this session, South Africans love the property market or property investing as an investment class, despite the risks being sometimes a little bit more heady than some would think. Also, South Africans have a connection with property, considering home ownership as well as the land issue in South Africa. There's an emotional connection considering our history. In this session, we're chatting to two well-known names in the property industry in South Africa, Ipeleng Mkari, founder and CEO of Motseng Investment Holdings, and Kundai Munzara, co-founder and executive director of Sesfikile Capital. Our topic, making money from property. But if you already invested in property, how do you get higher returns? We're looking forward to the chat. Welcome.
Thank you.
Thank you, Suren.
Just a reminder for those listening in, if you have any questions, you can email events@moneyweb.co.za. Before we deep dive into the topic, let's start with you, Ipeleng. How easy is it to get into the industry? You are an entrepreneur in property, having got in the late 1990s, but I'm sure back then it was a lot more tough, and people complain about, okay, how do I get into property investing or the property industry as a career? But 20 years ago it was much more difficult, and it's a lot easier now, but there's still some bottlenecks. Maybe chat about your journey.
It's a very interesting question, and thank you. It's a good question, Suren, and thank you very much for having me. I think that, 23 years ago, the access into the industry was harder because typically, I think the average Joe didn't really know much about the commercial end of property. I think that has changed somewhat with a lot of awareness that's been created over the last 2 decades, particularly post-democracy. I think that the entry point for us was maybe slightly possible to move up the value chain because we didn't start off with investing in property. We started off with servicing property players. And so we saw the value chain, Suren, and we decided that over a good decade, we realized we needed to move up the value chain. Today, I would say to an investor, there are so many ways to enter the market because you are able to enter as just a pure investor, just a person sitting at home, buying stocks into the listed property funds. You could invest directly into your own property, essentially the property you live in or other assets. And I think that the opportunities are quite varied. And then obviously for me as an operator who's built a business around it, it's been fascinating seeing the growth of other people who've come in and been very exciting to see that opening up because I think, as I said earlier, the market has changed in South Africa somewhat to make sure that we have a lot more conversations around this asset class. And we provide it as a real source of entry and wealth creation for individuals as well as entrepreneurs alike.
Motseng, you've come a long way, 20 years in the game. You started in servicing the property industry. I think it was CCTV, was it?
Yes, and property services, servicing the likes of JHI then.
Yes, and then you got that big deal. It's old news now, but 20 years ago, the Marriott deal was a coup of sorts.
Indeed.
With all the history and insight that you've gained over the last 20 years, where are you seeing opportunities in the market now, and what are you investing in?
Oh, Suren, that's a great question. Kundai and I was saying earlier, what do you say about property now? It's a challenge, but it's not an asset class that is that we should forget anytime soon, I would say. I think that for us, you're quite right, Suren, we had a coup in those days, and at that stage, as I said earlier, we were service providers, we were property managers. So for us, the transition to do the Marriott deal was interesting, but where we really made our mark was when we decided to buy our own properties off our little balance sheet and then to list a property fund. So we've gone through the whole value chain as a business. I would say today, it's a very different world. It's one that's quite exciting, but certainly the guarantees that a beautiful property, a commercial asset with a long-term lease presented 10 so years ago, even 5 years ago, is markedly different today. Vacancy rates are sky high as a result, in part, and mainly because of the COVID pandemic. There are obviously other issues in terms of the economic downturn. But I think that largely when I look at property today and where we are investing as Motsing, we're a diversified investment holdings business. We've used our property base and our foundation in property to build a business that can look at alternative investments. And what I mean by that is businesses that lie and that perform and that kind of look like a property, but are not a typical commercial property as we would understand it. So when you talk of alternative investments, we've had a PPP business, which is called Motsing Concessions. It's a public-private partnership business. We've had it for about 15 years. And we have very, very serious confidence around this particular framework that is utilized in the market. And I say it's a framework because it really is a project finance type business. It's not you're not buying the property, you're assisting someone to build something, and there's a project cash flow over a long-term tenure. And I think what would be interesting to share with the team, with the viewers rather I should say, is that we're looking at these alternative investment classes as a feature of property. So if you're buying into a tower asset, a tower co, it has a lease. You can have a lease for 10 years with a lessor, a tenant, a lessee rather. If you have an education asset, if you have a triple P lease against that of 10 to 20 or 15 years, that itself for us is essentially an asset that performs similarly to a typical property lease. There are some slight nuances that differ. We are focused on building our balance sheet as a business, in one part looking at opportunities around disposals or acquisitions into directly held properties, but on the other, looking at how we can contribute to the focus around social infrastructure in our country through this triple P model and building up a bit of a project finance capability there.
We'll get to the public-private partnership because what you could say is that particularly the listed property space has kind of shied away from public-private partnerships. Absolutely. So it's interesting that you might be a case of first mover advantage, who knows. But turning to you, Kundai, just a slightly different tack here because your experience is pretty much listed property. You extensive experience from Old Mutual and having also worked with Investec and then setting up Sifikile Capital as a business on its own. Can you give us maybe a little bit of a rundown on the performance of the sector over the last maybe 3 or 5 years? It seems like a long time frame, but it's actually been quite a roller coaster from like 2018 when you had the resilient fallout and contagion as a result, and then just a slight recovery, and then COVID hit. And now there's a recovery, but there is a bit of wariness, maybe not so much on the South African front, but with the Ukraine and Russia situation. Yeah. Over to you.
Well, thanks, Serena. I think, listed property as an asset class has had a difficult period. I think I was saying earlier, we've had, if we look at the last 4 calendar years, 3 of those calendar years have been particularly difficult for the listed property sector. You rightly said 2018, we had the big drawdown. I think the market was down some 33%, something in that region. And a lot of that had to do with major corporate governance issues, unsustainable earnings that were happening across the sector, much more pointed to a particular group of companies, but it actually affected the whole sector over that time. 2019 was kind of like a holding pattern year. I think the sector was probably flattish or maybe something like 4 to 6% negative. And that was really, I would call it kind of a period of indigestion where the sector was starting to rebase earnings, sort out their balance sheets in a move to try and clean up even at the corporate governance level. And then 2020, obviously, we had the big drawdown that happened, largely driven by COVID lockdowns. So to put it into a little bit of context, 2020 was particularly difficult because the listed property sector on a see-through basis is probably about 60%, maybe a little bit more in the retail space. And the retail space, particularly the large shopping malls, were really the most affected due to the lockdown. So they simply couldn't trade. Aside from community centers and open air centers, the large shopping malls simply could not trade. I think we all remember that period. And also I think something that should be said is that some of the large retailers didn't pay rents for a period or were withholding rents for a period. And the sector went through quite a difficult period. But having said that, 2021 was probably, one of the better periods where we had rebased a lot of the earnings. We started to see kind of light at the end of the tunnel in some respects, and the sector was up just about 38% in returns. So point to point, from the beginning of 2018 to the end of last year, the sector has been down about 20%. If you look a little bit longer than that and you say, what has the sector done maybe 10 years prior to the end of 2021, the total return number is just around 6%. If you compare that to equities, equities have done about 12%. So equities have certainly done better. It hasn't always been the case, because if you look before 2018, 10 years prior to that, the sector was one of the best performing asset classes for many years. So I think these things do happen in ebbs and flows. The important thing, however, is that if you actually look at the earnings pace of the companies, a lot of the companies have been able to outpace inflation. And I would argue that, let's say, compared to buying your own flat to let out to a tenant, listed property has been able to outperform that as well, on a capital basis and also from an income basis.
Okay. Turning to this year, how's things looking this year? I did report that it was a top performing asset class last year, but as you say, it hasn't fully recovered to being top performing for the 10-year period, as it were.
Not at all. So this year, the listed property sector is down. I looked earlier, it's down 10.8 on a year-to-date basis. But also context is important. If you look at global equities, they're down about 23%. If you look at local equities, they're down about 9.5%. So South Africa in general has actually been stronger than global markets if we look at the performance. And I think we know some of the drivers. Some of the drivers is the big, the war in Ukraine. In addition to that, central banks are increasing interest rates globally and locally, and that will have a detrimental impact on valuation. So I think we're in for a tough patch, but I think listed property and South African markets in general have outperformed this year.
Okay. Just turning to the conference itself, or the key theme of the conference, being a better investor from a property perspective. In previous conferences that Moneyweb's hosted, I know good old Keelan, he's no longer with Liberty, but he did punt the fact that property is a long-term investment, and you can't be shocked when there's a shock in the market. Sometimes you need to stay in the game. Yeah. But one could also argue that with the crash from COVID in 2020, or the peak of COVID, the market, you said 38% total return. Imagine if you got in just after that crash. You might not be a long-term investor, but you would have got some pretty good returns there.
Yes, Suren, you're absolutely right. So we've got some clients who Sometimes we wonder who should be doing the asset management, whether the client should be doing it or us. But, we've got some clients that actually did very well. They were investors in the sector, but they topped up around April and May of 2020. And I don't think you could have gotten the timing any better than that, because from that very low point to the end of 2021, that was probably about 70-80% total return. So some of those clients did exceptionally well, and good for them for making that call. The difficulty is no one actually gives you a phone call when it's that right time to invest. And I think, I support what Kilen was saying about being long-term in nature, and really just sticking to the fundamentals of what you're investing in. I think we often get mixed up between what's happening in the stock markets, and often we don't have control of what's happening in the stock market. I don't think any of us here had any predictions about COVID lockdowns or predictions about the Ukraine war. And these are things that are way out of our control. What we think we have a better handle on, not control, but certainly can have better forecast accuracy in, is looking at the underlying fundamentals of the companies. So, looking at it now, the listed property sector is offering a distribution yield of about 10.5%. We expect about 5 to 6% growth over the next 2 years on a per annum basis. We think that's slightly shy of inflation, but what we do like is that the companies are trading at about a 29% discount to NAV. And the balance sheets at a loan-to-value ratio of about 38%, we think are quite stable. So on a going forward basis, you could be encouraged about where you are right now going forward in the sector. To time it and to say today is the right day or next month is the right time is a difficult call. What we do see at this point is value in the sector, and you should rather focus on the fundamentals of the sector. We think the sector is in a decent shape, especially relative to 2 or 3 years ago. And we think that we're actually becoming a lot more constructive on the sector in general. I'm happy to speak more about this later.
What's interesting about what Kunzai just said is that when you consider the listed sector, all those factors are as important for an unlisted player, because when you think about what has happened as a result of COVID, you can imagine having been an owner of properties at that stage, losing out on tenancies and so forth. It became a bit of a bloodbath. And I couldn't agree with you more in saying that an investor with cash, whether you're looking at an opportunity in the listed sector, which is great because there's liquidity potentially, and an investor with cash who's looking at a directly held property portfolio, the opportunity is now. The opportunity was at that time to really come in at the low end. And I think it's those players who we are seeing, Suren, in the typically unlisted sector, who are seriously closing very exciting deals for themselves because they can make quick decisions. And as Kundai is saying, assets are operating and performing at, there are serious discounts to NAV. So you're coming in and you're getting the benefit of that upswing potentially. And really, the guys who are able to make those cash plays, I suppose, will see the long-term capital benefit in being able to make decisions at the right time. But not all of us have that opportunity.
You kind of have covered one of the questions that I had in terms of deal flow and mergers and acquisitions at the moment. Maybe you want to expand a little on that, but it's a little bit of an entrepreneurial question. And we have our next session talking with Easy Properties on their innovation. But access to capital, how do you take credit to most homeowners will take a bond, but if you want to get investing, do you start small? How do you start as a small investor to get into the property? And I'm talking direct here because I'll leave the listed. I'm sure Kundai is biased towards listed.
Towards listed, he would be, of course. Look, I think that for a small investor who's starting out and who has some cash, the fundamentals are not different really to when you're looking at a stock, a share or whatever on the stock market. you really are looking at those key elements and saying, I have some cash, I want to put it somewhere. We're in a very, very challenging market, but as I said earlier, it is those investors or small investors who are able to identify quality assets. So property is still about positioning, it's still about location, it's still about quality tenants, whether it's a retail asset, whether it's a house. It's still about those basic issues. And I think what becomes quite important when you're looking, particularly in our space, Suren, where you're looking at transactions that are not large transactions, but they're big enough for you to have to look at some kind of capital raise of some sort. The fundamentals haven't changed really, So when you're asking the right questions, if it is a house, who's the tenant that I'm going to have? Who's the counterparty that's going to stay in that house who's going to tenant it and rent from me? If it is a small office block, who are the tenants, and are they tenants that I can rely on, so to speak? And I think that what becomes very important is doing having the right assessments for yourself, doing the right analysis and doing the right due diligence on these properties and on these assets. And I think that's where we're finding there is a lot of opportunity in that mid-tier, certainly in the commercial sector. We're seeing a significant amount of deal flow, but we're also seeing challenges in the sense that there are a lot of landlords who are sitting with assets who'd love to offload assets, but who believe that their assets are so highly valued and will not offload at a certain yield. And what we're finding is that, quite honestly, Suren, in the context of that space, many a lender is saying, well, actually, we're not going to participate. We're not interested, because what you're looking for in terms of your yield is far too rich compared to what actually it should be paid for. And I think there's a disconnect there, definitely, in terms of, once again, that directly held property owner who's had these assets for a long time and thinks, hang on, I can offload for a certain price, and is not getting that price. And so, it would be interesting to hear what your thoughts are around that, because I think really there's going to be some time before we get to a point where there's that connect kind of narrows. And so I think what we're seeing is a number of the big banks and, mid-tier banks really not seeing as much deal flow as they would want, or the kind of deal flow that they would back. Let me put it that way.
Okay. We'll stay with you for a minute or so long, or a few minutes. In terms of the opportunities from your side, it's a question for Kundai as well, but the new areas of property, we know logistics property is popular at the moment. There's storage, but there's increasing focus on things like student accommodation. And if you think of a property investor, student accommodation, the likes of the Growth Points are now investing in student accommodation, and these are big buildings. Yes. But you do find in areas that are close to universities, ordinary homeowners are converting their extra space into student accommodation. So you do have that entrepreneurial aspect there. What are the other opportunities? You talked about towers. That's relatively new. In fact, MTN
just sold their
overseas,
business.
and I know somebody. What was it?
IHS has just acquired that, yeah.
And I think it was a pension fund that complained, why didn't South African companies take advantage of that?
Sure, Suren. Okay, so this is a great question, because I think that from an entrepreneurial point of view, we're an unlisted business, and what we've loved is the property space, but we are certainly seeing a strong move by players like ourselves, which is very exciting, into this quasi-social infrastructure and core infrastructure. So we have a business, as I said, called Motseng Concessions, and what I love about that business, it gives us a very wide value chain to look at. An asset is an asset. We've always loved managing assets, and we've been able to buy assets and bring the two together. So when you start talking about a tower asset, so we have a tower management business, for instance, in Mozambique, where we manage all the towers in that country for a particular MNO. The natural move would be to take those towers and understanding of how you manage towers and become a tower co. And so for me, the value proposition, I suppose, in the asset ownership is that you really are now beginning to yield better returns for yourself, because you understand how the operations run, and you're able to yield, I suppose, better income growth for yourself. That is a very, very different asset, although it is still a property type. It operates almost like a property, to a typical building. But let's come closer to home in terms of closer to the property conversation. You're quite right. Student accommodation, health facilities, healthcare is a very interesting space. Those two pretty much operate like a property. It's a building, there is a long-term off-taker or a lease, and in one way or another, that particular lease essentially gives you the capability to now take ownership, raise some kind of funding for that particular asset. I think what is quite exciting about this property space in our country is that people are becoming more flexible and are beginning to respond to the needs of the country and what actually people want. So the reality is that there's a massive student deficit in terms of beds in this country. That's why we're seeing the likes of Growthpoint. A few years ago, they already set up their health business. They're now following with a student accommodation play. And I think what's absolutely fundamentally exciting about student accommodation that you've just underscored is when we look at the research in various regions and even nationally, you start to realize in specific nodes across the country, people's homes that have been turned into student accommodation facilities, those are as much property owners and investors as is the Growthpoint, right? So this space is really shifting at quite a pace. And I think with government's backing, whether it be higher education, the NAFSAS approach, whether it be you're coming in at a higher rate in terms of above NAFSAS, there is a demand. And that is where the connect, I suppose, comes in when you're an investor and saying, well, what do I do with this property, this house that I could potentially turn into something else? And that demand is certainly being taken up. And we are finding that extremely exciting for us because the additional component now that's coming in, I think government is also realizing just their fiscal challenges in being able to secure and provide this kind of accommodation and are bringing in the likes of project finance structures like PPPs on a long-term lease basis that now secures the investment for even the commercial players even longer. And that's important.
Thanks, Ipoleng. Could I, moving away from the NAVs and the technical terms of listed property, as a youngster wanting to invest, how easy is it to invest in the sector? Do you go through an asset manager, a financial advisor? Should their approach be retail? Obviously, it's also about dabbling in the market maybe first, but for those newbies that want to invest in property and think it's difficult and it actually might be quite accessible.
Yeah, thank you. I think the listed property sector, I think in this context of accessing the market, there are several ways to access. So one, which is the most basic way, is looking for a particular share, understanding what the underlying assets of that share are, and buying a share in that company. There's Growthpoint, likes of Growthpoint, there's Redefine, there's Equitas, there's many other companies listed on the stock exchange. One other avenue is to buy a unit trust that is managed by an asset manager similar to us. And then the other method as well is an exchange traded fund, which is effectively buying an index that replicates what the market does in the particular sector, in this case listed property. So those are your avenues. Typically, the entry barrier is not very high. And I think there are many unit trusts which may have a minimum of, let's say, 5,000 Rand. 5,000 to 20,000 Rand is kind of your entry points. But if you're buying a share, it's simply just the price of that share. I mean, I wouldn't recommend you just buy one share, but buy what I would say to many kind of young investors and is that buy enough that if you were to lose that portion, it would hurt, but it wouldn't wipe you out. And I don't know what that number is specific because it's different for different people. But if you buy enough that if you do lose, it hurts, it keeps you interested in the game. So what that does is that it keeps you engaged in terms of what is happening with the underlying companies. Should you invest directly? Should you invest in an index tracker or in a fund? You would want to know what's happening in the sector if it's an index tracker, or you would want to know what's happening in the sector and with a particular manager if it's a fund. And I think that's the way to stay engaged. And the longer you're engaged, typically the better you're going to become at understanding the key drivers of that market. But the answer really is that listed property has effectively made owning some of the, would call it trophy assets in the country and abroad much more accessible than before. Before, for any of us, I think here, to say we wanted to get together as the three of us to buy Sandton City Mall, the check required for that, should we want to do that, is massive. If you buy a share in that via listed property, then you've got a stake in that asset, but obviously you don't own the whole thing. You've got a small portion of that, but at least you've got access to it.
Okay. And then coming back to opportunities, the office sector is still, nobody wants to talk about the office sector. One of your colleagues in the competitor to Sesfigila Capital joked with me the other day saying that attack, for example, don't refer to their offices as offices. I forgot the term that they use.
I know the term. So the term is collaboration hubs.
Collaboration hubs. That's
Yes.
because the office sector is struggling at the moment. But
I must declare I'm an attack director, so I'm going to keep quiet here.
oh, I forgot about that. But thanks for
I love
It's
the
well
term.
done.
I
I'm so
do
glad
love
you
the
know
term. Yeah, I love
what the
term.
term is. So
Yeah,
well done to
yeah.
our team.
Outside the office space, Ipeleng talked about student accommodation. What else can we look forward to in terms of new or alternative sub-investment classes within the property sector?
I like the question, and why I like it is what we're seeing in South Africa. At Sesfigila Capital, we manage some money in global property funds as well. And what we've seen, I'll give you this number. Back in 2000, so let's say 21 years ago or so, the traditional asset class, traditional sectors within property, and I'm talking office, retail, industrial, and apartments, used to form 89% of the total market. Fast forward to today, those four sectors only form about 49% of the total market. And that's because we've seen growth in these sectors that at this point we're calling alternative sectors. We're talking about student accommodation, self-storage, towers, data centers, which I think will come as well in a South African context, and healthcare as well, and different other sectors. But I think the overarching thing when we're thinking about where is property going forward is a closer link between the operations and the actual asset ownership. So the previous job of a landlord of simply rocking up to collect a check for the rental, in many cases, those days are numbered. And what's happening, and I think to Ipeleng's point about understanding the operations of the asset gives you the big advantage in actually managing and owning that asset. So I'm actually quite comfortable to talk about, collaboration hubs, we'll call it that for now, in that the winners even in the office space are the guys that understand their tenants much more and are actually starting to reconfigure their spaces to get much closer to the operations of the tenants, operations of the asset, and owning the asset. So it's not necessarily an issue of there's only opportunity in areas outside of the traditional spaces, but the opportunities for those that can operate and own. At this point, something like self-storage is very interesting. It's a fairly young sector in South African sense. I also think data centers will be interesting. Towers are also interesting. But also the really interesting thing is understanding who's the operator and who's the owner and how linked are they. And at this point, we think the opportunity is going to be the ones that are much more closely linked in terms of where the property sector is going in general.
I couldn't agree more with that. I'll say no more. Yeah.
Just a little note. Thanks, Kundai. Just a little note. We have a few questions that have come in, but Danica, our marketing manager, would need to have a separate property session on tax, because some of them are related to tax questions. So I'm not going to put you on the spot from a tax investment perspective. But one question that I can ask, and I think considering you being a former SAPOA president, and that's a South African Property Owners Association, Ipeleng, I'm going to put you on the spot here.
Okay.
How should an investor, and sorry, the question is from Marion, how should an investor think about property when the land reclaim, the land question, or going forward in South Africa, land reform rather, that's a big topic, and the ANC hasn't really made a decision on it, but it's like...
so it's part of our history, right? And it's part of our future in a way, because if I wear my SAPOA hat, so I don't sit on the board of SAPOA any longer, but I think it's something we grappled with, particularly in my tenure, Suren, and I would say to Marion that the issue around, land in this country and the particular laws or potential subjects around what land can be reclaimed and what can't. We need to consider the conversation in the following context. So there are specific clauses, or I suppose thoughts, that already speak to the ability of land that is not being utilized in the country at all, either by landowners, government, or others, to form part of that process to be, reclaimed and whatever else must happen. I think what's very, very important, and I was at a function yesterday, Suren, that reaffirmed this conversation. What's important for us to understand is that constitutionally, we are a country that also has a very strong judiciary and a very strong process around which I can't just come and take your piece of land that you're sitting on and that you own if it does not form part and parcel of land that is not in use and so forth. So there are conversations that must continue, and I think Marion should not be deterred to, one, understand that investing in property, which is continuing in South Africa at quite a pace, even in these difficult times, you're investing in the context of a country that has a legal structure, that has quite clear lines that can be drawn around ownership of assets, and that yes, this conversation is continuing, but that there are also organizations that on both sides of the fence that are having the conversation quite robustly. And I think that's why the government hasn't kind of accelerated this particular conversation, because that conversation needs to happen. It needs to happen in a way that is responsible, that addresses issues, but that doesn't necessarily tear up what we have, right? And then that's the best way, I think, for me to put it from an investment point of view. It's interesting because when you look at the history of listed funds and what they have, how they've performed at a particular period around that uncertainty. So uncertainty is a very strange thing for investors. Once there's uncertainty, people start to move away from their investment choices in that particular country or in that sector. And we certainly saw quite a movement, certainly in my tenure around 2018-19, of many of the large funds going towards Eastern Europe and other locations offshore, because of the uncertainty. And I think that what I want to speak to and play to is that there will be uncertainty everywhere. In any country, in most jurisdictions, it really comes down to what is, I suppose, particularly in the African context, what is it that we have in South Africa? Well, we have a policy that potentially could be rolled out, but we also have a very strong constitutional democracy, and we're able to interact within that and still continue investing. And that's why we do continue to invest as business people.
Kundai, I'm not going to ask you about the land question per se, but do you agree with Ipeleng, though, within the context of, and it's not a broad statement, but did South African funds invest overseas because of that? Or is it also partly opportunity and higher returns and the hedge of foreign currency as well?
There were many reasons. I think that uncertainty that Ipeleng mentioned is sometimes that becomes, your push factor when you already made the call. But at the time, a lot of listed property funds started going offshore, in Eastern Europe in particular, is that there was a very wide spread between the yield that you could buy assets or the cap rate that you could buy assets versus your funding costs. So, and that spread was much wider than what we're seeing in South Africa. In addition to that, on a comparative basis, those economies were, fast forwarding to catch up with Western Europe in terms of spendings, wages, unemployment. And I think on a market structure perspective, particularly with retail, when you went to places like Poland or Romania, relative to South Africa, you found their retail level of development in formal retail being way behind South Africa. So I think there was real merit in that opportunity set, but the land situation or potential uncertainties that it would create would almost kind of like add an additional reason. But there was absolute merit in some of the players going there. But what we do like, and what I do like, is that a lot of companies are starting to refocus back at home, starting to simplify themselves and to refocus in the backyards that they know. And I think, to Ipeleng's point, there's no country without risk. And you'd rather, and I think you're in a better position managing the risk that's in your own backyard versus the risk that's in other countries, Western Europe, US, Eastern Europe as well.
The land question may be seen somewhat as of a risk. What are the other risks for investing in property? Obviously, it's quite a broad question, but Ipeleng, I'm going to come to the question around utilities and spiraling rates and taxes, but it's quite broad. But what are some of the risks that investors need to consider, Kundai?
I think the biggest risk that investors should rather focus on, and I'm not discounting the risks of the land issue and all of that stuff, but I think the bigger risks that are much more front forward or in front of us, is really, I think in basic terms, the supply and demand picture, the strength of your underlying tenants, their plans, whether to expand or contract. In addition, I think on the cost side, you said you're going to mention that later, because that is really what affects your net operating income. And also the cost of funding is also a cost and availability of funding are the real issues that are the main drivers in property. So if we're talking about supply and demand in the retail space, I know we see a lot of shopping malls around, shopping centers as well, but I would certainly like to say that the amount of new supply has actually dropped down quite considerably. So it's not as big a worry as it was a few years ago. In the office space, there's only 0.4% of existing space being completed, which is almost nothing. Vacancies are high, they're about 17%, that's a big number, but the supply-demand picture is starting to look better. And then the strength of the tenants, if we're talking about the retail sector, if you look at Foschini and many of the other groups, ShopRite as well, a lot of those guys, if you look at their statements, they're refocusing on South Africa and talking about expanding space. And that's a good thing. So if you've got limited new supply and you've got retailers that are talking about expanding, you should be in a better position than you were a few years ago. So I think those are the things that investors should maybe concern themselves with the most. And I think there's sometimes an overemphasis on the negative aspects. But I think things are in balance. There are a few things that are actually quite positive on the demand side. The cost side is difficult, and the funding cost side, which is a global thing, is difficult. On balance, I do again say that I think from a listed property perspective, things are looking a little bit better than they have in many years in general.
And the interest rate cycle and inflation spiking now is uncertainty from that perspective and some level of risk.
Yeah, I mean, I haven't been in the industry forever, but I've never been at a time when I'm talking to my friends in the UK and the States, talking about their inflation being 3% higher than South Africa. I'm kind of enjoying it. But the truth is, inflation in South Africa, I think, came out at 6.5% yesterday, which is a higher number, and it's outside the 3 to 6 band. But I think in context, maybe we're a few quarters behind some of the larger economies. Inflation, I think, in South Africa is high, is accelerating, but I think is still under control. Importantly as well, the lease escalations that a lot of the companies are getting are between 7 and 8%. So they're still outpacing inflation from a lease escalation perspective. And we think that, yes, it is a concern, but if you look 12 months out, we think that inflation will start to come down, really because of some of the base effects that are there. So yes, these things are big concerns. Yes, we shouldn't ignore them. But I think if we kind of extrapolate what we're seeing today, we may actually be making the wrong call. I think things will be under control. And the Reserve Bank has got the credibility and the ability to actually keep inflation at bay. They've done it for all these years.
That is their focus now.
I'm going to ask this question, and it might be, I don't think it's for either of you, but I'm going to ask it. Ipeleng, maybe you want to wade in here as an entrepreneur in the property sector as well. What should retirees avoid when buying an additional property for investment, apart from living in it?
Retirees avoid. It's an interesting one. When buying an additional property.
Yes.
Well, I suppose, you know, the one thing that retirees would be looking for, and I'm certainly not close to that yet, but I'm just imagining stable income and just, you know, consistent kind of return. So I would kind of go back to what Kundai has just said around, you know, quality of asset and quality of counterparty becomes a very big thing when you're looking for something that is just a simple investment and brings you the kind of returns that you want. And that's obviously, I'm assuming that that's a retiree who's looking at investing in a directly held property as opposed to a unit trust or a share. And I think the other is there are things that they can't avoid. You know, there are things that are out of our control, which don't affect retirees, they affect all of us. And those really, Suren, speak to the cost side issues. So you're not going to avoid issues around, you know, energy supply and the cost of energy and how you typically, whether you are a one property owner or you own 100 properties, that issue can really, really have a massive impact on your portfolio and on your investment and on how you manage your property. So I hope I've answered the retiree one as best as I can.
I think it's also, you know, some of the core investment, or not investment, but when you're buying a property, when you buy a house, you know, location and that sort of thing as well.
Absolutely.
So,
absolutely.
yeah.
Those fundamentals that we mentioned before are fundamentally critical. They don't change for any of us when looking at an asset, whether it is one property, one home, or it's a shopping center or whatever it might be. I think those come directly into play. I like what Kundai said earlier around the things that you really need to be concerned about, because I think we've gone through a significant change economically. Just things are just not the same any longer. And so you do need to really understand the counterparties that you're engaging with and their strength and their ability to withstand and be with you in whatever kind of lease term, you know, let's say you're tenanting, and it doesn't matter if it's an office or one home, that is the same. I would say that one of the key challenges that I think commercial property owners and private owners are really facing is this whole, as you said, the whole utilities basket and the impact that it has on us, really. We are seeing a fundamental shift, and I didn't realize, and I didn't think, and let me not say realize, you know, we exposed in the engineering space in our property business to a lot of engineers, the spike and the real acceleration of the water crisis in our country and what that will mean. It will be, I think, a lot harder than we felt in the energy process that we've gone through. So that utility basket, its cost What it does mean is that, you know, for any property owner, particularly large property owners, you are having to become your own utility backer to a degree, in fact, to a large degree. You're having to create that at your own cost, much to most landlords' absolute shock and horror, and we can't run away from that. So that becomes a real, you know, it's a real issue, and I think the moment you're able to look at it as a potential opportunity and a game changer in your business, it allows you to obviously potentially reap other benefits from it. But that also comes with scale. So when you don't have scale, you have a problem in front of you, and you have to be able to manage it. And unfortunately, it's something you can't really control. And I would say that that area is a really serious area, and it will be with us for some time in our country.
We're about to wrap up, but I just thought I'd ask somewhat of a personal question on property investing for both you and Kondai Ipeleng. What has been your hardest lesson in investing in property in the 20 years or so that both of you have been involved in the industry?
So look, one thing that I've learned, and Kondai might not like this, is that, you know, listing a property fund is great. But I'm definitely one, particularly the majority of the South African population, there's a point at which you must participate in it, I think, as an investor. I think that there's a lot of sexiness around this space. It's a very hard space to stay afloat and focused. What Kondai said about the relationship between managing assets and owning assets is fundamental in that space, even more important. You are really dressed up for an investor and an analyst, and you've got to be able to maintain that at all times. So my biggest lesson has been understanding that there's great liquidity in that space, but it comes with massive risks. Not as an investor, but largely as a promoter of a fund. I think that I love the opportunity that the unlisted space presents, particularly for commercial property players or people who want to enter that market, who have entered it, and that ability to eventually see yourself possibly moving into that space. I've learned my lessons there. I've lost a lot of money there. And I think you begin to realize that some things are they're not as sexy as they look from afar.
Okay, thanks, Ipeleng. Kondai, on your side, are you going to punt the listed space? I suppose you are.
Well, that's not the lesson I learned, but but I think the lesson I've learned out of investing in listed property mainly for all this time is I think there are many times where we as investors or the sector, listed or unlisted sectors, underestimate risk, and we maybe fail to take a conscious effort to try and understand the risk, and then adding a little bit of a buffer on top of that. So you can analyze a sector or an opportunity or a company to many levels, but I think there should be a good focus on issues of maybe corporate governance risk, issues of maybe balance sheet risk, and also add a little bit of a layer for, we'll call it the unknown unknowns. And I think a most recent unknown has been the COVID, what happened with COVID. And I think for many people in markets in general, even the Russia-Ukraine conflict is a risk that maybe some people thought may happen, but many people thought would never happen. And I think we find ourselves every 2 or 3 years in markets faced with these unknown unknowns that become apparent. So when investing, I think allow yourself, spend a lot more time considering the risks of that investment and add a little bit more for the portion that you don't know about. And that's been a key lesson for me to maybe try and navigate and be successful in markets in general.
Well, I suppose navigating risk is for any kind of investment. Unfortunately, we're out of time. Thank you so much, Kondai and Ipeleng. That's it from this property session. Thanks for joining us.
Moneyweb Frequently Asked Questions, Part 5. How to use the Click and Advisor tool.
Welcome to part 5 of the Moneyweb Frequently Asked Questions series. I'm Bitumelo Nzoko, and in this episode, we'll share how to use our Click and Advisor tool. Moneyweb's Click and Advisor offering provides financial advisors with the unique opportunity to grow their investor-based audience and attract new clients. Advisors can choose between having just a Click and Advisor profile, which starts at only 650 Rand for 3 months, or the more extensive Moneyweb Insider Pro subscription, which further develops your professional persona as you're able to submit your own opinion pieces and answer readers' questions. This option also includes all the benefits of a Moneyweb Insider Gold subscription. Both options include an advisor profile page with your contact details, company logo, geography, areas of expertise, accreditation, and awards, and can link to your website and social media accounts. Your profile is searchable on search engines, promoted on rotation in our highly popular morning newsletter Moneyweb Now, and is listed on the Moneyweb app. Once you sign up, you can log in, view and assess your profile statistics on your dashboard at your own convenience. Here's how you can join today. Start by going to the moneyweb.co.za homepage, click on the menu tab, scroll down to Click an Advisor and select the Sign Up for Click an Advisor option. Choose between a profile only or the Moneyweb Insider Pro option. Alternatively, to speak to a consultant, please email pro@moneyweb.co.za. Here is what some of the advisors from our Click and Advisor community have to say.
Hi, my name is Tulisile Nkomo. I am from NFB Private Wealth Management. I have been part of the Moneyweb Click and Advisor for the past 3 years. This platform has been a powerful tool in helping me build and grow my professional profile, as well as educate the masses of South Africa about financial literacy. I'd encourage other financial advisors to consider joining this platform, as it helps in growing your own book and also helps to empower other people by educating and promoting financial literacy. Thank you.
Good day. I'm Elke Brink from PSG Wealth in Pretoria and Stellenbosch, and I've been working with the Moneyweb Click and Advisor team for probably 3 or 4 years now, and this has definitely been an exceptional opportunity for myself and my practice. Not only is this really a fantastic platform for you to educate readers and of course reach a much bigger scope of clients, but there's definitely a big opportunity for leads as well, coming from the articles and from the opportunities that Moneyweb provides. So yes, I would definitely advise any advisor to get involved. It has meant quite a lot to me in my practice for the last few years, and yeah, go check it out on moneyweb.co.za.
You can go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels for more information.
Moneyweb, your trusted source for business and investment insights.
Hi there, Suren here again. This time we've got, still sticking with property, we've got a very interesting session ahead. I'm chatting to Rupert Findimore, who's the CEO of Easy Properties. And Easy Properties is part of the bigger Purple Group, but also Easy Equities. And those two companies have disrupted the market. Easy Properties is quite new to their business, only about 2 years old. But we're chatting to Rupert today just about what is Easy Properties doing that's disrupting the market. And we're chatting to him also about access, because the company is leveling the playing field somewhat to allow almost anyone to get into the property sector. I know this because I've already done a story, but welcome, Rupert, and
thank you very much.
Looking forward to the chat.
Yeah, me too.
As I said, the history with Purple Group being the holding company or the listed side of things, But Easy Property is somewhat new. It's 2 years in the game, but it also came in during COVID. Tell us, it's a property play, not really rather a prop tech play. A little bit of history of how it came about.
Yeah, thank you. So obviously Easy Equities was launched about 7 years ago, and it was around about 2.5 years ago a survey was done with the Easy Equities community, which at that stage numbered quite a few 100,000, about what other assets the community would like to invest in. And overwhelmingly, the majority of responses that came back was property. I think initially it was a little bit surprising, with the state of the kind of property market and everything that was happening. But I think if one applies the kind of political and psychological history and attachment to property, it shouldn't have come as a surprise. But yeah, based on that, the idea of Easy Properties was born.
And what makes it easy?
A lot of hard work makes it easy. I think there are a lot of friction points when it comes to traditional investing in property. And so what we've done is we've attended to those friction points and solved for a lot of those friction points. Things like a very simple one is an access to capital. If you don't have access to capital, it's very difficult to invest in property. The other friction points are things like lack of access to finance, lack of access to opportunity. On the assumption that you are able to solve those three things yourself, you still got to then go and find a quality opportunity. You've got to be able to manage this property yourself, and you've got the risk of not necessarily being able to diversify that property investment. And so I think through solving all of those things, it has become certainly easier. I think that's probably it.
And maybe a little bit of insight behind the model that Easy Property offers for investors to get into the property industry.
Yeah. So we've got a group or a big team of people that actually are out there sourcing quality investment opportunities. Generally, if you're a retail investor or someone who's looking to buy a residential property, you're out there paying retail prices. What we're able to do with our community, we're essentially crowdfunding a checkbook. And with that size and weight of the checkbook, we're able to negotiate particularly good deals for our guys. So that's the first starting point, is going out, finding good opportunities, understanding the market, negotiating these kind of discounts which gets passed on to our investor base. We then package that all together. We sign an offer to purchase with the property owners, subject to raising the finance on our platform. We package a whole big prospectus. We put financial models together, the whole bang shoot. We get that all approved by the CIPC, and then it's up to our community to decide whether they want to invest in that property or not. There's a funding target in place. We raise generally 70% equity. We've got a 30% loan to value. We've got an arrangement with SA Home Loans who finance our properties. And should we meet the funding target, then we take transfer of the property on behalf of in the SPV that people are buying shares in, that will own that particular property. And then we've got a team that manage those units in a particular property opportunity, delivering returns, collecting rent, managing the vacancies, all of that. So that's essentially how the model works.
And the access part beyond the side, the friction points that you talked about, where it's access to capital and that sort of thing. What I found quite interesting is that you can invest anything from a rand to hundreds of thousands of rands, and you have investors going across the spectrum. But tell us a little bit about that, and how do you actually participate in this platform? Do you have to be part of these IPOs that you do with specific developments, or there is a separate liquidity question I have later on.
So, I mean, I suppose the biggest difference with what we provide is that people get to choose to invest in a specific opportunity versus another. So for argument's sake, we've just had a very successful raise down in Cape Town with a property called the Carrington. There were 49 units that the developer is busy repurposing in the Cape Town CBD. Those 42, we bought 7 units. We secured 7 units for our investor community. The other 42 were sold out in 7 minutes. And so generally, those 42 transactions would have been to family offices, already well-heeled investors. And the fact that we were able to secure those 7 and offer it into our community, I think we had about 5,400 and odd people invest in those 7 units. So that's a good indication of the access that is being provided. The age range as well literally goes from like 1 year old to 80. Again, affordability. I'm always amazed at the positive nature of the 80-year-old property investors, but also a lot of parents investing on behalf of their children. And as you say, with no minimums. So on that particular investment, our average investment size was 1,200 Rand. And in this scenario, if you've got 1,200 Rand, you've got absolutely zero chance of investing in specific residential property in the Cape Town CBD. As you say, I think having done the stats, we had over 2,000 people that invested in this particular IPO with less than 100 Rand. So there's 2,500 people that, again, own quality residential stock in the Cape Town CBD that would have never had the opportunity to. And as you rightly pointed out, we had people that invested a number of hundreds of thousands of rands. I think for them what was interesting is, theoretically you could have gone and bought one directly, but then again it comes down to diversity and diversification. Putting 200,000 Rand into 7 units gives you that diversification in that specific instance versus owning one of your own and having the risk of a tenant not paying or vacancies or any of that. So there's diversification opportunities too.
And since the 2 years that Easy Properties or just over 2 years, how has the take-up been? I know you've got some ambitious targets, but talk about your investor community. You're involved with quite a few developments.
So Charles Savage, who's the CEO of Purple and Easy Equities, likes to say that Easy Properties is the most spoiled startup in South Africa, and he's not wrong. Being able to launch a business into a community, at the time we launched, I think there were 750,000 within the Easy community. So we're very spoiled from that point of view. It was very well-tended soil. But the take-up's been good. We've had over 250,000 people register for the Easy Properties platform. We've got well over 70,000 active investors. So I'd say the take-up's going well. As a collective community, we've invested in close on 260 units, numbering over 300 million Rand. The targets are ambitious. We're looking to at least double that, holdings in the coming year.
Okay, and then going back to the demographics, it's quite a wide spectrum. And then I was going to ask you about the 1-year-old, but obviously it's the parents investing on the behalf. But it's good to start young. The demographics are, who are? Is it mainly younger people? Is it a cross-section? You talked about an 80-year-old?
Yeah. So it is a cross-section. I mean, both from an age point of view and a geographic point of view. Interestingly, the majority of our investors are in their 20s. And I think that probably points to some of the changing attitudes as it comes to property ownership. People want to invest in property, but I think a lot of these younger generation don't necessarily want to stay in a property that they are specifically tied to, with a mortgage or whatever the case might be. So this is a good opportunity for those people to get onto the property ladder, to get a share of what is now a residential opportunity. We've got other opportunities coming as well across different sectors. So 60% of the investors in their 20s. What has always been quite interesting to me is 68% of all of the people who invest in our properties are male. And it's always been quite jarring for me why, theoretically, when one looks at it superficially, the female investors were lagging behind. But I actually take quite a lot of comfort from the point of view that I know with Lightstone, when they release their figures each year, that the highest or the biggest group of individual buyers are single females. And so I always kind of joke whenever I come across with male investors that the females don't need our help to get started. But yeah, it's spread across that demographic as well.
It might be a generalization, but we often hear women are better with money. So, but I also suppose the Lightstone remark that you made might be the direct investment of investing in a home to stay, for example, and starting off early. What is Easy Equities also looking to try to get more, or I would think they would, but initiatives to try to get more women to invest?
Yes, definitely. We recently had a couple of really good sessions with some female stockfells who've raised significant money and are looking to invest into the platform as well. So definitely, many more females needed.
Give us a little bit more detail on your partnerships and your associations, because it's a very, the disruption side of Easy Equities model, buying into properties and or developments. Maybe you want to highlight some of the other developments that Easy Properties is involved with. When I did the report, I saw some big names, Baldwin, a couple of their developments you've invested in.
Yeah.
But just this week you also got involved in the Saxon Square development in Rosebank was launched, and you also involved there. Maybe you want to talk about that.
Yeah, so I mean, we are essentially developer agnostic. There's no specific partnership or arrangement. We're not a distribution arm of any particular developer, but we do have really good relationships with the developers. I mean, you mentioned Baldwin. Baldwin really love the Easy Properties model, and they've been very generous in giving significant discounts to our investors, and also very generous in giving up to 3-year rental guarantees on their units as well, which is great. Developers putting their money where their mouth is obviously great comfort. So we've got relationships with them. As you rightly pointed out, Saxon Square, which is run by Profica. It's also TriStar Construction are involved. So we've got good relationships with them. But there's no specific developer that we have a preferred relationship on. We assess every opportunity on its merits, and if we feel that it doesn't warrant going onto the platform or is not good enough for our investors, then it doesn't go on. We've also obviously got a very deep association with a development company called Narrative. They're also part of our property partners who help and go out and procure deals for us as well. Yeah.
Just to give a little bit more insight, the management side, because it's quite interesting that you mentioned why maybe somebody should not necessarily take a little bit more risk and invest in a property and then have to let it out. A lot of people who have money would invest in a property and get an agent to deal with all that. But for somebody who might not have access to as much cash, that benefit around you're not investing in one, you're investing in 7 units, and maybe 5 of the 7 is occupied, so you're still getting some income.
Yeah, well, I think, I heard one of the previous guests talk about COVID, and obviously, that was an enormous disruption to the market. I mean, both with people losing jobs and not being able to pay rent and, all of that. Also with vacancies and trying to fill vacancies. If you are all invested in one unit and, your property is vacant or the tenant's not paying rent, then obviously you've got to find the extra money every single month to pay that bond. We were lucky in that by the time COVID hit, we launched with 4 different property collections. One of the collections was hit a bit harder by COVID because it was in the slightly more affordable market. But the guys who launched with us had invested in over 20 units. So while there were 1 or 2 that were a bit tricky to get rentals in, we were still at least collecting income on the other 18 units. So yeah, diversity is key. Again, guys who've invested in all of our different property collections, and there have been quite a few who've since started and have invested in all of them, they've now diversified across 260 individual units. So, 5 or 6 or 7 of those are vacant or, there's no rent collected or something like that. It's not really a big deal.
Going back to the IPOs, and we think IPOs with the, listing on the JSE or on the New York Stock Exchange, your IPO is slightly different. Can you give a little bit more insight on how exactly that works? Because you have people that might sign up and take advantage of each development as it comes up, but you also have another level from the PropTech side where liquidity, there is a level of liquidity of selling it through an auction, I believe.
Yeah. So maybe to deal with your first part of your question first, you're exactly right. So investors have the opportunity of investing in a specific IPO, and we've decided to kind of put those property collections together in a homogeneous way. So there might be, which is sometimes different to investing in the funds, where you're investing in a fund and you've got fund managers who are buying and selling and making decisions, on those particular assets. This way around, you can decide you specifically want to invest in Cape Town, you don't want to invest in Sandton, whatever that story might be. You get the opportunity to apply for shares in that SPV that owns those units alone. So you're not obliged to obviously invest across all of them. Yeah, and the second part is obviously auctions. One of the major friction points with property is liquidity. Having just sold my house now myself, it took me close on 6 months to sell. I was looking at another opportunity, and by the time I had got my cash out, that opportunity had largely disappeared. So liquidity is a huge thing, though we do try and encourage our investor base to remember that property is a medium to long-term investment. It's not a meme stock, and it's certainly not crypto when you're going to look for 30, 40, 50% returns or losses, in a short period. It's a 5 to 7 year investment horizon, and we encourage our investors not to invest with money that they're going to need for school fees or rent or whatever the case might be. But we also understand that things happen and people do need access to their funds. And so we built up an auction capability where once a quarter people can put their shares onto our platform for sale. It's essentially a marketplace within our community. And people can buy and sell shares. It's not only for selling, of course. Guys who are later to the investment platform might very well want to invest in some of the other opportunities. So there's a good opportunity for them to buy at that stage too.
So I guess you have to be in the community to access those opportunities.
Yeah.
Okay. From a financial regulation side, property is sexy. People love investing in property, but you have a case where there's been a lot of property schemes over the years that have been ended badly.
Yeah.
People have had their fingers burned one way or the other. Very often these are private operations where it's, you sign up as an investor and that sort of thing. Considering Easy Property being part of the bigger Purple Group, talk to us about from a regulation and governance side.
Yeah. I've been in the property industry for 18 years, and when I made this transition into essentially the financial services business and the property side there, I've been amazed by the huge regulatory barriers to entry, but also the regulations that look after all of these investments. So yeah, we governed obviously by the Companies Act, by the CIPC, Financial Services Regulation Authority, the works. So before we even put a property onto our platform and after it's been approved by the investment committee, we've got to submit what is essentially a 70-page document to the CIPC, and they scrutinize that and check for all sorts of things, and so it's highly regulated. By the time this property comes onto the platform, there's been months of work in the background to tick the various check boxes and everything that's required from that point of view. With regards to some of these other private enterprises that have gone before us, this is very different. Each of the SPVs is on the title deed of the specific property, and each of the shareholders on the shareholder register of those SPVs. So, it's regulated in all manner and form.
Okay, and talk to us about the returns and the yield side of things. We talked about the liquidity aspect if you invested and you have these auctions, and you did mention that you encourage your investors to stay in it, but the benefit is similar to investing on the JSE, for example, in a property stock where you benefit both from dividends as well as capital gain.
Yeah, and that's one of the benefits again of our collective crowd-funded checkbook, is that we are able to, with these multi-unit purchases, negotiate significant discounts. One of the recent listings on our platform, we had negotiated a 23% discount, which gives you a real running head start on your capital growth. Yields obviously vary across different provinces. I think the biggest thing is obviously the benefit of investing in property is both getting a rental yield and your capital growth, and all of our properties offer a different mix of that. Depending on what a particular investor is looking for. There are high-yielding properties with a slightly lower capital growth, or vice versa. It very much depends. Again, in some of the Cape Town property markets, the yields can be slightly lower because of the expense of the property, but your potential upside for capital growth is big. The area is still pumping.
The question I asked the previous panel, or everybody's talking about it, maybe not so much inflation, but the impact of inflation. How is the interest rate cycle going to affect your investors and Easy Equities as a group? Is it positive? Is there a balance?
Yeah, well, I think from an Easy Properties point of view, we decided to be quite conservative with our loan to value. So the debt that we take on each of these properties, in some of the property investments, guys take a massive loan to value, just really trying to boost the yields that they're getting. We decided to be conservative, and thankfully, and that was, when we launched, obviously interest rates were at an all-time low. But I suppose it's a case of, wanting to under-promise and over-deliver. And so we only take a 30% loan to value on these units. So certainly the kind of rental income that's coming in more than covers all of those bonds, obviously at that low loan to value rate. But yeah, the simple fact of the matter is in a rising interest rate environment, your cost of debt increases and it erodes some of the returns. Unfortunately, there's no way to escape that. Yeah, thankfully, because we've got this long-standing relationship with our mortgage providers, you know, we get good loan rates. Yeah, obviously the inflationary aspect is a concern. You know, it would be naive to not think that.
Okay. We talked about the development, some of the development partners and that side of your model. Where are you seeing opportunities? Let's stick to residential for now, but from a South African perspective, I see that you are invested across the country, but like where are you mainly investing in, and where do you see opportunities for expansion? It's pretty much the big cities for now.
For now, yeah. We've invested in KZN, the Western Cape, in Cape Town itself, deeply here in Gauteng, in Rosebank, some parts of Sandton, and out in Pretoria. Yeah, I mean, you mentioned the Saxon Square opportunity that we've just launched. Rosebank is an area that is doing incredibly well. That sectional title market has increased 12% per annum over the last 9 years. The amount of development that's going on in that area is extraordinary. I know that 60% of the major construction that's happening in the country is happening in Joburg, and the vast majority of that is in Rosebank. You know, Rosebank is outperforming Sandton from that point of view, and so you know that's obviously a really exciting market for us. The other markets are interesting. You know, one of the reasons why we went down to KZN is to take advantage of this Zoom boom. You know, when people suddenly realized that they could work from anywhere and chose to rather be at the coast if that's what they wanted to. So we were lucky enough to invest in a whole bunch of units there to take advantage of that. But I think the next wave, Cape Town's obviously doing incredibly well still, but I think the next wave of opportunity is going to be in some of these slightly smaller Western Cape markets. Cape Town is very expensive, especially when people are selling in Gauteng looking to move and enjoy the lifestyle that the Cape offers. They often get like a rude awakening with what you can get like for like with your rands. And so there are a lot of more people pushing out into some of the slightly farther out areas. If I think of Hermanus and Somerset West and things like that. So geographically looking at those areas. And then also obviously just across the different property types. I heard your previous guests talk around student accommodation. We are assessing a whole lot of opportunities. It's actually been something that has been requested by our community. Stellenbosch is particularly expensive from a student accommodation investment point of view, so we're looking at some of the other major areas. But yeah, some good opportunities there. And again, the micro storage, those kind of self-storage units, micro industrial units, that kind of stuff. Yeah, lots of different opportunities around.
Okay. Tabu sends a question in and asks, why should I invest through Easy Properties as opposed to investing in REITs on the JSE? How would you respond to that?
Yeah, so they're such different products. You know, when you invest in a property REIT, you obviously you're putting your cash into a massive property holdings. You don't have any say on what assets are bought or sold or anything like that, and you are reliant on those decisions that are made by the fund managers. So there's obviously also then just differences in terms of the dividends and the profits that are paid out. Easy Properties pays out 100% of all of the proceeds of these investments. But again, it comes down to personal choice. There are a lot of really good REIT stocks on the market where people can invest. The difference with us is that you are specifically choosing what assets you would like to invest in, for one. You know, often these other funds that are listed on the JSE, you're actually investing in the stocks rather than the underlying assets in a way. You know, it's a stock play. This one, Easy Properties, you're investing directly into the properties and, you know, decide how and where you want to invest in those things.
Rupert, we'll have to leave it there. Thank you so much for your time. We'll have to also Look out for Easy Properties and some of the new developments going forward.
Thank you very much.
Thanks again for joining us. That's the end of this property session.
I'm Kieran Ryan and I host the Moneyweb Crypto Podcast. The Moneyweb Crypto Podcast gives investors a window into the world of crypto that they did not have before. One of the things we do is we introduce them to the white hats in an industry that has its fair share of opportunists and scamsters. Remember, this is an unregulated area of the market, so one needs to be especially careful. If you're going to get into cryptos, and the stats suggest a high percentage of people are at least looking at it, then you need to enter with eyes wide open. So join me and my expert guests weekly on the Moneyweb Crypto Podcast on moneyweb.coza, the Moneyweb app, Apple Podcasts, and Spotify.
The Moneyweb Crypto Podcast, hosted by Kieran Ryan. Moneyweb, your trusted source for business and investment insights.
Our next speaker is a seasoned investment professional, having started his career as an equity analyst in 1999, progressing to many senior leadership roles. Busisa Jia is the CEO of the Association of Savings and Investment South Africa, also known as ASISA.
Good afternoon, ladies and gentlemen. It is an honor and a privilege to stand before you and present on the Association for Savings and Investment South Africa. As said, I am the Chief Executive Officer for ASISA, founded in 2008, representing 121 members across life offices, asset managers, multi-managers, collective investment schemes, linked investment service providers, a lobby group that looks after the interests of our entire industry within savings and investments, managing in excess of 8 trillion rand. And I'm here today really to talk about investments and savings in a manner that I think and hope that all of us have an appreciation for. First and foremost, one cannot start to invest and save without a plan for one's future. And with that said, the best way I can describe how I entered the industry was finally understanding the ability for one to identify business expertise and professionals whose business is to create value, and then having the opportunity to invest in those companies across various investment instruments that perform, that are diversified, and in so doing creating wealth for myself. The first discipline really is around savings, and a financial advisor and planner will assist you with that in determining how much your income is, of your income, how much you spend. That component that is left over, that we would consider savings. And the first step really is to have the discipline to be able to create that surplus or excess so that you can set it aside. In the beginning, I expect it would be something that is just in cash. And that in itself is one of our asset classes that our members across asset managers and life offices can assist in providing access in products that allow you to save. Beyond savings and an expectation for a return that is above inflation, in it being above inflation, meaning that it not only preserves the value of money, but grows it so that you can acquire things that you plan for in future. In acquiring those things, it will be important to assign value to them and a term. And based on your outlook, it will be determined how much risk you can take. It's often said it's not when you invest, it's for how long you invest. And the more patient you are, the greater your chance of achieving that. As a CISA, we report on an annual basis on a number of key initiatives. One of them is the 3 or so trillion that is invested across collective investment schemes, or commonly known as unit trusts. And we have something that's called quarteritis, where we observe on a quarterly basis that the highest inflows are in those products that typically have the best short-term performance. And that's not always the case, that over the long term that such products actually perform. And that's why it's important what I mentioned earlier, that it's your time invested, not your timing of your investing, and it's important to match your expectations to the products that you access. Part of what ASISA does is to improve accessibility to individuals and communities in terms of the products that they can access. And by that I mean wherever you are in our land, whatever tools you have, whether it's a mobile phone or whether it's a insurance company that is in your town or city, we seek to educate and inform individuals and communities as to how they can access our products. And that is quite key. I've talked about the importance of savings, and I've talked about the importance of investing, projecting into the future. But it's also important to emphasize the other parts of our members being in the life offices in terms of insurance. Insurance is often referred to as a grudge buy because by all accounts it covers for an event that is anticipated but has a probability. In other words, it cannot be determined when that event will happen. The history of insurance in itself started abroad in Lloyd's, where ship owners found that when they lost a ship, they could lose their entire business, and they bandied together, and that's how insurance started. Essentially, it's the ability for you to set aside a premium through a policy that's issued by a life office that ensures that that component within your monthly take-home can be set aside for the potential event that if you were to plan for it on your own, given that you don't know if and when it would happen, you can survive it. So in the case of our members, we have policies that look out for that. They can range from life policies in the sense that you plan for the day that you are no longer with your family, and you plan for your family and any other people who are dependents and depend on you in terms of being taken care of. It can also be to plan for the funeral that is unforeseen and to ensure that there's a dignified burial and funeral service. So within the life offices, they also have endowment policies that allow you to invest and plan for a future, whether that future is that for your child's education or something else. Perhaps you are planning to eventually buy a home and you have some period of time to set about the discipline of investing and planning for the future. Speaking of funeral policies, within our membership, we also ensure that we cover funerals, and we ensure that our members are able to honor in the eventuality of a lost life or needing to bury someone. And we are still within a period where we have undergone and endured what is COVID-19 pandemic that led to lockdowns, that led to businesses suffering and households suffering. And in that endurance, our members, some of the 121, have been able to honor to the tune of 600 billion in payouts upon death, and it is important for us as a membership to ensure that our members continue to operate as businesses, and by that, not to be technical, we would look along with our regulators who monitor us, the Prudential Authority, to ensure that those companies continue to operate and are effectively solvent, and our ongoing businesses that have the correct capital adequacy to ensure that for the future they are also going to continue to be able to honor the policies that have been written and signed by our clients. Part of our challenge within our industry is that of reflecting the demographics of our country, in the sense that there are imbalances that are a history of apartheid. So as an association, ASISA also endeavors to have an academy that we refer to as the ASISA Academy, in which we allow students who are not employed to take courses that address the requirements within the savings and investments, and in so doing prepare themselves to be able to work within the industry. And with that in mind, we recently set about ensuring that we have a course that is at an undergrad degree level, NQF8, which essentially means that through the CISA Academy, one is able to get an undergrad degree. On top of that, those students that are enrolled have one-on-one, face-to-face lecturing from our lecturers, and in so being part of that group, they also are seen by our members and have an opportunity to apply for positions. So not only is it important for us to educate and train, it's important that such candidates are also considered for jobs. There is also on-the-job training that allows for individuals to improve themselves, to put themselves in a position where they can be promoted, and in so doing, we address also the diversity and transformation challenges that our industry faces. It's important to be reflective of the demographic of our country. It's important also to consider that the clients also place emphasis to that. Another thing that we do at ASISA as a collective of members is we also look to support small, micro, and medium enterprises and black-owned companies, some of whom become service providers within the industries. Others may be completely outside the industry, but where we have expertise that are able to evaluate entrepreneurship and support it, and essentially support it in terms of funding, and also support it in terms of providing expertise that are able to teach and give opportunity for some apprenticeship in businesses being started. So I have to say that whilst the conference is about savings and investments, it's a far-reaching topic to talk about savings and investments, because it's important to acknowledge that within the financial services, it is part of an infrastructure that enables the ability for all forms of businesses across industries to be able to operate. It allows for better planning in the form of insurance that we provide, and savings and investment products that are accessible for all forms of companies. And as an association, we labor, talk, discuss, debate all aspects that are related to our universe. And our universe includes our stakeholders, from government to regulators to our clients, to our employees within our members, to the economy at large, and to our competitiveness as a country. And so it is important to start young. If you are watching this and you are considering a career, ASISA avails itself, and as a collective we represent the savings and investment industry to our best ability. I thank you for this incredible opportunity to be able to present to you, and we will continue to act in the best interests of our stakeholders as a collective to discuss and prepare ourselves for a changing world and be the change that is needed for our economy, our clients, and our members. I thank you very much.
Traditional property investing can be a complicated, difficult process, often requiring the involvement of various professionals. Here at Easy Properties, we will put you on a path to property investing without the complexities of traditional property ownership. We've changed things so that you can own a share in bricks and mortar through fractional property investing without making a huge commitment of time and money. Here's how. We've made property investing simpler, smarter, and stress-free. Our team of seasoned property experts chooses the best properties to buy and negotiate discounts on your behalf. We buy real properties and then split its value across a number of shares for you to own. Our quick, easy-to-use online platform makes it simple for you to start or expand on your investment portfolio with just a few clicks, offering investors the chance to start small while thinking big. Whether you're new to property investing or a seasoned pro, our goal is to simplify your investment process through fractional property investments. You'll see investment cases for each available property, as well as valuations and historical returns. There's no pain with bonds, lawyers, or boring paperwork, and the costs associated with investing are much lower than traditional property investing. We'll take care of tenants, insurance, maintenance, and all the hassle. All you have to do is sit back and earn your share of rental income after expenses from creditworthy tenants, paid in cash from us to you. If property prices rise, you can watch your investment grow, and when the time comes, you can sell your share to another investor at the new market price through the auction capability within the platform. You can easily access and monitor all your investments online 24 hours a day. Our mission is to help you to enter the property market. Start with one share, keep building, and soon you could own a property empire. It couldn't be easier. Revolutionize your portfolio to the power of property. Sign up on Easy Properties today.
And that's a wrap of Moneyweb's Better Investor Conference. Thank you to the Moneyweb community for attending via the live stream, and to our esteemed panelists and keynote speakers for sharing your insights and guidance on becoming better investors. All sessions will be available to watch from the 1st of July on moneyweb.co.za and the Moneyweb app. Please send us your feedback on events at moneyweb.co.za and engage with us on social media at Moneyweb News. Thank you and good evening.